Hello, my dear students. So, I'm very much happy to meet you all in this platform. So, generally, we all met in another platform. So, generally for CMA or CA. So, now we all are here for CS executive course. So, I'm very much happy. You can see happiness on my face. So, first of all, you all know BCCA is already number one in CA as well as CMA. Now we are in CS2. So, already you all know. So, already our faculties released videos with respect to CS executive course previous two papers. I think Naeem sir and Vignan sir has released videos. So, this video is about first 10 classes of paper number 4 of group 1 corporate accounting and financial management. And one thing, this video is intro video. Here I am just going to discuss few important facts about entire CS course and by BCCA and few information about my paper. Okay, so first of all, coming to CS executive course, you all know we have two groups, group number 1 and group number 2. In group 1, we have 4 papers. So, mine is paper number 4, corporate accounting and financial management. And one more thing, many of the students, they feel, especially who comes from CA or CMA, they feel group paper number 1, 2 and 3, they are completely different if you compare with CA or CMA. Paper number 4 is similar to my CA and CMA. Why? Because we know corporate accounting in our CMA and CA interlevel, and we know financial management as well. Of course, concept is same, but way of asking questions and question pattern is completely different when you compare with CA and CMA. Of course, concept is same. And if you ask me personally, out of these 4 papers, paper number 4 is damn easy when compared to all previous 3 papers. Why? Because all remaining 3 papers are little bit different, and especially theoretical subjects. If you go, that is not that much easy to understand. Of course, for understanding that is easy, but if problematic, that is you are very much expert in accounting as well as financial management in your CMA and CA level. No sir, I am completely a new student. I don't have any background of CMA or CA. For you, all 4 papers are same. Here I am trying to convey one thing. If you pay more attention, definitely you can get very good score in our paper. Why? Because to be very sure, our paper is a little bit easy when compared to remaining all papers. Okay. So everybody will say same thing, but as a faculty for this paper, I have to say same thing. Okay, fine. So, coming to CS executive, if I ask you one thing, why not CA or CMA, why CS, all thing I covered in my class 1, you can go there, and we had a discussion why CS, or what are the opportunities, all those things. Here I am not going to tell same things again and again. So, first of all, for every paper, whatever you are writing, whether it is CA or CMA or CS, exam paper analysis is very important. So I analyzed past 4 to 5 question papers. So coming to our paper number 4 is little bit easy. If you focus on my lectures and if you followed our material, that is more than enough. Okay, so please be positive that you are going to score good marks in paper number 4. Second thing, sir, why BCCA? We have n number of options in market. Why can we choose BCCA? So I have to tell few facts and few facts about our team BCCA. If you observe, our entire team is on screen on that particular pic. So everybody is very much expert in their own subjects. So already group 1 is started, group 2 is going to start very soon. So everybody is simply superb in their field. And one more thing, we are under the same roof. That's why we can spend lot of time. Then we can discuss how to give the best material, and what are the what you call weakness we have to rectify it, what are our strengths we have to keep more strength than it, and what are the opportunities available. That means we are under the same roof, no? Then we have so much of time to discuss, and of course we are working very hard to give the best material. Very soon everybody of us will come up with a big update that is about material, where material will be the simply superb material. First of all, for any student, especially professional student, if you want to qualify in your examination, so more than classes, material plays very crucial role. That's why if you observe, I have not given material right now. Why? Because I'm working on it. I'll definitely give you very good material in very soon. Not only for paper number 4, for all papers you will get the best material. And second thing, sir, what are the mode of classes? So we have 3 modes of classes available. Mode number 1, face-to-face classes. You can directly come to our campus. The location is Newsweed. You can directly sit in front of faculty and you can listen the classes. Second mode, live streaming. That means whenever class is going on, you can listen the same class in your home or else hostel, wherever it is, through our app BCCA. Number 3, recording lectures are available, video recordings. You can purchase video recordings. You can listen those classes whenever time permits to you. So up to my knowledge and up to information available to me, so BCCA is giving the best lectures for CS Executive 2. Okay. So this is about CS. Why BCCA? That is the answer for this your question. And next one, sir, if I study CS, is there any opportunity in the market? Generally, there is a wrong notion that CA and CMA, they are only 2 big courses in commerce course. CS are not very good opportunities in the market. There is no opportunities for CS. That is completely wrong. I will show you a practical example. Then you decide is it important or not. So this is Reliance Company annual financial statements. Okay, for recent last year 23-24, I think, yeah, 23-24 year financial statements of Reliance Company. I think you know, for every company they have to conduct audit of their financial statements. Correct? No? Who is authority to audit? Obviously, CA, Chartered Accountants. In the same report, I will show you one thing. Just give me a couple of minutes. Just 1 minute. I think page number around 80 plus. 81 or 82. Yes, I am correct. 82. Yeah. You can observe this page. What is this? Form MR number 3, Secretarial Audit Report. That means some bigger companies like Reliance companies, they have to conduct secretarial audit. So who has power to do secretarial audit? Undoubtedly the only person are CS, company secretaries only. Chartered accountants and CMAs are not eligible to do conduct secretarial audit. Already I have given the same statement in class number 1 as well. So if you observe this statement, at the end of statement you can observe these are the company secretaries for Reliance Company. BPN and Associates company secretary, form number is there and date 21/4/24 plus Mumbai. In that form, partner is Kalidas Ramaswamy sir. He is the partner for it. He is Udin. Okay, so that means this is a live example for company secretaries. For company secretaries, definitely you have secretarial audits. No sir, I don't want to start an office. Then what are the alternatives available to me? Of course, you can go for corporate jobs. No problem at all. Always doors are open to you with respect to all big companies. Okay. So this next coming 6 to 7 hours or just my first 10 classes video lectures are there. So they are just demo lectures and those all are basics, first 1 or 2 chapters. So still more is pending, very big and interesting chapters are there. I promise you paper number 4 is going to be very interesting. So please come and join us, or else if you are not able to come to directly to newsfeed, then you can opt recorded classes or else live streaming classes. Okay, then there we can discuss more and more. I hope every one of you who are watching this video and who has joined already in CS executive course, I hope a good success. Thank you and enjoy this video. If you have any opinions or doubts on this video or in course or anything else, you can give your opinion on comment section. Take care, all the best, bye. Yeah, thank you. So first of all, so myself Varma, I'm faculty for corporate accounting and CMA and CA level. So now, of course, you know, in CS executive, in group number 1, paper number 4 is corporate accounting and financial management. I am going to deal this subject, nothing but CA and FM. So first of all, just I want to tell you something about me, then you will get some amount of confidence, then it will be more interesting. Since this is first class, I am not going to start any concepts. So today just I want to tell about my facts and my experience, and then we'll discuss about what is our paper, what is syllabus and what are the number of chapters. From next class onwards, we can start the subject. Yeah. First of all, the persons who are watching this video or else who are on live, a big congratulations to you because you have selected a different path what generally other people ignores. Generally, nowadays, majority of Indian students are selecting either BTech, nothing but engineering, or else they will go for medicine. Some people are choosing this commerce course. You know, in commerce course, we have mainly 3 courses. Chartered Accountancy CA, Cost Accountancy CMA and Company Secretary CS. Out of these 3 courses, majority students are in Chartered Accountancy and a little bit equal to CA or in CMA. Very less number of students are pursuing CS course, Company Secretary. But in practical life, the person who has qualified company secretary course, they will have very good amount of opportunities. Why? Because when compared to chartered accountants, number of company secretaries are less. India needs more number of company secretaries. You know, already there is an act called Companies Act. In Companies Act, as per section number 204, every bigger companies has to conduct company secretary audit, nothing but secretarial audit. For conducting secretarial audit, that companies needs only qualified company secretary and they should be in practice. They are called PCS. PCS means practicing company secretary. So definitely for bigger companies, nothing but whose turnover is more than 100 crore and paid up share capital 100, turnover 300 crores. For them, they have to conduct secretarial audit. Secretarial audit means that should be conducted by the company secretary only. So definitely in India we have n number of bigger companies. All those companies should appoint one company secretary for conducting audit. So what is secretarial audit? All these we will discuss in respective subject. Here I want to convey one thing clearly. So in particular company secretary course, so of course syllabus is little bit huge, but if you qualified your professional and final level, definitely there will be a good future. Okay, because number of competitors are less when compared to other courses. If you qualified your company secretary, definitely you can get a job easily, or else you can start a practice. You will get a number of opportunities through bigger companies, or else some kind of proprietorships. You can what you call prepare memorandum of association, articles of association, such kind of things. So firstly, myself Varma, as of now I am teaching accounting and corporate accounting and auditing at CA and CMA level. Also I am teaching corporate accounting and financial management at CS level, and sometimes I use it to teach CFR paper in CMA final level. So why I choose this subject for CS level is very clear. So majority of this subject consists of corporate accounting. Corporate accounting is my subject. So whatever the chapters in our paper is majority, I use it to teach at CA and CMA level. So almost concept is 99% same. And of course I know financial management very well. So today, on first day of our syllabus or our interaction, I promise you definitely at the end of this batch you will be satisfied with my level of teaching, and I will give wonderful material. Definitely I can't do false promises. So I can't say I will give you material by tomorrow or the after tomorrow. It will take some amount of time, but I am working on it. I will give you very quality material. Of course, to qualify any students in any kind of professional courses, whether it is CA or CMA or CS, of course teaching is important, but more than teaching, we need a good material. For example, if you are listening this first class very seriously and very sincerely, even though I am teaching very honestly, but after 1 week or after 10 days, what will happen? You will not remember even single word of mine. That is normal human tendency. So for that you need some material. Whatever I am writing on the screen, you will get the same in the material format. Or else I will try to give at least soft copy to all the persons who are watching online and who are watching our recorded classes as well. Okay, I am planning, actually I am working on material right now. So for me, if you are my student or if you are watching my marathons or else any other courses, my concept is very clear. I'm against to all those muck-ups and all those weightages, all those things. My concept is, my thumbline or my tagline is, always student has to learn with logic. Without logic, you should not accept any kind of facts. There should be some amount of logic. Without logic, there is no concept of accounting, no concept of financial management. Especially for accounting or corporate accounting, definitely there should be some logic is there. Without logic, even I don't accept any facts. For everything there should be some logic is there. For some kind of things, of course there are no logics, we have to accept. For example, in an accounting there are debits and credits. Why debits and credits? That I can't accept without any kind of logic. Once debit or credit are there, why should we debit, why should we credit? For that I have a logic. For example, generally if you comes to CS executive, definitely you should aware of some journal entries. For example, salary paid. What is the journal entry? Salary account debit to cash or bank account. But I don't accept that kind of journal entry. I will ask, why you debited salary account, why you credited cash account. Without knowing the logic of why you are debiting, why you are crediting, I should not accept it. That's what my level of teaching would be. For everything I will give you logic. Without logic, there are no point of classes or no point of concept. If you are listening constantly, there should be some kind of logic. Okay, so come back to our paper, corporate accounting and financial management. You know, in CS executive we have two groups. Under group 1, our paper is paper number 4, the last paper. In paper number 4, we have two parts. Part number 1, corporate accounting. Part number 2, financial management. So out of entire paper, so weightage as per ICSI board is 60%, 40%. 60 marks from corporate accounting, 40 marks from financial management. Actually, here I want to appreciate board of ICSA. Why? Because especially in CMA and CA courses, we can expect or predict question paper. So I don't think this is not a right platform to discuss about it, but still I want to tell something, I will tell. See, for example, in CMA inter level, I used to teach paper number 10, corporate accounting and audit. In that paper, generally, I will explain all the questions, obviously, just like CS or CA. But day before exam, I predict generally question paper. So, for recent June 25 examination paper, I predicted 4 questions. What happened? Exactly those 4 questions has been attended in main exam. Because out of my analysis and my experience, I can predict a question paper of corporate accounting and audit in CMA inter level. Same thing happened in CA level as well. But coming to company secretary course, we can't predict question paper, but we can predict concept. For example, in corporate accounting, 60 marks is weightage. They don't deviate the 60 percentage, 40 percentage. They can't ask 60% in FM, 40% in financial management. They will ask 60% from corporate accounting, 40 marks from financial management subject only. But the problem is, but the fact is, we can't say they will ask a question from this chapter only or this chapter only. That's what I like in CS course. If they are clearly telling us from which chapter they are giving how many marks, that is not at all correct in my perspective, in my book. Otherwise, student will feel mechanical. For example, if I say this weightage for this chapter is 10 marks, you will always focus on this chapter. You will not focus on remaining 2 chapters. So that's what I like in CS course, especially because I analyzed past 4 to 5 papers. Out of my analysis, I observed one thing very clearly. ICSI board is not following particular pattern for examination. They are not asking every time one question from one chapter. We can't predict that kind of analysis in CS. That's I like most in CS course. Then student will focus on each and every chapter. I think that might be the intention of the ICSI board. Otherwise, students will give importance to the weightage chapters. They will ignore remaining chapters. So that is the reason I can't categorize the entire syllabus into A category, B category and C category chapters. Generally, in other courses, we can categorize into A, B and C. But for our course, our company secretary course, especially coming to my subject, paper number 4, corporate accounting and financial management, I can't and I don't tell you categories. Even though out of my analysis, definitely I can categorize it into A, B and C. But right now, I don't reveal A, B and C categories. Definitely, I will give you the details which is A, which is B, which is C at the end of this batch. That means once our syllabus is completed, I will give you which is most important area, which is moderately important, which is less important. If I give it on today, you will not focus on C category or B category chapters. Personally, I don't suggest or predict this A. I don't believe this categorization system. But unfortunately, that is a present scenario of the students. So students are always looks for easy or choosy mode. Okay. So definitely I will give you categories at the end of this batch. Right now, our focus should be always on concept. Ignore about exam, marks, weightage. Definitely, if you are conceptually strong, nobody can stop you to crack your examination. So please don't focus on exam, marks, pass, criteria or fail right now while you are listening or watching these classes. That is all we have to think at the end of batch. Right now, always focus on conceptual clarity. Just listen the classes with 100% presence of your mind. If you are unable to get anything, just ping me. I will clarify your all those doubts. If possible, let's create a WhatsApp group or Telegram group. You can ask me your doubts, or else I will give my number. If management permits, then you can directly contact me. You can ask any doubt at any point of time. You can just text me. I will give you reply whenever time permits to you. Sometimes maybe I am unable to give a reply immediately because of my busy schedule. Because as of now I am teaching all three levels, CA, CMA and CS. Little bit my schedule is busy, but definitely I will give you reply whenever time permits. Okay. So first of all, this is all from my side. So definitely I will do whatever I can do. I will give my 200% best. If you have any queries with respect to my subject, you can feel free to ask any of your doubts at any point of time by just texting your message, or else just take a photo of your question, just send me. Okay. Yeah, let's get back to our executive course. In executive, we have two groups. Out of two groups, our group is group number 1, and under group number 1, I am going to teach you paper number 4. Already I told you at the beginning of this video. So we have two subjects under the same paper: corporate accounting and financial management. Actually, financial management is recently added in this particular syllabus. Before this recent new syllabus, in 2017 syllabus, there is a subject called management accounting and corporate accounting. Now it is modified into CA and FM. CA means corporate accounting, FM means financial management. Actually, you will get two kind of material. One is workbook, second one is concept book. Workbook means there you will find all those questions. Concept book means whatever you are watching on the screen, I will copy the same thing in material format and I will give you this material. Okay. So definitely our material, our classes will be wonderful. The only thing I am expecting from you is maintain consistency. For example, if you are watching classes online, sometimes it may not be possible to attend the classes, maybe because of your health issue or else some other works. In such a case, what you have to do? You have to watch the same class at the evening on same day itself. Don't postpone it. For example, if you have not listened to today's class, what will happen? Definitely, I will continue the same class by tomorrow. Definitely, I can't repeat the same class by tomorrow. There is some connection between today's and tomorrow's class. How can you understand tomorrow's class? So please, if you are unable to attend any class, please complete that video by the next class. Otherwise, it is difficult to understand the next class. Okay? Just like if you have not watched first half of movie, if you go to the movie after interval, definitely you can't understand what is happening there. Why? Because you have not watched the before interval sequence. Here also same. So without consistency, should not expect result. Generally, I told the same thing to all the students at CA, CMA and CS level. You have to maintain consistency. Otherwise, you should not expect results. See, for example, if you are a topper student in your plus 2 or degree level or SSC level, so is set criteria to clear your CS course? Obviously no. If you are an average student in your 10th class or plus 1 or plus 2 level, is it criteria to fail in your CS? Obviously no. Your 10th or plus 1 or plus 2 marks are not at all relevant in this course. Completely our course and subjects are different from whatever you have read in your 10th class and plus 1 and plus 2 courses. So here our focus is on law and accounting, auditing, costing, all this financial management, all these kind of courses, taxation as well. So now here I want to convey one thing to my dear students. Please maintain consistency. If you maintain consistency, for example, as a student you have to watch all the faculty classes. For example, your schedule will be started from morning 9:30 to evening 5 or 6. Definitely, as a student, that is not that much easy to listen all the classes with 100% concentration. I accept it because I came from that situation, that is not at all easy. Of course, students can attend the session and they can listen the session, but the matter is concentration. Is it possible to listen all classes with the same level of consistency? Obviously, no. But my suggestion to you is, even though if your concentration level or decrease from 100 to 80 or 70%, don't quit or don't give up. Just sit and relax the classes. At least you listen 70 or 60% of the content whatever faculty is teaching. That is enough as of now, because we are just taking the coaching. After coaching there is 2 levels or more. You have to prepare for exam, you have to revise the concept, and after that you have to go to examination. Till 2 levels are there, you will get 100% concept. If you have not even listened that 70 or 60%, then while starting your preparation or revision, that will be more difficulty. Okay, my suggestion is to you guys, so even though if your concentration is not up to the mark, please don't give up, just sit and listen. Sometimes what happens, faculty is discussing something which is what you call unable to take, or else which is clumsy, which is not easy. In such a case, our mind will not accept that concept whatever faculty is teaching, or else your mind is not accepting what faculty is saying. You are unable to connect the faculty. In such a case, please don't think anything else. Just sit and listen. That's it. Or else take a deep breath of 1 minute and again get back. Please try to focus on the class. If you get it, okay. Otherwise, also no problem. That video will be recorded in our app. No, watch one more time. You will get it. That's it. No problem at all. Sometimes what happened? Even though that concept is easy, but due to our mind situation, we are thinking about something, or else our mood scenario. You have something problem with your mother or father in the morning session. Immediately after that fight, so there is class from 9 a.m. onwards. Definitely your back end is thinking about that fight with your mother or father. Here faculty is discussing something about corporate accounting or law or taxation. Definitely that is not easy to connect with this faculty. In such a case, don't worry, just keep calm and take a deep breath and listen the class. Still you didn't get it, no problem. Same thing will be recorded on our app. You can watch it evening once again. Okay, so that's it. So from my end, I am giving you promises because I am a kind of person, I can't do false promises. If I give promise, definitely I'll do it. Otherwise, I can't do any kind of promise. So my promise to you guys, definitely we are going to rock paper number 4 in your group 1, nothing but corporate accounting and financial management. Definitely I can say proudly, I am expert in corporate accounting field in subject. You can inquire with us to the same thing with our students. So here that is not important for you guys. Just I am telling the fact. So definitely I will give you the best output from my side with respect to corporate accounting and financial management as well. Okay. So let me start this subject. This intro is enough for me. And you as well, if I am not wrong. Okay, come on. And I want to tell you one more thing. My requirements are very simple. For me, consistency is important. Already I told you. Second one, for me, running notes is very, very, very important. So for qualifying or cracking any paper in any of professional courses, you should maintain some running notes. Or else you can just go through a YouTube channel and just watch the interviews of qualified IAS or IPS who cracked civils, especially rankers video interviews. Definitely they will everybody tell you one common point. Their common point is they will maintain some notes, running notes. Whatever they have practiced or listened, they will maintain a running notes. Of course, you will get material. Same whatever you have watching on the screen, you will get the same thing in a printed format. But definitely, if you write the same thing with your hands, that will give more confidence than it will be in printed format. Definitely, whenever I watch this material, I feel most confident because I prepared this material. In the same way, you have to prepare your own running notes. At the end of batch, you will feel most confident because whatever the content in your material is completely written, handwritten by you only, that is your product. That is your product. In the same way, here also, I am telling you to please maintain running notes. That will help you a lot. That will give you most moral confidence. For cracking any examination, moral confidence is very, very important. Okay? So please maintain a good running notes and better maintain a rule notebook. Okay? Yeah. And that notebook should be only dedicated to our paper number 4, corporate accounting and financial management. Better there should not any other kind of content in that book. Okay? Yeah. Next one. So, actually, I think schedule is from 11:30 to 12:30, but we started at 11 only. Then we can wind up at 12 p.m. because this is first day. So, in corporate accounting, this is the syllabus. Not too many chapters. Very what I can't say less chapters. Moderately. First one. Introduction to accounting. Here we are going to discuss accounting basics already. If I am not wrong, everybody of you aware of this accounting basics. But I will give you promise. I am going to teach accounting basics, which you are which you are going to be surprised. Why? Because everybody knows accounting basics, but you don't know the logic behind it. I will tell you along with the logic, sir. After that, I will discuss introduction to corporate accounting. Why our subject? What is the purpose of this subject? And we have to discuss third chapter accounting standards. You know accounting standards are there. I will tell you accounting standards there. And fourth chapter accounting for share capital. Fifth chapter accounting for debentures. Sixth chapter related aspects of company accounts. Seventh chapter consolidation of accounts. Next chapter, financial statement analysis. Last but one, cash flow statement or cash flows. Last but very important, forecasting financial statements. How many chapters are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, 10 chapters are there in only corporate accounting. Still another part is there, part number 2, financial management. Under this subject we have first chapter introduction, second chapter time value of money, third chapter capital budgeting, fourth chapter cost of capital, fifth chapter capital structure, next chapter dividend decision, working capital management, security analysis, operational approach to financial decision. Yeah. One more thing, if you open your board book, it is around 800 plus pages of content. Please don't follow it. I will give you the best material for CS paper number 4 in our group 1. Okay? Don't watch or don't open that book and don't feel afraid, or else don't think about how can I read this entire 800 plus pages. Don't worry it. Okay? So, first chapter introduction, time value of money, capital budgeting, cost of capital, capital structure, dividend decisions, working capital management, security analysis, operational approach to financial decisions. These 9 are chapters with respect to financial management. Already we have 10 chapters in corporate accounting, but these first 2 chapters are not at all very big chapters. They are just introduction, no? So you can ignore these 2. That means hardly we have 8 chapters in corporate accounting. Here If you ignore introduction, 9 chapters or 8 chapters in financial management. So 8 plus 8, 16 chapters. Okay, so little bit number of chapters are high if you watch aggregately. That means both the CA and FM. Okay, so I'm just showing you index of our paper. So just open your notebook and give a heading index. First of all, if you want, write this entire content. I will wait for you, no problem at all. If you have not yet maintained notebook for it, at least write in a rough book, and after this class or after this today's schedule is completed, and take a good rule notebook for it and copy the entire thing whatever you have written in your rough book. Okay, please copy it. Right, group number 4, paper 4, corporate accounting, divided into 2 branches just like this, and second branch financial management, and corporate accounting 60 marks, FM 40 marks. I will wait for you, no problem. Take your own time to write the content because this is our first class only. And put a heading index. After that index, corporate accounting chapters. Write down one by one. Can I scroll up? 60 marks, 40 marks, and under corporate accounting we have 10 chapters. Number 1, introduction to accounting. Second one, introduction to corporate accounting. Third one, accounting standards. Fourth one, accounting for share capital. And fifth one, accounting for debenture. And next one, related aspects of company accounts and consolidation of accounts, financial statement analysis, cash flow, forecasting financial statements. Just copy this index. Just I am telling you one more time, please believe me, we are going to rock. Is it done? All 10 chapters? I think Meenakshi, I think you are there. Is it okay? Everything, audio and video? May I know? If possible, please respond by texting. Audio and video are okay or not? Meenakshi. Yeah, thank you. If it is 10, I will move on to financial management chapters. Yeah, I hope it is completed. So let me scroll to financial management. If it is not done, yeah, you can just again get back to your video. Just pause and you can write. Otherwise, just ping me, I'll definitely give the details. At the end of this session, I will share my number or else Telegram. You can directly text whatever you want. With respect to subject, any doubts you can ask me. Introduction, time value of money, capital budgeting, cost of capital, capital structure, dividend decisions, working capital management, security analysis, operational approach to financial decision. These 9 are chapters in financial management. Now the point is, so out of our paper number 4 in group 1, 60% is from corporate accounting, 40% is from financial management. Now the point is, sir, which part we have to start first? Obviously, we are going to start corporate accounting part first. Then if it is completed the entire corporate accounting chapters, then we'll move on to financial management part. Okay? Yeah. Is it completed? From next class onwards, there will be no this kind of lates or else delays. I will plan that whatever time is there with respect to our paper, we are going to utilize that time effectively and efficiently. I am not going to waste even single minute. I will plan accordingly. But since this is the first class, so that is the reason I'm just what you call giving all details, and I'm giving you time to writing as well. Done, no? Yeah. So now let me tell you what is the importance of each and every chapter in our syllabus. So firstly, let's discuss about corporate accounting part. Okay. I hope it is completed. All these 9 chapters you have written in our index. Yeah. Yeah. So thank you, Meenakshi completed. Superb. So come on. In corporate accounting, you have written introduction to accounting. In this chapter, just we are going to discuss what is the basics of accounting. Where I am going to tell you why accounting subject is, what is the roots of accounting, and how to write journal entries, how to post ledger accounts. Of course, you know, but I will give you a different perspective, entire different aspect. So this is very basic chapter, but I will give you some more new points which you are unaware of it. Second one, introduction to corporate accounting. So in this chapter, I will tell you the main subject name is corporate accounting only. There we are going to discuss how this subject will be, what is the meaning of corporate accounting, those all things will cover in this chapter. First of all, do you know what is the meaning of corporate? In fact, corporate means company only. There we are going to discuss what is company accounting, how companies will maintain their books of accounts as per section number 128, subsection 1 and 2 of Companies Act 2013. And third chapter, accounting standards. I think some of you might aware of this concept, some might not. No problem at all. See, every company has to prepare their books of accounts, right? So for maintaining books of accounts, they need to follow some standards. Or if there is no such kind of standards, everybody will prepare their own methods. That is not at all accepted. To maintain uniformity, to compare all those companies, so we need to follow some standards. There are some accounting standards. We have different standards over there. AS 1, 2, 3, 4, 10 number of standards. Actually, in practical life, we have accounting standards and Indian accounting standards. We are going to discuss all those in a third chapter called accounting standards. Fourth chapter, accounting for share capital. Share capital is a beautiful concept in a company. If you are aware of it, no problem, otherwise also no problem. So how companies will issue shares, what is IPO, what is generally in our news, we are regularly see some green marks in news, sometimes red marks in news, some bull and some bear is there. What is all those things, how companies will issue shares, what is primary market, what is secondary market, how generally people will trade in share market, how people lose the money, how people earn the money. If company issues shares, what is the accounting treatment in the books of company, all these details, what is SEBI, what is IPO, what is FPO, what is what you call RSCs, all those things we will discuss in this chapter. What is that? Accounting for share capital chapter. Next one, accounting for debentures. So debentures is a kind of debt loan to the company. They are also similar to shares, but they are not exactly same. So there we are going to discuss about accounting for debentures. How when company issues debentures, what is accounting treatment in the books of company, and how they will pay interest to the debenture holders. All those things we are going to discuss in this chapter. Next one, related aspects of company accounts. Some more things which are apart from these two we are going to discuss in this chapter. There may be definitely there are some n number of things in company accounts. So here there are two separate chapters for share capital and debentures. Remaining aspects we are going to discuss in the sixth chapter, nothing but related aspects of company accounts. Seventh one, consolidation of accounts. Very beautiful chapter it is, and very important chapter as well. This is very beautiful and important chapter. Consolidation of accounts means if you take Reliance company has n number of subsidiary companies. Reliance Fresh is there, Jio is there, Telecom is there, n number of subsidiaries are there. But the main company is RIL, Reliance Industries Limited is the main parent company. It has almost 100 plus subsidiaries. So as a parent company has to prepare their own statement and they have to prepare one more aggregate statement which covers entire subsidiaries and principal accounts. They are called consolidation of accounts. How they have to add all those things will cover in this chapter. And next one, financial statement analysis. This chapter is how to we analyze financial statements. First of all, do you know what is the meaning of financial statements? It means it covers balance sheet, P&L, cash flow, statement of changes in equity, notes. How we have to analyze it, we are going to learn in this chapter, financial statement analysis. Ninth one, cash flows, nothing but cash flow statement. How cash is inflow to the business entity, how cash is outflow from the business entity, all we are going to discuss in cash flow statement chapter. 10th one, forecasting of financial statements. Forecasting means we have to predict future. So how we have to forecast or predict our future financial statements we are going to learn in this last chapter. So if you observe, each chapter has their unique speciality. So it is not that much preferable or correct to ignore any chapter. Use your common sense. If any chapter is unimportant, why ICSA board include in the syllabus? If they included means the chapter is important for you guys. So please don't skip any chapter. Okay. Even for me also, for teaching each and every chapter is important. Of course, for me first two chapters are not that much important because they are intros. From 3rd to 10th, each and every chapter is important. But for understanding 3 to 10 chapters, first two chapters plays a crucial role because they are fundamentals, they are basics. So, we are going to start Introduction to Accounting as a first chapter in our paper number 4 in our group 1 by tomorrow onwards. Okay, from tomorrow onwards. And once these 10 chapters are completed, we'll move on to financial management subject, part 2 of our paper. There again we have 9 chapters. First chapter is introduction. Here we are going to learn what is financial management subject is, how it will help us in our practical life. Second one, time value of money. So of course time has some value. For example, when I was student, when I was in your place, when I was studying for CMA or CA or CS foundation level, my hostel fees was around 2,400 rupees, that too in a place called Vizag. I was some days in Chennai as well. During my articleship tenure, my hostel fees was around 3 to 4,000. Now tell me what is hostel fees? It is around 7 or 8k. So why? Because there is time gap. For time, obviously some inflation is there. Inflation means every cost will be increased. So how, for example, especially if you take your parent generation, for them 10,000 rupees is very huge amount. Now 10,000 is nothing. One person monthly expenditure, or else some people weekly expenditure. That because time gap. For time there is some value. So how that value we have to find out, all the things we are going to discuss in this chapter. Next one, capital budgeting. So this is also very important chapter in financial management subject. So in this chapter we are going to learn how much we should take what you call how our capital would be, what is NPV. That means if you take one new project, whether we should accept or reject, all the things we are going to discuss in capital budgeting, especially NPV, payback period, all those things. For example, if you take up a new project, is it feasible to accept or not? Or if you want to purchase a machine, is it feasible or not? For example, we started a business organization in a Chennai, so we need some asset. For example, we need some generator for electricity supply. There are two options. You can directly purchase that asset, or else you can go for lease. Is it better to go for buy or lease? Buy or lease will be decided by this concept capital budgeting. Next one, fourth chapter, cost of capital. Cost of capital in this chapter, definitely whenever a business entity started a business, whenever we are going to start a business, we need a capital. Capital is we need a investment, nothing but capital. So capital we may directly get it from either shares, or else we may get it from debt. That means own funds or debt funds or loan. For every, if you take any company, if it is Reliance company or a Tata company or else HUL company, if you take any company, each and every company definitely they will have some share capital, some debt. That means they will have some loans. For example, Reliance company is there. Out of their total capital, they are maintaining 60% equity, 40% debt. That means out of their each and every 100 rupees, 60 is their owners, 40 rupees is from loans or debts. So that is their choice, their discretion. But which ratio is better? How much debt is better? How much equity is better? Out of total capital, how much should be debt? How much should be equity? All this we are going to discuss in this chapter called cost of capital. Next chapter, capital structure. Actually, in cost of capital, we are going to learn for starting a company how much cost it would be. Definitely, I will take some amount from the debt, some amount from the capital. If I take some from debt, some from capital, what is the total cost? That's what we are going to discuss in cost of capital. In capital structure, we are going to learn how much debt we should maintain, how much equity should maintain. Both are looks alike. In fourth chapter, we are going to learn what is my cost. In fifth chapter, how much debt, how much equity. In sixth chapter, we are going to learn about dividend decisions. I think you know some people are already aware of dividend. So if you are unaware of, we are going to learn in detail in this chapter. And seventh chapter, working capital management. And this chapter is also very interesting and very practical related subject. Working capital means very easy concept. For example, you bought some car, you bought some bench car, value of some 50 or 60 lakhs. So you purchased a car with the amount of 60 lakh rupees, but you don't have 500 rupees to fill petrol in that car. So what is the use with that 60 lakh rupees car? So purchasing car is easy, but every month filling fuel is difficulty. So purchasing a car is not a big deal. Everybody can purchase car with EMI. With 1 lakh or 2 lakh down payment, you can purchase a car. But you have to maintain fuel and you have to repay that EMS. That is biggest thing. So maintaining fuel is called working capital. Working for running business, we need some amount of funds. That is working capital. How we have to manage our working capital, we are going to discuss in chapter number 7, nothing but working capital management. And next chapter is security analysis, where we are going to discuss about how shares and how debentures, all those things. And last chapter is operational approach to financial decision. There we are going to discuss something which is bigger than what we learned in the previous chapter. If you observe, each and every chapter has some unique feature. Okay? Yeah. So today we covered just total content of this subject and what are the chapters in this subject. So before winding up, let me summarize the entire content. Actually, I have a habit that every day before winding, I am going to revise entire concept whatever I covered on that day. And next day as well, I am going to revise entire content what I covered in the previous day. So why I do all those things means that only for the benefit of the student. If I revise entire content, for example, that means I am repeat. I am telling the concept, same concept 3 times. One is in my regular class, second one is at the end of class, third one is in beginning of next class. Okay. So today's summary is, so we have started with intro of our paper number 4. Paper number 4 is under group 1. So subject name is CAFM, nothing but corporate accounting and financial management. So in paper number 4 we have 2 parts. Part number 1 is corporate accounting, part 2 is financial management. Part 1 is consists of 60% of weightage, nothing but 60 marks. Part 2 40 marks. In corporate accounting we are going to learn 10 chapters. First one is introduction to accounting, second one is introduction to corporate accounting, third one is accounting standards, fourth one is accounting for share capital, fifth one is accounting for debentures, sixth one is related aspects of company accounts, seventh one is consolidation of accounts, eighth one is financial statement analysis, ninth one is cash flows, tenth one is forecasting financial statements. And the same manner in audit has been, in FM we have another 9 chapters. Number 1 introduction, number 2 time value of money, number 3 capital budgeting, number 4 cost of capital, number 5 capital structure, number 6 dividend decisions, number 7 working capital management, number 8 security analysis, number 9 operational approach to financial decisions. If you observe our point very clearly, in our class I revised, I repeated entire chapter names at least 4 to 5 times. The reason is very clear. Just I want to inculcate in your brain all the chapter names. Whenever I start this chapter, for example, in future, I will start a chapter called cash flow. You should not feel that as a new chapter. You should feel like already I knew this chapter because already discussed this chapter name in introduction class. That is the reason I repeated all those names at least 4 to 5 times. And after this discussion, we had a discussion of why each chapter is. For example, why introduction to accounting, why corporate accounting, all those things are. Okay, so this is for the first class, and I will tell you a few more things which is the requirements of mine. First one is I need consistency, please maintain it. Second one is please maintain a good running notes, better maintain rule book. Number 3, please revise the class by next class. Before starting next class, you should revise the entire class. Point number 4, if you have any doubts, if it is very small doubt also, don't feel bad, feel free to ask me. You can directly message me through Telegram or else WhatsApp. Okay, so if our team created any group, no problem. Otherwise, you can just save my number. You can just text me through Telegram or whatever it is. My number is 789392671. Okay, yeah. If there is any Telegram group or else WhatsApp group, I will join there. We can share our doubts or whatever it is. It's okay for me. My point is very clear. Every one of my student will get satisfied and they will get justified. Not even single student feel sad after following my lectures. So as a team BCCA, we are very much confident on CS executive course. So we are going to rock this batch. So especially if you ask me personally, I'm damn confident on this match because almost corporate accounting is I know how to deal with it in the same way financial management as well. Okay, so this is all for today, and from tomorrow onwards we are going to start accounting basics chapter nothing but I am going to start corporate accounting chapter number 1. Okay now? Yeah. So already I told you I need only few requirements. What are those requirements? I need consistency. Second one, maintain a good notebook. Third one, what is the third point? You have to revise all the content before starting the next class. Fourth one, if you have any doubts, feel free to ask me. Okay. So this is for today. We'll meet tomorrow in the same time and same session. Yeah. Very good afternoon to all of you. So, welcome to day 2 of our session, which is obviously recording on in the check it once. Yeah. So, welcome to day 2. So, in day 1, we discussed what is the total syllabus of your CS executive course and how many groups are there. Out of 2 groups, what is R paper? So R paper is paper number 4 of group 1, nothing but corporate accounting and financial management subject. And in that session we discussed what are the chapters which are going to cover in our syllabus. If you remember, there are 10 chapters in corporate accounting and 9 chapters in financial management subject. So at the same time, in previous session, we have covered what is the prominence of each and every chapter in corporate accounting and financial management as well. So already we agreed that so we'll start first with corporate accounting. Once corporate accounting is completed, then we'll move on to auditing part. Okay, coming to corporate accounting part, so let me begin first chapter, introduction to accounting. So this introduction to accounting is same for all the students across all professional courses. If you are a CA student or CMA or CS, all basics and fundamentals are same. So anyway, as of now our course is CS executive, so let's ignore about all remaining professional courses, but coming to fundamentals, everything is same for all those people. Okay, fine. So introduction to accounting, that's what we have to begin from today onwards. Yeah. Let me begin chapter 1 of CA and FM, especially corporate accounting basics. Yeah. Generally, why accounting is important? Rather than important, why students should read accounting subject? For example, in our academic life from past 18 or 19 years, so we have learned so many subjects. For example, mathematics is there, English, Hindi, science, social studies. This number of subjects we have learned in our academic career. If you take mathematics as an example, for example, you went to a shop and you bought a 10 rupees pen and you have given 20 rupees to that vendor. Tell me how much amount he has to repay or refund to you. How much amount you will get back? 10 rupees. If you given 20 rupees note, the pen cost is 10 rupees, you will get 10 rupees back. How do you got that 10 rupees? 20 minus 10 equals to 10 rupees. So how you got that 10 rupees? It is because of mathematics. For example, in your villages or else in your houses, your grandmother or grandfather, if they are illiterates, sometimes they will give you money to count that amount. Why? Because they don't know mathematics. So this is how the subject called mathematics will help in our regular life. For example, if you feel little bit of unhealthy or sick, you have to take some medicine. For example, if you are feeling some amount of feverish, you may take some Dolo or else paracetamol, whatever it is. So how do you know that is because of those signs? So you are forecasting some weather, or else you are what you call visiting some place, and where the weather, how all those things will be depend upon another subject. So each, for example, you are shifted to some UK or US. There, to communicate with the people in that country, you have to use English, no other option with you. If you are going to north states of India, where generally they'll use Hindi as their primary language, there you have to use your Hindi. So that's how Hindi will help you. That means out of entire subjects, each and every subject will be helpful to you in your regular life at some point of time. My question to you is, my direct question to you is, then in what way accounting is relevant for us? In which way the subject called accounting will help you out in our regular life? Why students should read accounting subject? What is the reason? Why should he read, or why should he learn? Accounting subject is designed for the business organization, not for the common people. So that is the reason for a common people just like you and me, or else for your father or else your mother, even though they are not aware of accounting subject at all, but they are running their life successfully. If you take one doctor or else one engineer, they don't know accounts, but they are leading their life successfully. In fact, better than us. So, then why this subject is? Then why accounting subject is? Very clear. The accounting subject has been designed only for the business organization, not for the common people. The subject is not for you and me. The subject is only for the business organization. The subject has designed only for the particular set of community. That community is business community. That means accounting subject is not at all important for the people other than relevant to the business. The subject has been designed only for the benefit of the business organization. In fact, if there is no concept of business in our Indian economy, then there is no point to learn accounting subject. That means the main roots of accounting subject is business. If there is no business, no need to discuss about accounting subject. So that is how the main roots of accounting is business. That means before studying about accounting subject, or before going to introduction to accounting subject, we should learn about term called business. So I think everybody of you aware of what is the meaning of business. What is the meaning of business generally? People will invest their money in particular operations, and they will use that money, and they may sell goods or they may render services. So they'll invest some amount of money and they'll expect some return from that investment. This is all called business. For example, you can observe a small shop nearby your home. At the same time, you can observe D-Mart in your town. You can observe Reliance Industries Limited in nearby city. That means if you take a small tea shop or coffee shop, the small coffee shop is also business organization. A shop nearby your home is also business organization. At the same time, D-Mart is also business organization. Reliance is also business organization. What is the difference among all these entities? What is the difference between coffee shop and that particular Reliance Industries Limited. What is the difference between coffee shop and demot entity? And what is the difference between what you call shop nearby your home and Reliance Industries Limited? Every one of them are simply doing their own way of business. If you observe all those four people, their agenda is same. That means everybody has invested some amount of money in their business. Maybe if you compare in numbers, that numbers may be little bit more or higher, depend upon person to person. The investment of the shop nearby your home may be less when compared to investment of the coffee shop. Investment of that coffee shop owner is less than investment of the demot or Reliance. Even though if investment is less or more, all those four people's agenda or objective is very clear. Everybody generally do their business with the two objectives. Objective number one is to earn more profits. Number two is to earn more wealth. Wealth means assets. These two are the objectives. Next one, sole proprietorship. Sole proprietorship means single person is owner. So before that we have to discuss types of businesses. So just now we covered what is the meaning of business. So we have covered four examples. Not only these four fellows, if you take any business entity, if that is coffee shop or else Reliance Industries Limited, if you take tea shop or Tata Industries Limited, if you take HUL or else any small shopkeeper, if you take any business organization, that business entity may be in three forms. First one, sole proprietorship. Second one, partnership. Third one, company. These three are forms of business or types of business ways. What are those three? Sole proprietorship, partnership and company. So what is the meaning of sole proprietorship? Here, sole proprietorship means single person is owner. If he get profit, he will enjoy it. If he get loss, he will suffer from that loss. Second category, partnership. Partnership means two or more people, they will run business together. If they got profit or loss, they will share in their agreed ratio. Third one is company. Company is altogether different. We will discuss the same thing in next chapter called Introduction to Company Accounts. So, for example, let me discuss these things in deeper sense. First one, sole proprietorship. Sole proprietorship means there is only single person as a owner. For example, I started a business with my own capital. So, for example, I started some business which is relevant to some software or whatever it is. So, in first year, I got a profit of 10 lakh rupees. So, the 10 lakh profit should be enjoyed by me only because I am the only owner. Sole means single, proprietor means owner. That's why we call it as a single owner. So, we can write single person is owner. If I got 10 lakhs profit in first year, I can enjoy the 10 lakh profit. If I got 10 lakh loss in first year, again same, I have to bear the 10 lakh loss. Nobody will help you out. Second category, partnership. For example, I think Meenakshi is there, right? So, myself, Varma and Meenakshi, we both started a business, for example, in a partnership. Okay? So obviously, I'm very kind-hearted person and I'm very honest person. So we both started a business in the form of partnership. In first year, we got 10 lakh rupees profit. So, I'm very kind-hearted person, obviously. So I will take out of 10 lakh profit, I will take 9,99,999 rupees. So definitely one more partner is there, Meenakshi. She will get whatever the balance amount is there, whatever it is. Okay, yeah, I will give the entire amount, the balance amount to Meenakshi. Okay, now how much balance? 1 rupee, right? Yeah. In second year, what happened? This time we got 10 lakh rupees loss. Now this time also I'm very much kind-hearted person. No, this time again same. First I will give that out of 10 lakh rupees loss, I will give 9,99,999 rupees to Meenakshi, and the entire balance loss I will take care of that entire balance. However it is, how much? 1 rupee only. You can observe, no, at the time of profit I have given more, loss I have given more. This is just an example, but in practicality there is an agreement between the partners how to share those profits and losses. Okay, about company we'll discuss in the next chapter. Okay, yeah. So now tell me, what is the meaning of sole proprietorship? Here sole means single, proprietorship means owner. So sole proprietorship means a single person is owner. He will enjoy or suffer profits and losses. Second category, partnership. Partnership means two or more persons as a owners. They will share profits and losses. Next one, about company, we'll discuss about it later. So please copy this particular topic on your notebook. I will wait for 2 minutes.
అవును మేడం, ఇక్కడ రాలేదు మేడం. మేడం ఓకే మేడం. ఓకే ఓకే అప్లోడ్ చేస్తాను. మేడం అవును. సరే మేడం. సరే మేడం, ఒకసారి ఆ స్టూడెంట్ నెంబర్ నాకు పెట్టండి మేడం. నేను ఇక్కడ క్లాస్ స్టార్ట్ అయ్యేటప్పుడు నేను కాల్ చేసి చెప్తాను లేదండి. ఓకే మేడం. అవునా, ఓకే ఓకే మేడం. సరే మేడం. సరే మేడం, సరే సరే. ఓకే ఓకే మేడం. సరే మేడం. ఓకే థ్యాంక్ యూ.
ఏమంటారు?
ఇంకా క్లాస్ జరగలేదు అనుకుని స్టూడెంట్ కాల్ చేసినండి. జరుగుతుంది, మీరు కంటిన్యూ చేద్దాం కదా. కంటిన్యూ చేసింది మేడం. జాయిన్ అవుతుంది.
Okay, it's done now. Yeah. So what is sole proprietorship? What is partnership? Already we covered. Sole proprietorship means single person is owner. He will enjoy or suffer profits and losses. So please copy it with respect to sole proprietorship. And then coming to partnership, two or more persons as a partner, they will share profits and losses. Okay, yeah, if it is completed, then I will move on to some important terminology is there in accounting subject. So there are some 10 terms are there in accounting subject. Each and every person should understand and should listen these 10 terms. So without understanding or knowing these 10 terms, so that is not at all possible to understand the subject of accounting. Though this 10 terminology is damn important. So if your notes is completed up to partnership, then I'll move on to that important terminology. Okay? Yeah. I think your notes is done, right? Fine. So coming to 10 important terminology, we have 10 important terms in respect to accounting subject. So if I am not wrong, your notes is done with respect to these two things, which is meaning of proprietorship and partnership. Yeah. Otherwise, you can go to the live once more and just copy the notes with whatever is discussed. So listen carefully. So in our accounting subject, there are 10 important basic terms are there. Without understanding those 10 basic terms, it is highly impossible to understanding the total accounting subject. Of course, out of this 10 what you call terminology, maybe you have listened or at least listened at least twice or thrice in your regular life, or else if you are comes from CA or CMA, at least you are aware of these terms. But here, knowing is different from understanding. Just knowing these terms is not at all enough for our examination, especially for CS executive exam. Try to understand these 10 terms. For example, the first word is goods. Sir, I know what is the meaning of goods. That is not at all enough. Try to understand the total what is the goods means. Assets, you know the what is asset, but try to understand in deeper. So let's understand these 10 terms, 10 important terms in accounting subject. First one, goods. Second one, assets. Third one, purchases. Fourth one, sales. Fifth one, debtors. Sixth one, creditors. Seventh one, expenses. Eighth one, incomes. Ninth one, capital. 10th one, drawings. These all 10 words we are going to discuss right now. Okay? So, first term is goods. Just now we covered in the beginning of this session what is the purpose of accounting subject. Why accounting subject is, that's already we covered at the beginning of this session. Tell me why accounting subject is. Accounting subject is designed not for the common people, it's designed for the business organizations. Again, business are three types, that's what we covered in this session itself: sole proprietorship, partnership and company. Sole proprietorship means single person as owner. Partnership means two or more persons as owner. We'll discuss more about company in next chapter called Introduction to Company Accounts or Corporate Accounts. And we covered what is the meaning of these two. Now we are moving on to important terms. First one is goods. So, goods means generally businesses are two types. One is they will deal with goods. Second one is they will deal with services. For example, BCCA is there. So BCCA is not purchasing and selling goods. We are here to provide services. We are covered under the second category. DMart is there. DMart is not providing any kind of services. Or Reliance is there. Reliance, Smart or Fresh Points are there. They will not provide any services to you. They will dealing with goods. So here, two types of businesses are there. Let us ignore about service sector some point of time. So let's focus on the business entities who are dealing with goods. First of all, what is the meaning of goods? Very easy. For example, I have started a business. I am purchasing and selling these water bottles. So for me, this water bottle is good. That means the product or article which is regularly purchasing and selling is called goods. For example, I am in a business of I will purchase mobile phones and I will sell the mobile phones, and that is my business. So for me, this mobile will be called as goods. That means whatever the product or services whichever you are generally using for purchasing and selling is called good. For example, if I am purchasing and selling some what you call, if I am purchasing and selling some notebooks or else pens, for me those notebooks and pens are called as goods. So whenever, if you wait for 1 minute please. Yeah, fine. So from tomorrow onwards, our team will let you know whenever the class started, no issue. So, listen. Goods means the product which is regularly we are selling and purchasing. For example, if you take, for example, if I am starting a business, my business is I will purchase and sell mobile phones. For me, mobile phone is good. If I purchase and sells laptops, laptops will be called as goods. If I purchase and sells iPads, iPad is called as goods. Simply I can say, whatever the product or article which is being traded, nothing but whatever the product or article which is regularly you are purchasing and selling is called goods. So that's what we can say. Article or product which is being traded. Here traded means purchasing and selling. Sometimes no need to purchase. Some people may manufacture and sell it. For example, a bakery is there. They will manufacture the particular products and they will sell it. Those will be called as a goods. Whatever you are selling generally is called goods. For example, if you go to Reliance or D-Mart, such kind of stores, you can observe n number of items there for sale only. All those things are called goods. Goods means whatever they are regularly selling to the customers. Second one, assets. So assets means they are also within the business organization only. But the real point is they are not for sale. First of all, that's what you have to understand. Goods are for sale, assets are not for sale. They will use that asset. That means business will use that asset for generating future economic benefits. Future economic means financial benefits. For example, if you take this classroom as an example, in this classroom we have three air conditioners and three TVs as well as furniture is there. Let me discuss one by one. So in this classroom, two TVs are there. So what is the purpose of the TV? Is it available for sale? No, they are here for using. That means I'll use those two TVs for giving classes to you. So whenever you are listening classes by using the TVs, you will pay fees to me. If your batch is completed, what will happen? Your juniors will come. I will use the same TVs for even them also. If they reveal, one more person will come. Again, I will use same TV for them also. That means I am going to use same kind of assets for future students also. I am generating future profits as well with the same TV. For example, here I have some camera is there in front of me. So I use this camera. A camera is here, not for sale. Why I am using this camera? I am using this camera for recording my classes. By recording these classes, I will sell these classes in future. I will get revenue from these classes. That means I am using this same camera for your batch and for your next batch as well. So, for example, furniture is there. You are using the tables, benches, whatever it is. So, for you are using that furniture. If your batch is completed, your juniors will come and they will listen those classes. That means I am using the same furniture for future students also, and I will get the revenue. Simply I can say asset means it is a resource which entity will use or used by the entity. Entity means a business organization. Again, business may be in three forms. What are those three forms? It might be sole proprietorship or partnership or company. So even though if it is a sole proprietorship or partnership or company, asset means it is used by the entity which means that resource generates future economic benefits. In future, we will get economic is nothing but financial benefits. That resource is called asset. In this classroom, we have different assets. For example, you can observe AC is asset, TV is asset, camera is asset, laptop is asset, my iPad is asset. All are comes under asset category. If anybody, for example, if layman is asking you what is the difference between goods and assets, you can say in single sentence. If they ask you in single sentence, what can you say? Very easy. Goods are for sale, assets are not for sale. Assets will be used by the entity. Goods are not for use, they are for sale. Are you getting my point? So definitely you should understand the difference between goods and assets. Goods means for sale, assets means not for sale. Again, I think you know this concept, but still anyway I have to revise because I have to cover all the fundamentals. So even though you know, just listen, no problem at all. So again, assets are divided into two categories: tangible assets, intangible assets. Generally, whenever I started this concept, my habit is I will ask a question for every batch. What is the meaning of tangible assets? Majority students will say tangible assets means which can be seen and touched. Intangible assets means which cannot be seen and touched. That is not at all correct definition. If you give the same answer in your interviews, definitely they will not accept your answer. Tangible assets means assets which have physical existence and which can be seen and touched. This sentence will be more important. Assets which have physical existence and which can be seen and touched. Without physical existence, we can't call one asset as a tangible asset. So, physical existence should be there to call it as a tangible asset. And now, tell me what is the definition of tangible asset? Tangible assets means asset which have physical existence and which can be seen and touched. Now have a look how beautiful the definition is. If you say which can be seen and touched, that is not look professional. Please add that sentence as well. Tangible asset means asset which have physical existence and which can be seen and touched. Opposite, what is intangible assets? Assets which does not have physical existence and which cannot be seen and touched. Examples for tangible assets are whatever you can see and touch: land, building, machinery, furniture, vehicles. All these are examples for tangible assets. What are intangible assets examples? Like brands, logos, trademarks, copyrights, patents, goodwill, etc. These are examples for assets. Clear? Intangible assets. Clear? So we have covered two important terms out of 10 terms. What is the first term we have covered? Goods. Second term, assets. In assets, again two types: tangible assets, intangible assets. What is the meaning of tangible assets? Tangible assets means assets which have physical existence and which can be seen and touched. Example: land, building, machinery, furniture, vehicles. Coming to other category, intangible assets. Intangible assets means asset which does not have physical existence and which can't be seen and touched. We can't see and we can't touch all those intangible assets. Examples are brands, logos, trademarks, copyrights, patents, goodwill. So the third term is purchases. I think you know what is the meaning of purchases. There is nothing to discuss more about purchases. Purchases means we have to buy goods from our supplier and we will use the same for selling to others, our customers. So again, purchases are divided into two categories: cash purchases, credit purchases. Cash purchases means we will purchase the goods and we will pay the cash immediately. Goods purchased and cash payment settled immediately, that is called cash purchases. Cash purchases means settlement of cash immediately. There is no delay in settlement of cash. For example, I went to coffee shop or else a coffee shop only. I think you are the coffee shop owner. I am supplier of coffee powder. I am supplying coffee powder to you. Now think in your point of view. For example, you are running some coffee shop. So I am your supplier. So I am sending coffee powder to you and you paid immediately cash of that coffee powder. Then your perspective, that is purchase, not sales, because you bought from me. That is purchases. Now the point is it cash or credit purchases? Cash purchases only. Why cash purchases? You purchased the goods and you paid immediately. Are you getting my point? For example, Meenakshi is running a business. She is a sole proprietor. So she needs some raw material and she bought from me and she paid immediately cash. So Meenakshi definitely purchased some good, that is called purchases. But the point is it cash or credit purchases? If she pay money, that is called cash purchases, otherwise that is called credit purchases. So for example, Meenakshi purchased goods from me, but she told me that, sir, I don't have money right now, I will pay your money after 2 months. Even though if she has not given money to me, she purchased goods from me. But what is the different thing? She will pay amount in future after 2 months or 3 months. That is the agreement between me and Meenakshi. So listen, if cash payment is settled immediately, that is called cash purchases. Otherwise, that is called credit purchases. Same vice versa, sales. Here also same. Sales means goods sold. If we receive cash immediately, that is called cash sales. Otherwise, that is called credit sales. For example, Meenakshi selling goods. For example, Meenakshi is doing a business of some iPads. So she is an iPad dealer. She is purchasing iPads and she will sell the iPad to the customers. So she is running business successfully. And I approached Meenakshi, ma'am, I need one iPad. So definitely, sir. So then she sold one iPad to me. The cost is 72,000. That means in thinking her point of view, is it purchases or sales? Sales only. But I have not given entire money to Meenakshi. I told her, ma'am, I will pay that money after 1 month. And she said, okay sir, no issue, you can pay after 1 month. Now think in her point of view, is it sale or not? Obviously sales only. What is the difference? But she is not getting any cash. That means that is called credit sales. Credit sales means we are selling goods but we will receive money at future. So cash sale, credit sale. Next one, debtors. Debtors means again same example. Let's continue same example. Here Meenakshi sold iPad to me, but I have not given money. I said I will pay amount after 1 month. She said yes, okay sir, no problem. Now think in business point of view. In business point of view, business has sold 73,000 rupees value of goods to Varma. So definitely, if you think in business point of view, 17,000 is receivable from Varma. So whatever receivable from some person, that person is called as a debtor. Debtor means receivable. Receivable means right. Right means assets. A thumb rule is there. Remember, my dear students, in accounting subject, rights or assets, obligations or liabilities. Rights means that you can choose or you may not, you may or may not. Obligations are issued. Obligations or liabilities, rights or assets. Here, what is the right of Meenakshi? She can take 73,000 rupees cash from Varma. So that is her right. Right means asset. So in business of Meenakshi, she will write 73,000 receivable from Varma sir. That Varma sir is called debtor. I have given an example. Goods sold to Mr. Kumar, value of 80,000 on credit. That means business has sold some goods to Kumar, value of 80,000 on credit. Now think in business point of view. On credit means they are not paying cash immediately. That means we are not receiving cash immediately, even though we sold goods to Kumar. That means in Kumar point of view, in business point of view, Mr. from Kumar amount is receivable. So if we are selling goods to Kumar on credit, we can receive 80,000 rupees from Kumar in future. Future means that might be after 1 month or after 2 months. That Kumar is called as debtor. So whatever receivable from any person, that person will be called as a debtor. For example, I am running a business. I sold goods to X, Y and Z on credit. That means all these three people will pay amount in future. This X, Y and Z will be called as debtors. Nothing but receivables. Next one, opposite sense, creditors. Creditors means here reverse. Goods purchased from someone on credit, but we have not paid any amount towards it. So we purchased goods, for example, I purchased goods from X, but I have not paid cash. I told to X that I will pay after 1 month. So when you are selling goods to X on credit, X will be called as a debtor. If you are purchasing goods from someone on credit, that supplier will be called as a creditor. That means at the time of selling, you have to call him as a debtor. At the time of purchase, we have to call him as a creditor. Okay? Yeah. Now try to understand difference between debtor and creditor. For example, if I am running a business, I sold goods to you on credit. That means amount is receivable from you. Then you will be called as debtor. If I purchased goods from you on credit, then you will be called as creditor. Debtor means receivable, creditors means payable. Debtors or assets, payables or liabilities. Why assets, why liabilities? Debtors means receivable. Receivable means rights or assets. Payable means obligation. Obligations are nothing but liabilities. And one more point you should remember in your accounting life. You should not ignore this point. If you want to write correct journal entry, or if you want to understand accounting subject in 100% accuracy, definitely you should follow this thumb rule. What is that thumb rule? If you want to prepare any business entity accounting, if that is sole proprietorship or partnership or LLP or company or any kind of business entity, if you want to prepare accounts of that entity, definitely you should think in business point of view, not in any other person point of view, even not in owner point of view. You should always think in business point of view. In fact, business is different from owner. That concept is called business entity concept. If you follow this concept, then only accounting subject will be more easier to understand. Don't think in owner point of view. For example, X is there. He has started a business with amount of 50 lakh rupees. X is a new startup. He is a new entrepreneur. So he has started business with 50 lakh rupees cash. What is the journal entry? How people generally will think X is investing, that is capital, that is okay, fine. But they don't know why they are writing all those things. Very easy, sir. If you want to write any journal entry, you should think owner is different, business is different. Think in business point of view, not in owner point of view. If you think in owner point of view, it is like cash is giving. If you think in business point of view, you are receiving cash. There are two different perspectives. You should always think business point of view, not in owner point of view. Business is different from owner. Business is different from owner. So, if you take in owner point of view, if your answer is 100% wrong exactly, always you should think in business point of view. Okay? We will discuss the same concept in detail in further concepts. So, right now, let's focus on what is the difference between debtor and creditors. So, debtors means when you sold goods to one party on credit, that he is called debtor. Yeah, very good morning to all of you. So, we are discussing basic terms and next word is capital. And first of all, I know that everything, whatever I am discussing right now, I think you have learned somewhere else. But this is the time to just recollect all those things, nothing more than that. Okay? Yeah. So, capital. Capital means it is the investment of the owner. If any person wants to start a business, definitely they need some investment. Whatever they are investing in business entity is called capital. Actually, generally students there is a wrong notion that capital means only in cash. That is 100% not at all correct. Capital may be in the form of cash, sometimes it may be in the form of assets, sometimes it may be in the form of goods. So it may be cash, goods or assets. Last one, drawings. Drawings means, for example, I invested 10 lakh rupees in a business and after a couple of months, due to my personal urgency, I need some 2 lakh rupees cash. So I withdraw from my business for my personal use. That is called drawings. Drawings means if amount withdrawn by the owner for personal use. Actually, here also same thing. Here drawings means not only cash. Sometimes it may be goods or else assets as well. Okay, so similar to capital, assets drawings is also maybe in three types, that might be in asset form or else cash form or else goods form. These terms are very basic terms before we are introducing our CA and FM paper. So after that, I will discuss very well-known area which is accounting process. I think all of you know this concept. What is the accounting process? It starts with a journal, after that ledger, trial balance, profit and loss account and balance sheet. So you know that I don't want to drag this concept more and more, but here I want to discuss something more rather than what you are aware of it. So the first step is journal. See, in journal, actually it is a book. There we record all accounting transactions. So whatever happened in a particular day, we will record whenever it is happened. But everybody, I am damn confident, everybody, whoever watching this video or whoever watching this recorded classes, you know journal entries. But the point is, generally, the main mistake generally a student community generally they used to do is they'll muck up the journal entries. That is not really a correct way. For example, in your school level, especially in mathematics, there is one well-known formula. A plus b whole square equals to a square plus 2ab plus b square. That is a formula, and after that formula, you will have some 5 to 6 questions on that formula. Out of the 6 questions, they will ask 1 or 2 questions in the main exam, you will write it. If they change the numbers, students will feel that is out of syllabus question. That's how our students are. But that is not correct. You have to understand the concept clarity. You have to be very clear with respect to concept. Here also same. Journal entries are very easy if you understood the concept and if you have some amount of common sense. So for me, if you ask me, sir, what is the trick to give journal entries without taking time? Very easy. You should have some amount of knowledge, that should be conceptual clarity. Second one, you should maintain or you should have some common sense and practicality. Those are enough. For example, cash received from Mr. Ramu, value of 70,000. This is the transaction. What is the journal entry? Everybody will say cash account debit to Ramu. That is okay, fine. But by how to write journal entries, it is depend upon we have some golden rules. So what are the golden rules? Actually, we have 3 rules of accounting which are called golden rules of accounting. Rule number 1 says debit the receiver and credit the giver. Rule number 2, debit what comes in, credit what goes out. Rule number 3, debit all expenses and losses, credit all incomes and gains. So everybody will tell all these 3 rules without taking even 1 second gap. But the problem is giving answers is very easy and understanding the concept is difficult. So please try to understand the concept rather than answers. So here, rule 1 is that debit the receiver, credit the giver. So what is the meaning of it? Try to understand. That means they are clearly telling us if that person is receiver, debit him. If the person is giver, credit him. So how can I find out whether that person is receiver or giver? That's it. That is the point. So actually, whenever you want to prepare accounting of any entity, you should be sit in the place of business organization. Actually, there is a concept called business entity concept. This concept says business is different from owner. If you want to prepare accounting or if you want to write a journal entry, you should sit in the place of business organization. You should think owner as a different person, as a third party. Otherwise, you can't prepare correct journal entries or you can't record correct journal entries. So if you sit in the business place, what is happening here? You are receiving money from someone. That means you have to think what is the status of that person. Does he comes under receiver or giver? And vice versa. So, if that person is receiver, debit him. If that person is giver, credit him. Okay? Rule number 2. Debit what comes in, credit what goes out. Whatever comes into your business entity, just debit it. Whatever going out from your business, credit it. Sir, what comes in, what credit out, sir? Very easy. For example, I paid salary or else we paid rent. What happened? So rent is paid from our pocket, cash is going out. For example, salary is paid. What happened? So salaries has been paid means cash paid to employees. That means my cash outflows here. That means my cash is going out. So what goes out? Here cash goes out. For example, or else goods sold for cash. I received cash. What comes in? Cash comes in. TV purchased, TV comes in. AC purchased, AC comes in. Whatever coming into your business organization, debit it. Tell me, if you purchase a TV, what is comes in? TV comes in. If you purchase AC, what comes in? AC. If you sold a TV, what is going out? TV is going out. Instead of cash is comes in. That's it. Rule number 3: debit all expenses and losses, credit all incomes and gains. Okay. So that means if any expenditure is there, you have to debit it. If any income is there, you have to credit it. If any loss is there, debit it. Any gain is there, credit it. That's what these 3 golden rules will discuss. What are those 3 golden rules? Rule number 1, debit the receipt, credit the giver. Rule number 2, debit what comes in, credit what goes out. Rule number 3, debit all expenses and losses, credit all incomes and gains. So let's solve few journal entries, then it will be okay, fine. Actually, I know that you may feel, sir, I know journal entries very well. Why you are discussing all these entries? Actually, this is a form part of your syllabus. That's why I am discussing it. Okay. Yeah. Cash received from Mr. Ram, value of 70,000. What is the journal entry to receive cash from Mr. Ram? Very easy. Before giving journal entry, please focus on the transaction and think practically what is happening here. So you are receiving cash. That means what happened? Cash is comes in. I told you very clearly, whatever comes into your business, debit what comes in. What is comes in here? Cash. So that's why I have to debit cash. How much? 70,000. Next, what to credit? Sir, who is giving cash? We are receiving, someone is giving. Who is that person? Who is that someone? Ram. So tell me, Ram is receiver or giver? Giver only, because his giver we are receiving. So credit the giver, no? To Ramu account. That's it. Second transaction, cash paid to Ram. Cash paid to Ram. So again, tell me what is happened practically. So I am paying cash. That means cash is going out from my pocket. So cash is going. Just now we covered debit. What comes in credit? What goes to? What is going out here? Cash is going out to cash. Debit what? Who is Ram? He is receiver. So debit Ram account to cash account 80,000. Okay. And one important point I should discuss here. For example, salaries paid. What is that? Salaries paid 1 lakh rupees. Tell me what is the journal entry for salaries paid? What is the journal entry? Obviously, again think practically. Salaries paid means cash is going out. So credit what goes out, right? So to cash account 1 lakh rupees. As well as we know rule number 3, debit all expenses and losses, credit all incomes and credits. We know that salary is an expenditure, we have to debit salaries. So entry would be salaries account debit to cash account 1 lakh rupees, 1 lakh rupees. Okay. So next one. For example, transaction is like, you tell me entry for it. Salary paid to Mr. Mukesh, value of 1 lakh rupees. So you tell me entry for it. Salary paid to Mukesh 1 lakh rupees. How much? 1 lakh rupees. What is the journal entry for it? So definitely we are paying cash. So 2 cash, that is fixed. What is the debit item? Tell me, what is the debit item? So here, if you apply golden rules, there is a chance for 2 answers. First answer is, because we are paying salary, salary is an expenditure, so entry is salary account debit to cash account. That is first option. Second option, we are paying salary to Mr. Mukesh. That means Mukesh is a receiver. Debit the receiver, no? So Mukesh account debit. And cash is going out to cash account. You tell me which is correct. Salary to cash or Mukesh to cash, which is correct? 100%. Both the answers are correct if you apply golden rules of accounting. But the correct answer is salary to cash. My question to you guys, why this is not correct? If you apply the golden rules of accounting, this is correct only. But I think you don't have reason for it why this is incorrect. The reason is very clear. There is a stumble in accounting. If you are paying expenditure to anybody or any entity or any person, so the person name or entity name is irrelevant to us. So if you paid any expenditure, you should not record the person name in your books of accounts. Instead, you have to give importance to the expenditure name, purpose of expenditure. For example, rent paid, you have to focus on the type of expenditure, rent. You should not focus on paid to whom. Salary is paid, focus on salary, not on employees. Rent paid, focus on rent, not on landlord or owner. So remember one thing guys, it will help you in your life, in your future life also, even in your final level. So whenever you are writing journal entry for any kind of expenditure, don't look at the person name. Instead, you have to focus on expenditure. So best example, entry number 3, salary paid. What is the entry? Salary to cash. Entry number 4, salary paid to Mukesh. What is the journal entry? Same, salary account debit to cash account only. You should not record Mukesh account debit to cash. Here you have to give more priority to expenditure only, not to the person. Okay? This is all about some kind of journal entries. Yeah, I think you all know this all journal entries, how to record all those things. And next one. So I will write one entry, then we'll discuss about it. For example, bank account debit 1 lakh rupee to asset account 90,000 to P&L account 10,000. So up to previous 4 entries, there is only one debit item and one credit item. But in this entry, there is 2 credits and 1 debit. Sometimes entry may be like X account debit, Y account debit to cash account 10,000, 10,000, 20,000. Here, in entry number 5, 2 credits, 1 debit. In entry number 6, 2 debits, 1 credit. If in any journal entry, if there are more than 1 debit or more than 1 credit, such kind of journal entries are called compound journal entry. What is that word? Compound journal entry. If there is only one debit and one credit, those are called simple journal entry. What is that entry? Simple journal entry. Okay. And next, in our basics, we have to discuss ledger, trial balance, all those things. So just I will start ledger posting. I'll complete this within span of 5 to 6 minutes. I will not take more than 6 minutes. Why? Because that is all very basic things. I think you have covered in your plus 1, plus 2 or else in your foundation level only. So how to write, how to post in your ledger? Listen. For example, if there is an entry like cash account debit to Ramu account, this is a journal entry. Now you have to give ledger posting. For example, amount is 10,000. Sir, how to post in ledger? Very easy. So firstly you have to open all accounts. Here there are two accounts. One is cash account. Second one is Ramu account. So left side of account is called debit side, right side of account is called credit side. Whenever you are preparing account in T shape, you should not forget to write DR and CR. Without DR and CR, that is not an account at all. Okay, so now we can call it as an account, no problem at all. Okay, next listen. Now how to post this entry in this ledger? Let's go with step by step. Step number 1, firstly focus on debit item. What is debit item here? Cash account. Okay, tell me, does cash account debited or credited in that journal entry? Debited only, no? Here also cash account should be debited. Already you know that debt means you have to start with 2. Now the question is whether I have to write 2 cash or 2 Ramu. Again one more thumb rule. If you open any account, you should not write the same name in that account. That means you should not write 2 cash or buy cash in cash account. You have to write opposite person, opposite account name. What is opposite account? 2 Ramu account. That is okay, fine. Now the point is, how much amount should I write here? Again same, how much debited here? 10,000. So here also you should write 10,000. Okay. Step number 1 is done. Step 2. Next item, credit Ramu. Ramu, debited or credited? Credited only. Here also you should credit by. What should I write? Again write by Ramu? No, that's what I told just now. You should not write same account name in account. Instead of you have to write the opposite account, nothing but what is the debit account? Cash. How much should I record? 10,000 only. This you can obviously post in ledger, that is not a big deal. But coming to compound journal entries. For example, just now we discussed journal entries. For example, entries like cash account debit 1 lakh rupees, to asset account 95,000, to P&L account 5,000. Now it is a challenge to all of you. Just pause the video for 10 seconds and give me your answer, or else write answer somewhere else. I need ledger posting, or else I will wait for you. Please give me ledger posting for this entry. Done. Yeah, same as previous journal entry. You should open all the accounts. Here, how many accounts we can observe? So cash, asset, P and L. So cash account. After that, asset account. After that, P and L account. Again same, you have to write DRCR, DRCR, DRCR. Okay? Yeah. Now tell me how to post it. Again same as our previous discussion. First focus on debit item. Is it debited or credited? Debited. So cash account debited, no? Here also we should debit. But the problem is, look at credit side. Here, yeah, I'll tell, listen carefully. So you have to look at cash account is debited. How much debited? 1 lakh. Already I told you, here also you should debit 2. Now the point is, either I have to write 2 asset or 2 P&L. So here you have to write both those things, nothing but 2 asset. At the same time, 2 P&L. 2 asset how much? 95,000. 2 P&L 5,000. So total 95,000 plus 5,000, 1 lakh tally. Here you should not write only one debit item, you should write 2 items. In the same way, debit item is closed. Next one, what is the next item? Credit item. 2 asset. Tell me, here asset, debit or credit? Credit only. So here also we should credit. By writing opposite account means buy cash. Here generally students will do mistakes. They will write 1 lakh here. How can you write 1 lakh? Here you received only cash of 95,000, no? Here the asset value is 95,000, no? How can you write 1 lakh? You should write only the amount which shown in that particular account. The student will ask the question, then here cash account 1 lakh, recorded on 95, that's not correct explanation. Look at aggregate, total, what is the debit item? 1 lakh, here also 1 lakh tally. See, if you observe asset account, you should write only 95,000. How can you write 1 lakh? Similarly, P and L account that is credited here also I have to credit. What is the credit item? Opposite, buy cash. How much? 5,000 only. How can I write 1 lakh? And one more thing, you can check your answer whether it is correct or wrong. If you check the total debit is 1 lakh, credit is 95 plus 5, 1 lakh, tally, no? That's it. If you write here 1 lakh, here 1 lakh, total credit is 2 lakh, this is 1 lakh only. Our double entry system will not get tallied. Even our balance sheet will not get tallied if we bought the same thing. Okay? This is how we have to post our ledger accounts in case of compound journal entries. Okay? And after that, please give me 1 minute and Okay, so this is how journal and ledger, and I think you know this concept called subsidiary books. Subsidiary books are extension of journal. So what are the subsidiary books? Tell me. First one is purchase day book. Second one is sales day book. Third one is purchase returns. Fourth one is sales returns, or we can write return outward, return inward. Next one is bills receivable book. Sixth one is bills payable. Seventh one is journal proper or general journal. These seven are subsidiary books. So subsidiary books is an extension of journal topic. So here we will record only those transactions. For example, if you observe purchase book, here we will record only credit purchases. We will not record any other kind of transactions. Just give me 1 minute, I will show you it. Yeah, here you can observe what are the subsidiary books we have. The first one is purchase day book. Here we will record only credit purchases. Next one, sales day book. Here we will record only credit sales. Purchase returns, here we will record only purchase returns. In sales return we will record only sales return. In bills receivable we will record only bills receivable. In bills payable we will record only bills payable. Remaining one, the last all remaining topics whatever which are not covered in the previous 6 books. So this is all about all basics. So trial balance is nothing to discuss. Trial balance, I will give you the material, that is more than enough. Okay. So with this I conclude introduction topic, accounting introduction. I don't want to prolong this topic because all these topics are already covered somewhere else. Even I covered a little bit. Okay. So that's it guys. We'll meet in the next class with the second topic, which is very very important, introduction to corporate accounting. Okay, fine. Very good morning to all. So, in our paper number 4 of group 1, that is CA and FM. So, in this subject already we completed the first 2 chapters. Those are Introduction to Accounting and Introduction to Corporate Accounting. So actually those 2 chapters are just introductory chapters, so those chapters are not that much important for your examination. But coming to from 3rd chapter, accounting standards, from this chapter onwards, each and every chapter is going to be very very important. Okay, so pay more attention from this chapter onwards. If you have not listened previous 2 lectures or previous 2 chapters, or if you are not focused on previous 2 chapters, that is okay, fine. But from this chapter onwards, each and every line and sentence is very very important. Okay, so let me begin our 3rd chapter and very very important chapter, accounting standards. From this chapter onwards, I'll give you time for notes as well. So when I am teaching or when I am telling anything, so please don't focus on writing. So definitely I will give you time for writing. At the time of at the time you can write. Okay, you can copy. So come on. Accounting standards. A we can call accounting standards in shortcut AS, nothing but accounting standards. Accounting standards are written policy documents. So these are the kind of policy documents which are in written format issued by the either expert accounting body or else government or else some other regulatory body. So these accounting standards are issued by the either expert accounting body or government or other regulatory body. Expert accounting body means nothing but ICAI. I think you all are aware of the body called ICAI. So our body is ICSI. No? Similarly, for CA, there is a body called ICAI, Institute of Chartered Accountants of India. So that body prepares accounting standards, or else government, or else any other regulatory body, they will prepare accounting standards. So whatever accounting standards we are going to learn in our future, those standards are prepared by the especially our expert accounting body is nothing but ICAI and with the help of government and some other regulatory body as well. So they can ask an MCQ from this area like accounting standards are prepared by or issued by option A expert accounting body, option B government, option C other regulatory body, option D A or B or C. So option D is correct. These all are R clauses, A or B or C. So accounting standards may be issued by the accounting body or else government or else regulatory body. Okay. So normally accounting standards covers four things. What are those four things? Recognition, measurement, presentation and disclosure. First of all, sir, what is this accounting standards concept is? What is the purpose of this accounting standards? I will tell you in brief, then we will move on to the chapter. See, for example, there are some areas there we need uniformity. Otherwise, people will do as per their own requirement or they will take their own choice. For example, we are valuing inventory. For example, we are doing some business and at the end of year we have some 100 items as a stock. It's nothing but we call as an inventory. Now we have to value that inventory. So I may follow LIFO method or some people may follow FIFO method. Or else I may value my closing stock at cost. Some people may value those closing stock at selling price. So whenever each and every person is following their own kind of valuation, then definitely there is no kind of uniformity. Better I will give an example, then we will get more clarity. For example, I need one place. Yeah. For example, okay. So this is business of Varma. I am running business. And this is business of Meenakshi. So you are also running business. So we both have started business on same date and our business is same business. We both are in same kind of business. Okay. So for example, our business is for example a mobile business. Okay. Same company, same brand, everything is same price, everything same. So at the beginning of month or year, I bought 100 mobiles from supplier. You also bought 100 mobiles from same supplier, same price. For example, price is 100 into 1000 rupees. That means 1 lakh. For me, 1 lakh. For you also 1 lakh. So in during the year, I sold 60 mobiles. You also sold 60 mobiles. So we sold at 1500, you also sold at 1500. That means our selling price is also same. At year end, out of 100, we sold 60 no. So I am having 40 mobiles in my stock. You are also having 40 mobiles in your stock. That means my closing stock is 40 mobiles, your closing stock is also 40 mobiles. Then if you open trading account, under trading account I will write buy closing stock. You also write buy closing stock. Now the point is how many mobiles do we have in our closing stock? 100 mobiles, 40 mobiles only. I am holding 40 mobiles, you are also holding 40 mobiles. But now the point is actually what is my cost? 1000, my selling price is 1500. So actually I am valuing my closing stock. So I took 40 into 1000, 40,000 as my closing stock. My logic behind it is very clear. So I bought this mobile for 1000 rupees. So 40 into 1000, 40,000, that is my logic. So your logic is I am holding 40 mobiles. So if I sold all these 40 mobiles, I will get 1500 per each. So that means you are writing 60,000 as your closing stock. So your logic is genuine as just like me. So your logic is very clear. So what is your logic? Your point is, sir, if I sell these 40 mobiles, I will get 60,000. That's why I am writing here 60,000. My logic is cost is only 1000. I write 40,000, 40,000. Both of our logics are correct. If everything is same, including all those items, then definitely my gross profit will be lower when compared to your gross profit. Wherever your gross profit is more, obviously your net profit will also be more. Then tell me, if you show these two trading accounts or P&L accounts to a third party, definitely they will took a wrong assumption that so Meenakshi business is holding or getting more profits when compared to Varma business. But in fact that is wrong. Both are getting same amount of profits. Then why there is difference in this particular valuation? Because I took cost as my closing stock. You have taken your selling price as closing stock. Basically, both of our points are correct. But if you allow the same thing for all the entities, then everybody will take their own points. So similarly, that is not at all comparable. So we can't compare Varma business with Meenakshi business because both of their policies are different. My policy, Varma's business policy is to find out inventory by taking cost. So Meenakshi point is by taking a selling price. So definitely this is not at all correct. Okay. So this kind of areas, there are some areas are there where definitely one policy is required. That means everybody should follow that policy only. That should be in a written document. If that should be issued by the one head of our accounting body or else government or else any other regulatory body just like SEBI. If for example, if our government says everybody follow cost, then we actually should not follow selling price. If government says everybody should follow selling price, then Varma cannot take cost price. Are you getting my point? So that means one higher authority should be there and they should issue some policy documents. So whatever the policy documents issued by the either expert accounting body, nothing but ICAI, or else government or else other regulatory body, those written documents or written policy documents are called accounting standards. Okay. So these accounting standards particularly covers this kind of areas. Just now we covered just like valuation of inventory. Sometimes we have fixed assets. For example, again there is a point called whether we have to write gross value or net value, what about depreciation, or else events after reporting period, what we have to do. So all these some areas where government or ICA feels in these areas definitely one policy should be needed in such kind of areas. So they have come up with some policy documents which are in written format. Whatever the written policy documents are there, which were issued by the either ICAI or else government other regulatory bodies. Those written policy documents are called accounting standards. In shortcut, we have to call it as a AS. I think now you got full clarity about the all background of accounting standards. What is the background of this standard? So some areas where we need uniformity in those areas. So we have three persons over there, including artificial and natural persons. Who are they? ICAI or government or else any other regulatory body. They come up with some policy documents in written format. Whatever the written policy documents issued by these three people are called as accounting standards. They are called as in short AS. Okay. So okay, that is fine, sir. So in valuation of inventory, we have some accounting standard. So that is AS2. So what is AS2 says, or what is AS10 says? What accounting standard says? Very easy, sir. Every accounting standard discuss only 4 points. What are those 4 points? Recognition, measurement, presentation, disclosure. These 4 points are generally discussed by the accounting standard. If you take any accounting standard, it is AS 1, 2, 5, 6, 10, I think 5 is not there, 1, 2, 10, 12, 22, 19. If you take any standard, 29, if you take any standard, they will discuss only these 4 points. What are the 4 points? Recognition, measurement, presentation, disclosure. Okay. So please give a heading accounting standards and copy it. I will give you time. So happily write it. So just don't copy, so try to understand the concept and write it. So if you observe, that is only one sentence, but we had a discussion for that sentence for last 15 minutes. That is called conceptual clarity. Done. Yeah, tell me, accounting standards covers what are the areas? Recognition, measurement, presentation, disclosure. So let me discuss what is the meaning of recognition, what is the meaning of measurement, what is the meaning of presentation, what is the meaning of disclosure. So recognition means, so first of all, if you remember our previous chapter called Introduction to Corporate Accounting, there we covered three topics. Topic number 1, section number 128. Topic number 2, section number 129. Topic number 3, schedule 3. Okay, under schedule 3, we have actually under 129. I told you there is a concept called financial statement. Every company has to prepare financial statements. It includes balance sheet, income statement, nothing but profit and loss account, cash flow statement, and notes. So generally, this recognition concept says, so how to incorporate one item either in balance sheet or in profit and loss account. How to recognize, how to incorporate, where to incorporate, whether it should be incorporated in balance sheet or to incorporate P&L account. That's what says recognition is. For example, valuation of inventory is there, so we should incorporate in P&L account, not in balance sheet. Actually, if it is it should be included in balance sheet as well. In balance sheet under the current assets inventory, in trading account, in closing stock. But if you observe the previous chapter, there is no kind of trading account because trading account and P&L account are merged with a single vertical or forward statement of profit and loss. Fine? Yeah. So, recognition is the process of incorporating an item in balance sheet and profit and loss account. Just we are going to incorporate either in balance sheet or profit and loss account. The accounting standards tells us which item is to be recognized in balance sheet and which item is to be recognized in P&L account. For example, the first example is if you are discussing AS10. AS10 is PPE, property, plant and equipment, where we are going to learn about fixed assets and depreciation. So there AS10 says you have to write depreciation under P&L account and net value in our balance sheet. That's what called recognition is. It is a simply we can say process of incorporating either in balance sheet or in P&L account. Okay. Next one, measurement. Measurement means name itself says, so we are valuing it. So recognition says where to be recorded, where to incorporate, whether it should be in P&L or in balance sheet. That's what work of recognition. Measurement means recording is okay, fine, but how much? Is it 20,000 or 30,000? How much? That is called quantification, numbering, measurement. Accounting standards provides guidance as to what monetary amount should be recorded, how much should I record it. The accounting standard tells us quantification. Quantification is numbering of the transactions. So try to understand what is the difference between recognition and measurement. Under recognition, it just says which that means item which what you call what item should be recorded either in balance sheet or in P&L. I am trying to say that means which item to be recognized in balance sheet or P&L account. But measurement says recognition is okay, that is accepted, fine, but how much? Tell me the value. So how to value that inventory or PP, whatever it is. How to measure that number is decided with the concept called measurement. Third one, presentation. So name itself says, so in first three we are decided where to incorporate, either it is balance sheet or P&L. At second, we decided how much should I record. In third, how to present it. Where to present is fine in recognition, How much is fine in measurement, but what is the manner of presentation? That is inside the presentation concept. Accounting standards also deals with the presentation of transactions and other events in a balance sheet and statement of P&L. Here you have to focus on manner of presentation. Okay, last one, disclosure. Accounting standards are also deals with the manner of disclosure of transactions and other events in financial statement. So disclosure, I think you know there is a concept called footnote. So some items which are not to be recorded in your financial statement, instead of you have to write on footnote as a disclosure. So if you record anything in your P&L or in your balance sheet or in your cash flow or in your notes or in your statement of changes in equity, that is called presentation in financial statements or recording in financial statements. If you are writing anything beyond your financial statements or after your financial statement, that is called disclosure. Disclosure is also form part of statements, but they are out of the statement. That is the point you should remember. Okay, so these four are meanings of this particular four words: recognition, measurement, presentation, disclosure. Recognition means process of incorporating, and measurement means quantification. Presentation means manner of presentation. Disclosure means how to disclose, manner of disclosure. These 4 points are covered by the accounting standards. What are the 4 points? Recognition, measurement, presentation, disclosure. What is the meaning of recognition? It is a process of incorporating an item in either balance sheet or P&L. What is the meaning of measurement? Measurement means it is providing guidance to value in monetary amount. Presentation means in which manner we have to present. Disclosure means in which manner we have to disclose. Actually, maybe they can't ask right about recognition, right about disclosure. They don't accept this kind of questions. But as a student, you should learn at least. Okay? Yeah. So copy all these 4 points: recognition, measurement, presentation, and disclosure. If you are done, and I move on to the next concept, need of accounting standards. Then again, same while you are writing, don't feel like just I am copying it. So try to understand the concept and write it. If you are unable to get it, you can ask me whatever the difficulties you are facing. Done. Can I move on to the next topic? Okay, copy. You are writing presentation, I think. Presentation means accounting standards also deals with the manner of presentation of transactions or events in our balance sheet or else in our profit and loss account. After that, come to disclosure. Yeah. Next concept, need of accounting standards. That's already we covered to small extent in our introductory paragraph. See, let's see what is the need of accounting standards. Then ask as a question or as an MCQ. Improvement of credibility and reliability of financial statements. Just know, at the time of starting or commencement of our chapter, so I told you very clearly, if there is no accounting standards, I follows cost method. Meenakshi follows selling price method. So if everyone follows their own methods, then definitely there is no credibility of financial statements. So nobody can rely financial statements. For example, if anybody relies financial statements of Meenakshi, then tell me, is it correct? Obviously no. How can the decision is correct? So definitely they can't rely 100% on financial statements of Meenakshi. So definitely to improve credibility of our financial statements and to improve reliability of our financial statements, people has to rely our statements and our credibility should be more. To increase this kind of credibility and reliability of financial statements, so we need accounting standards. Number 2, comparability of financial statements. So we have to compare either one person to another person's statements or else within the same entity 1 year to next year or previous year. For comparing, accounting standards are needed. Number 3, benefits to accountants and auditors. So definitely, if we follow some accounting standard, then definitely the chances of frauds by the accountant will be the lesser. And for auditors also it is easy to find out if anything was wrong. Number 4, some additional disclosures are there because if you remember, accounting standards covers recognition, measurement, presentation at last, disclosure. So sometimes AS says we need some extra disclosure. So definitely whenever you are writing some more information, definitely that will help to the users. Next one, evaluation of managerial ability. So we can evaluate what is the ability of managers while applying those accounting standards. Last one, helpful to government. Definitely, whenever some written document, policy documents is there, if everybody is following same accounting standards, then that is easy to evaluate the taxes and to collect taxes from the companies or business entities. If there is no such kind of accounting standards, then that is very huge burden to calculate correct amount of net profit for collecting or charging tax on income. So definitely for these particular 6 issues, accounting standards are needed. What are those? To improving credibility and reliability of financial statements. Second one, comparability. Third one, benefits to accountants and auditors. Fourth one, additional disclosure. Fifth one, evaluation of managerial ability. Sixth one, helpful to government. These particular situations or scenarios where we need accounting standards, or we can say AS. What are those? You can just listen and copy it. Okay, I will give you time or else copy it, then we'll move on to the next topic. Copy quickly. Done. Okay. So from last half an hour, so definitely we have learned something. What is the point we have covered? So what is the background of accounting standards we have covered, and what is the meaning of accounting standards we covered? What is the meaning of accounting standards? It is a written policy documents and it is issued by the either expert accounting body or else government or else other regulatory body. And it covers four main points. What are those 4 points? RMPD, recognition, measurement, presentation, disclosure. RMPD. Then we had a discussion in detail what is the meaning of those RMPD. Recognition means incorporation, measurement means quantification, presentation means the manner of presentation, disclosure means manner of disclosure. At last we covered what is the need of accounting standards. Important, improving credibility and reliability and comparability and benefits for the accountants and auditors and additional disclosure, evaluation of managerial ability, helpful to government. Now, what are the accounting standards issued by ICAI? Some list is there. So, all these standards are issued by the ICAI. Sir, why ICAI, sir? Already we covered in the first concept of this chapter. So, standards are issued by the either expert accounting body. Here in accounting field, the expert is the only one, ICAI. So they have listed all these accounting standards. So let me read accounting standards one by one. So AS1 is there. AS1 is discussing about disclosure of accounting policies. AS2, valuation of inventories. AS3, cash flow statements. AS4, contingencies and events occurring after balance sheet date. AS5, net profit or loss for the period, prior period items and changes in accounting policies. AS7, construction contracts. AS9 is their revenue recognition. AS10, PPE, property, plant and equipment. AS11, the effect of changes in foreign exchange rates. AS12, government grants. AS13, accounting for investments. AS14, accounting for amalgamation. AS15, employee benefits, nothing but salaries and other things. AS16, borrowing costs. AS17, segment reporting. AS18, related party disclosures. AS19, leases. AS20, earnings per share. AS21, consolidated financial statements. AS22, accounting for taxes on income. AS23, accounting for investments in associates. AS24, discontinuing operations. AS25, interim financial reporting, AS 26 intangible assets, AS 27 financial reporting of interest in joint ventures, AS 28 impairment of assets, last but not least, AS 29 provisions, contingent liabilities and contingent assets. These all the standards are issued by the our beloved expert accounting standards body called ICAI. There is no other option to you guys. You have to remember standard number as well as the name. Okay, no other option is with you. You have to remember. Sir, is it possible? Yes, it is possible by practice. Okay? Yeah. So let me discuss single line about each and every standard. Then I'll give you time for writing as well. So first one, AS1. Disclosure of accounting policies. So definitely every business entity follows some accounting policies. So whatever accounting policies you are following, you should disclose. If you are not disclosing your accounting policies, then reader or user may take wrong decision. Next one, AS2, valuation of inventory. Actually, this is the area where we started with that. So how to value inventory? Whether I follow cost method or else I follow selling cost, or else many other method is there. So how to value your closing stock? Is there any methods or how to all those things covered under AS2 valuation of inventory? AS3 cash flow statement. For any business, so cash is very most liquidative and very important thing. So how cash is comes into business entity, how cash is going out from business entity, we have to draw a statement. So what is the format of statement, how to draw it, what are the categories, how they are writing inflows and outflows, and all those things, how to prepare a cash flow statement, what is the purpose of cash flow statement, all those things covered under AS3 cash flow statement. And AS4, so in examination point of view, that is not important, but it is important for practical purpose. For example, I am preparing my balance sheet is on 31st March. So this is my balance sheet, right? But this balance sheet it will take some 10 days or 20 days for finalization by the board of directors and all those things. For example, so date of approval by the directors is around 1 month, 30th April. So in between, that means, for example, on 15th April, some big fire accident was occurred and every stock of our sea is destroyed. Every asset is in our godown is destroyed. Everything is destroyed. But the point is, in your balance sheet, you wrote stock is there, asset is there. But in practical life, there is no stock, no asset. But our balance sheet is on 31st March. That is correct only. As of that date, the asset is there, stock is there. But as of that is not there. That means this event is happened after balance sheet. If anything happened after balance sheet, what should I do? That is covered under AS4, contingencies and events after balance sheet date. What to do? Is it necessary to adjust in balance sheet or else no need? How to do what? All those things requirements are done covered under AS4. AS5, net profit or loss for the period prior period items and changes in accounting policies. So if you change in any accounting policies, sometimes it affect not only current year, it may affect prior years or its future years. So whenever you are changing accounting policy, what is the treatment, what shall I do? All those things covered under AS number 5. AS7, construction contracts. So if you are in a field of construction or else you are building something, so if it is a kind of construction and you have taken contract for it, for example, say we can observe in cities. So if a people or a business entity want to construct a 5 floors building, they don't construct an entire building on their own. They will give it for some contractor. So whenever you are taking some construction contract as a business, so how to deal in accounting purpose? That means you will not receive money in entire amount in the first day or else last day. You will receive in progress mode. For example, in month 1, sir, for example, in year 1, you have completed some amount of buildings, or out of 5 floors, 3 floors are completed, but you have not received, any kind of amount. The reason is they will give you amount based upon, so they will give you amount based upon whatever the contract between you and the particular vendor or else the customer. But in our accounting purpose, definitely we should record in particular year. So how much, for example, we have taken some contract from one customer and we are building 5 floors building. 2 floors are completed out of 5 floors, but we have not yet received any amount. Sir, is there any necessity to record in our books, or how much do I record? All things is covered by the AS7 construction contract. Coming to the next standard is AS9, is nothing but revenue recognition. So whenever you are doing some business, how to recognize revenue? So all the things covered under AS9 is a very big standard and important as well. Next one, AS10 is property, plant and equipment. Actually, when I was studying, there is a standard called AS6 is there, now it is removed. AS6 is depreciation, AS10 was fixed assets. We have 2 standards while I am studying. Now these 2 standards are merged into one standard, that is AS10 with a new name called PPE. PPE full form, property, plant and equipment. There we are going to learn how to value fixed assets, how to find out depreciation, what are the methods we should follow, and how to write in balance sheet, is it gross or net. All those things we are going to learn in AS10. Okay, the standard is very, very important. How to value our fixed assets for the first time, that is called initial recognition. At year end, what to do, revaluation, all those things covered in AS10. Next one, AS11, the effects of changes in foreign exchange rate. For example, if you are dealing with foreign exchange, forex, foreign currency, definitely the rates are fluctuating frequently. Whenever rates are changing, what to do? See if it is get profit or loss, what is the treatment. So all things are covered under AS11. AS12 is government grant. Sometimes governments will give grants to the business organization. For example, ITC company is there, no? So ITC is planning to incorporate a setup in Vizag in Andhra Pradesh. So AP government is planning to give some big amount as a grant. So whenever AP government is giving grant to TCS, so in TCS point of view, how to record in our books. That's what we are going to learn in AS12. AS13, accounting for investments. If you have invested your amount in somewhere, how to do our accounting, that's what we are going to learn in AS13. AS14, accounting for amalgamation. Amalgamation means 2 businesses are merging into one business, that is called merger. If one business is taking another business, that is called amalgamation. So whenever amalgamation is there, for example, Vodafone Idea, such kind of things, how to do accounting, that's what we are going to learn in AS14. AS15, employee benefits. So whenever you are paying salary or else if you are contributed to PF or gratuity, so all those things, how to do accounting is going to learn in AS number 15, employee benefits. AS16 is borrowing cost, nothing but interest. If you have taken any loan for construction of asset or purchase of asset or acquisition of asset, what about interest? Where it should be recorded? Whether it should be recorded in P&L account as to interest, or else I have to record in balance sheet, I have to capitalize it. Is it capitalized or is revenue? That should be learned in AS number 16. AS17, segment reporting. So this concept is a little bit different, but okay. That means, for example, if you take BCA as an example, we have 3 segments. We have CMA segment, CS segment, CS segment. all the segments are different. So how to do this segment reporting, all those covered AS number 17. AS 18 is about related party disclosure. So if a business is entering into any transaction with our related parties, so you have to definitely disclose. How to disclose, when to disclose, where to disclose is going to cover under AS number 18. AS 19 is leases. Whenever you have taken any asset on leases, that may be operating lease or finance lease, what is the treatment, all those we are going to learn in AS number 19. My dear students, here I am not explaining all the points about standard, just I am giving just introduction to the standard number, that's nothing more than that. AS 20, earnings per share, we can call in short EPS. So what is the earnings per share? We are going to learn in AS 20. AS 21, CFS, consolidated financial statements. AS 22, first of all, what is the meaning of consolidated financial statements? That means whenever a holding company or parent company, it has some subsidiaries, right? Subsidiary 1, subsidiary 2. So definitely every company has to prepare actually I think this point covered in chapter number 2, right? Yeah, there I think you covered. So how to prepare consolidated statements, all the things we are going to learn in AS 21. AS 22, accounting for taxes on income, they were going to learn DTA, DTA, all those things, very interesting topic. AS 23, accounting for investments in associates. I think you know what is associate, what is subsidiary. Subsidiary means you invested more than 51%. Associate means more than 20 or 25. 20%. Yeah. 24, AS 24, discontinuing operations. For example, if I am running, I am in food industry, so I have two businesses. One is I am running a restaurant, second one I am doing catering services. I feel catering is last business, it is not feasible. I closed or I discontinued the catering business. So whenever you discontinue, how is accounting treatment is covered by the AS number 24. Next one, AS 25, interim financial reporting. Interim is in between. Generally, we have to prepare our statements at year end, but some companies or some entities, they will prepare quarterly. So it is called interim, in between. So how to prepare all the things covered by the AS 25. AS 26, intangible assets. So I think you know what is the meaning of intangibles. We covered under the first chapter called Introduction to Accounting. So intangible assets means assets which does not have any physical existence and which cannot be seen and touched. Examples: goodwill, patent, trademarks, copyrights, logos, intellectual properties, licenses, etc. So for those, how to accounting we are going to learn in AS 26. AS 27 about joint venture. So I think you know joint venture concept is, and AS 28 impairment of assets. Impairment is similar to depreciation but not exactly same. Impairment means it is also reduction in value of assets. It is a completely different concept. And last one, provisions, contingent liabilities and contingent assets. How to create provisions? What is the meaning of contingent liability? When to record all the things we are covered in AS 29. So these all are a single meanings of all these standards. Okay, I have not covered in detail. In further, we are going to learn all those things. Okay, just I am giving you time for copy. So please copy, and we'll take a break after completion of your writing. Just read it while writing. For example, AS2 valuation of inventory, AS3 cash flow statement, like that. Okay? Hello? I think you are okay. Write down AS3, AS for all those standards. Fine. Can I scroll? Done. Can I scroll up? Done.
Yeah. Before closing the session, just let me read the entire standard numbers along with names once, and after that we'll close the session and we'll continue tomorrow. So AS1 disclosure of accounting policies, AS2 valuation of inventories, AS3 cash flow statement, AS4 contingencies and events occurring after the report after the balance sheet date, AS5 net profit or loss for the period, prior period items and changes in accounting policies, AS7 construction contracts, AS9 revenue recognition, AS10 PPE, AS11 the effect of changes in foreign exchange rates, AS12 government grants, AS13 accounting for investments, AS14 accounting for amalgamation, AS15 employee benefits, AS16 borrowing cost, AS17 segment reporting, AS18 related party disclosures, AS19 leases, AS20 earnings per share, AS21 consolidated financial statements, AS22 accounting for taxes on income, AS23 accounting for investments in associates, AS24 discontinuing operations, AS25 interim financial reporting, AS26 intangible assets, AS27 financial reporting of interest in joint venture, AS28 impairment of assets, AS29 provisions, contingent liabilities and contingent assets. So this is all about accounting standards, meaning and terms and need of accounting standards and list of accounting standards issued by the ICAI. So before entering the next class or next video, please listen one more time, or practice all the standard numbers, and we'll meet tomorrow. Until then, I miss you. Take care. Bye bye. So very good morning to all of you. So today, actually, in previous session we started with accounting standards. So let me revise the entire content once, and after that we'll move on to the new topics. So, accounting standards are written policy documents issued by the three bodies. What are those three bodies? Either expert accounting body or government or other regulatory body. Expert accounting body means nothing but ICAI. ICAI means Institute of Chartered Accountants of India, or government or else any other regulatory body. And if you remember, I told you very clearly, accounting standards covers four things. What are those four things? Recognition, measurement, presentation, disclosure, RMPD. Next one, what is the meaning of recognition? We had a discussion about it. Recognition means it is the process of incorporating an item either in balance sheet or in P&L account. So the point is, for example, if an item is there, where to incorporate, whether it is in income and expense or else in balance sheet, that's what says recognition means. Measurement means how much should we write. That is called quantification. So recognition is discussing about in which we have to incorporate, whether it is under balance sheet or P&L account. Measurement says how much should I record. Third one, presentation. Presentation means it says manner of presentation. Next one, disclosure. It deals with the manner of disclosure. After that, we covered one more important area called need of accounting standards. What is the need of accounting standards? Improvement of credibility, reliability of financial statements, and second one, comparability of financial statements. Third one, benefits to the accountants and auditors. Fourth one, additional disclosure purpose. Fifth one, evaluation of managerial ability. Next one, helpful to the government. These all are called needs of accounting standards. Then we had a discussion of some list has been given by the ICAI which are discussing about accounting standards. So we have some AS 1, 2, 3, 4, 5, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 as well as 20, 21, 22, 23, 24, 25, 26, 27, 28 and 29 standards are there. Just we discuss what the name as well as number. AS1 is discussing about disclosure of accounting policies. AS2 is valuation of inventories. AS3 is cash flow statement. AS4 is contingencies and events after reporting period or balance sheet date. AS5 is net profit or loss for the period and prior period items in accounting policies. AS7 is construction contracts. AS9 is revenue recognition. AS10 is PPE. AS11 the effect of changes in foreign exchange rates. AS12 government grants. AS13 accounting for investments. AS14 accounting for amalgamation. AS15 employee benefits. AS16 borrowing cost. AS17 segment reporting. AS18 related party disclosure. AS19 leases. AS20 earnings per share. AS21 consolidated financial statement. AS22 accounting for taxes on income. AS23 accounting for investments in associate. AS24 discontinuing operations. AS25 interim financial reporting. AS26 intangible assets. AS27 joint venture. AS28 impairment of assets. AS29 provisions, contingent liabilities and contingent assets. These all are accounting standards given by our body ICAI. So let me enter into the next topic, sir. Applicability of accounting standards. Sir, accounting standard applicable to which kind of entities? So actually, it is applicable to the following categories. First one, it is applicable to sole proprietorships who are preparing their financial statements. Second one, partnerships. Third one, societies. Fourth one, trust. Fifth one, HUF, nothing but Hindu undivided families. Next one, AOPs, Association of Persons. Next one, BOI, Body of Individuals. Next one, cooperative societies. Next one, companies. Next one, LLPs. Almost for all category of business organizations, whatever we have in our Indian economy. So for all those entities, accounting standards are applicable. If you observe, everything is covered in this list. Sole proprietorship, partnership, society, trust, HUF, association of persons, body of individuals, cooperative societies, companies as well as LLPs. But the point is, remember my students, already we covered first chapter called Introduction to Accounting, second chapter Introduction to Corporate Accounting. So third chapter we are discussing now accounting standards. Out of these three, so first two chapters are just a fundamentals. In fact, third chapter accounting standard is also theory chapter. Okay. So tell me, applicability of accounting standard, it is applicable to which kind of entities? Sole proprietorships, partnership, society, trust, HUF, association of persons, body of individuals, cooperative societies, companies, LLPs. Okay, for all these category of entities, so accounting standards are applicable. But if you want to know in detail about applicability, you should know this kind of classification. So types of entities, there are two types, corporate and non-corporate. In corporate they have divided into two subcategories, SMCs, non-SMCs, and non-corporate they have divided into three categories, level 1, level 2, level 3. Now, SMCs means small and medium companies. So for small and medium companies, what are the applicability criteria and what are the conditions? Let's see. Yeah, now it is okay, I think. SMC is full form small and medium companies. You can say SMCs, no? Conditions. SMCs are companies that satisfies the following conditions. These follow, if any company satisfies this condition, they are called SMCs. By the way, I want to say one more thing. So just listen all this theory content just like nothing. Why? Because this is not that much important for your exam. So equity and debt securities of the company are not listed, are not in the process of listing. If you want to call any company as SMC, first of all, that should not be listed company. What is the meaning of listed company? Remember, my students. So, listed company means if any company wants to trade their shares or debenture, they want to list their companies in recognized stock exchanges. In India, we have so many exchanges, but the main exchanges are two exchanges. One is NSE, second one is BSE. NSE stands for National Stock Exchange, BSE stands for Bombay Stock Exchange. So there, if company is listed or in the process of listed, we can't call it as a SMCs. So it should not be listed or it should not be in the process of listing if you want to call that as a SMC. Second one, company is not a bank or financial institution or insurance company. If it is a bank or FI or insurance company, we should not call it as a SMCs. It is not covered under SMCs. Third one, company turnover. Turnover means revenue from sales or services. Company turnover, excluding their income, does not exceed 250 crores in the immediate preceding accounting year. That means if you want to check in 2025 whether it is SMC or not, you have to check the previous year turnover, nothing but 24 turnover. If the previous year turnover is greater than 250 crore, that is not a SMC. Okay? So company does not have borrowing including public deposits exceeding 50 crores at any point of time in preceding financial year. If in any preceding financial year, that means the previous year, if their borrowings or deposit from the public exceeds 50 crore, then that is not comes under SMCs. Last one, company is not a holding company or subsidiary company of a non-SMC. How beautiful the sentence is. If that company, even it is satisfied all those conditions, but if it is a subsidiary of another non-SMC or another non-SMC, that is also not a SMC. For example, Reliance company is not a SMC. Some subsidiaries there of Reliance company, for example XYZ Limited, that company satisfies all these three conditions even though that is not a SMC. Why? Because that is a subsidiary of non-SMC. So here they have given some 5 points with respect to SMC, but if you observe, all those 5 points are in negative sense. That means they have covered which are not comes under SMC, remaining all are SMCs. Okay? Applicability. So there is some partial exemption is there. Certain relaxation are provided with respect to the following accounting standards: AS 17, 15, 19, 20, 29. Full exemption AS 3. That means AS 3 is not applicable for SMCs. Actually, this all theory content is not that much important. Just listen once and leave it. Non-SMCs. For non-SMCs, all accounting standards are applicable. There is no exemption at all. For SMCs, AS3 is not at all applicable. And in this, there is partial exemption subject to some conditions. What are those partial exemption standards? 17, 15, 19, 20, 29. Coming to second one, non-corporate entities. In non-corporate entities, they are divided into 3 categories. What are those 3 categories? Level 1, level 2 and level 3 and level 4 categories. In level 1, let's see, non-company entities which fall in any one or more following categories. Entities whose securities are listed or in the process of listed. Second one, banks. That means if you observe whatever the four conditions which covered under SMCs, so those four again repeated here. That means they are considered level 1 category. So for them, they have to required to comply all accounting standards. However, AS 21, 23, 25, 27 is based upon their requirement. So these 4 points are repeated in SMCs. In SMCs, for them, A's are not applicable here. A level 1 no, so applicable. Similarly, level 2. Here also non-company that is not a company, which are not level 1 as well. So that means whose turnover exceeds 50 crores but not exceed 250 crores. If it is a commercial or industrial sector, deposits exceed 10 crores but not exceed 50 crores. Or holding or subsidiary of any of the above. For them, again same 21, 23, 25, 27 and not applicable standards 3, 7, 20. Applicable with some disclosure exemptions 15, 19, 28, 29. Just listen once and ignore, nothing more than that. For level 3, which are more than 10 but not exceed 50, for them also same 3, 7, 18, 20, 24. Level 4, non-company entities not covered under level 1 or level 2 or level 3. For them, AS 14, 21, 22 are exempted. Not applicable standards 3, 7, 18, 20, 24, 28. Disclosure exemption requirements 10, 11, 13, 15, 19, 22, 26, 29. So everything you can just ignore, just listen once, nothing more than that. But try to remember this classification. What is this classification? So 2 types based upon corporate and non-corporate. So or else you can say company or non-company. In corporate they are divided into 2 categories. SMCs, non-SMCs. SMCs means small and medium-sized companies. So non-SMCs which are not a small and medium-sized, nothing but large companies. In non-corporate, 4 levels. Level 1, 2, 3 and 4. Actually 4 is missing here, level 4 as well. So SMCs means which are not covered under these 5 categories. That means they are not in the listed or not in the process of listed. Second one, there should not be bank or FI or insurance company. Third one, if turnover exceeds 250 crores or deposits exceeds 50 crores, if it is not a holding or subsidiary of some SMC. Okay. Yeah. Hello, my student. So, in last session we are discussing accounting standards. So, I think no need to revise, or else just I will just recap. Accounting standards are written policy documents issued by the 3 of the bodies, either it by the expert accounting body or else government or else other regulatory body. It covers 4 things. What are those 4 things? Recognition, measurement, presentation, disclosure, RMPD. Then we covered what is the need of accounting standards. Those are improvement of credibility and reliability of financial statements, comparability, benefits to the accountants and auditors, additional disclosure, evaluation of management ability, helpful to the governments. Then we have covered the list of accounting standards AS 1 to AS 29. AS 1 disclosure of accounting policies, AS 2 valuation of inventories, AS 3 cash flow statement, AS 4 contingencies and events occurring after the balance sheet date, AS 5 net profit or loss for the prior period item that is in accounting policies, AS 7 construction contracts, AS 9 revenue recognition, AS 10 PPE property plant and equipment, AS 11 the effect of changes in foreign exchange rates, AS 12 government grants, AS 13 accounting for investments in associates, AS 14 accounting for amalgamation, AS 15 employee benefits, AS 16 borrowing cost, AS 17 segment reporting, AS 18 related party disclosure, AS 19 leases, AS 20 EPS earnings per share, AS 21 consolidated financial statements, AS 22 accounting for taxes on income, AS 23 accounting for investments in associates, AS 13 is investments, 23 is investments in associates, AS 24 discontinuing operations, 25 interim financial reporting IFR, 26 intangible assets, 27 financial reporting of interest in joint venture, 28 impairment of assets, 29 provisions, contingent liabilities and contingent assets. And after that, let me discuss applicability of accounting standard. For which kind of entities accounting standards is generally applicable? General accounting standard is applicable to majority kind of business entities. So if they have given some list of applicability, first one, sole proprietorship, partnership, societies, trust, Hindu undivided families, association of persons, body of individuals, cooperative societies, companies, LLPs. So these are the list of applicability of accounting standards. What are those? Sole proprietorship, partnership, society, trust, SUF, association of persons, body of individuals, cooperative societies, companies, LLPs. Majority of the entities are covered. But while knowing the applicability of accounting standard, we just want to know this particular categorization. So types of entities, we have two types of entities: corporate, non-corporate, corporate, non-corporate. Again, under corporate, we subdivision is there, two divisions: SMCs, non-SMCs. First of all, the main classification is corporate, non-corporate. Under corporate, nothing but company style. SMC. SMC, the name itself says small and medium scale size companies. Non-SMCs, other than SMCs. Under non-corporate, they have divided into three categories: level 1, level 2, level 3. So definitely for knowing applicability of accounting standards, depend upon which category it is. So you should aware of which is SMC, which is non-SMC, which is level 1, level 2, level 3. So when we have to call one entity is a SMC, or when we have to call one entity is a non-SMC, or level 1 or level 2 or level 3, that's what we are going to learn after this concept. First of all, try to understand the entire structure of these entities. So just this structure is only for applicability of accounting standards. So tell me, what are the main classification? Corporate, non-corporate. Under corporate, two divisions are there: SMCs, non-SMCs. SMCs means small and medium size companies. Non-SMCs means other than small and medium size companies. Again, under non-corporate, three entities: level 1, level 2, level 3. Now it is our duty to which is called as a SMC, to which entity is called as a non-SMC, to which entity is called as a level 1 or level 2 or level 3. Let's focus on it. So first one, SMC. What is the full form of it? Small and medium companies. Sir, when to call one entity is a small and medium company, so focus on it. So SMCs are companies that satisfy following conditions. They have given 5 conditions. If any one of these conditions is satisfied, that company or that entity is called SMC, small and medium companies. First one, equity and debt securities of the company are not listed or not in the process of listing either within India or outside India. That means there simply we can say that should not be listed company or should not be in the process of listing either in India or outside India. If any company is a listing company either in India or outside India, we can't call that entity as a SMC. Whenever that company is a listed company, that is not a small size company anymore. Okay, so whenever they are listing, they are planning for public issue. If they are planning for public issue, how can you call it as a small or medium scale company? So that is not a SMC. Okay, remember, not only equity, either debt as well. So either equity or debt, if any of these instruments are listed or in the process of listing. What is the meaning of process of listing? Actually, I applied for listing, but not yet approved by the particular recognized stock exchange, even though you are not a SMC, because that is in the process of listing. No, very soon you will get listed in that stock exchange. So I can't call you as a SMC. If I want to call any company as a small and medium size scale company, definitely that should not be a listed company, or that should not in the process of listed entity. Okay. Second one, company is not a bank or financial institution or insurance company. Very beautiful condition it is. So we can't call any banking company or any insurance company or any financial institution. So what is the meaning of financial institution? Just like Bajaj Finance, such kind of any institutions, or as any banking companies, or as any insurance companies. So you can't call banking company or insurance company or financial institution as a small and medium scale size company or SMC. So till now we covered two conditions. Condition number one, so if you want to call any company as a small and medium size scale company, that should not be listed company, or that should not be in the process of listing. Condition number two, the company should not be a banking company, and company should not be a electricity or company should not be a banking company or insurance company, and that company should not be a financial institution. That means there are three exemptions are there. These three kind of companies or any more or any way covers under SMCs. What are those three? Banking, insurance, as well as financial institutions. Number 3 or C, company's turnover does not exceed 250 crores in immediate preceding accounting year. So whenever you are assessing or determining the status of SMC preceding to that year, you have to check what is the turnover of that particular entity. If the turnover exceeds 250 crores, then that will not be SMC anymore. If the turnover does not exceed 250 crores, then we can't call it as a SMC. But one note point is there: while you are assessing or valuing the 250 crores, you should ignore other income. That means you should consider only revenue from operations. Either it might be revenue from sales or else revenue from rendering of services. So you have to check only principal source of revenue. If that revenue is less than or equal to 50 CR, then that is a SMC. If that exceeds to 50 CR, that will not be SMC anymore. Next one. Company does not have borrowing exceeds 50 crores at any time during the immediate preceding accounting year. Similar to previous condition, whenever you want to determine the status of SMC or not during the preceding to that year, you have to check what are the deposits or borrowings including public deposits. If that borrowings including deposits exceeds 50 crores, then that company, that entity is not eligible to call it as a SMC. That means you have to understood in a negative manner. So if you want to call one entity is a SMC, that entities or that company's borrowings including public deposits should be less than 50 crores or less than or equals to 50 crores. If it exceeds 50 crores, then that entity will not be hold anymore SMC status. Last condition, company is not a holding company or subsidiary of a non-SMC. So that means if one entity is there, it satisfies all the previous 4 conditions. That means that is not listed company or not in the process of listing company. Condition number 2, that is company is not a banking company, not a insurance company, not a financial institution. Condition number 3 is company's borrowing does not company's turnover does not exceed 250 CR. Condition number 4 is company's what you call deposits or borrowings does not exceed 50 crores, every condition is satisfied to call it as a SMC. But the problem is this particular company is a subsidiary of non-SMC, or this company has one non-SMC subsidiary. So then even though those previous four conditions are satisfied to call it as a SMC, that entity cannot hold SMC status. So that means even though company is eligible to hold SMC status, if that holds any subsidiary or holding which is non-SMC, then that company also becomes non-SMC even though they complied all the previous conditions automatically. Okay? And so all these kind of companies are called SMC. SMCs means small and medium companies. So applicability of accounting standards, they have given some list. Listen. Partial exemption. Certain relaxations are provided with respect to the following accounting standards. Because they are SMCs, so definitely our main agenda of our Indian government is, so we have to encourage SMC to encourage entrepreneurs. That is the reason we have given some relaxation, at least partially, with respect to some standards like AS 17 segment reporting. Segment reporting standard is partial exempted to SMCs, and AS 15 is exempted. AS 19 leases, 20 EPS, 29 provisions, contingent liabilities and contingent assets, and full exemption is AS 3. Cash flow statement is fully exempted for SMCs. Remember? So partial exempted standards are 17, 15, 19, 20, 29. Fully exempted is 3. These all exemptions or applicability is only for SMCs, not for all other entities. It is not for non-SMCs or not for level 1 or level 2 or level 3 entities. Okay? Come on. So next one. Second category, non-SMCs. So simply other than SMCs are covered under non-SMC. So for them all accounting standards are applicable. So there is no exemption. Okay? No partial, no full exemption. So first of all, sir, what is this kind of corporate? Nothing but companies only. So in the first category, corporate, we have two subdivision, SMC, non-SMC. SMC means small and medium companies, non-SMC means other companies, large companies obviously. So when to call SMC, when to call non-SMC, when to call SMC, they have given 5 conditions on it. What are those 5 conditions? Condition number 1, it should not be listed or not in the process of listing. Condition number 2 is that should not be a banking company or insurance company or else financial institution. Condition number 3 is turnover should not exceed 50 crore. Condition number 4 is that deposits or borrowing shall not exceed 50 crore. Condition number 5 is that should not holding or subsidiary of any other non-SMC. Next, partial exemption is AS 17, 15, 19, 10, 20, 20, 29 and fully exempt AS 3. And other category non-SMC. Non-SMC means companies other than SMCs. For them every standard is applicable, no more exemptions. Coming to non-corporate, we have 3 divisions, level 1, level 2, level 3. Now let's focus on when to call one entity is a level 1 entity, when to call one entity is a level 2 entity, when to call one entity is a level 3 entity. Focus. Level 1 entity. Yeah, actually you have to observe or understand one thing. So in corporate we are going to discuss only companies. Coming to non-corporate, we are no more. We have to discuss other than companies, non-companies. Okay, no more companies here. So first one, level 1 entities, non-company entities. That means remaining entities: sole proprietorship, partnership, HUF, AOP, BOI, society, trust, LLPs, all those entities. Non-company entities which fall in any one or more of the following categories at the end of relevant accounting period or classified as level 1 entities. So if any one of the below conditions are satisfied, which should be non-company, then that is called as a level 1 entity. So let's see what are those 5 conditions. Entities whose securities are listed or in the process of listing on any stock exchange in India or outside India. Here also same, but here this is different. Non-company, if their securities or debentures are listed or in the process of listing either in India or else outside India, that is called as a level 1 entity. Second condition, that is a bank or FI or insurance. Generally, bank, FI or insurance are not covered under SMC, they are covered under level 1 entities. Point number 3, all entities engaged in commercial, industrial or banking business activity whose turnover exceeds 250 CR. So in SMC they have given a negative thing, negative condition, that means you should not exceed 250 CR, but here if exceeds 250 CR, that is called level 1 entity. Next one, similar to the SMC, their condition number 4 is so if their borrowings or deposits exceeds 50 CR, then they are not called as a SMC. If they are less than 50 CR, we have to call it as SMC. Here reverse. If their borrowings deposits exceeds 50 CR, then they will call it as a non-corporate entities. Next one, holding and subsidiary of any of these 4, that is also covered under level 1 entities. That means these all 5 points are similar to SMC conditions. Okay. So what is applicability? Level 1 entities are required to the company in full with all of the accounting standards. So we have to follow all accounting standards. However, AS 21, 23, 25, 27 will apply based on regulatory requirement. So generally for level 1 entities, all accounting standards are applicable, but AS 21, 23, 25, 27. Do you remember AS 21, 23, 25, 27 names at least? AS 21 is consolidated financial statements, AS 23 investments in associates, AS 25 interim financial reporting, AS 27 joint venture. So all these are subject to condition they will apply based upon related requirement. For level 2, non-company entities which are not level 1 entities but fall in any one of the following categories. There, how to call one entity is a level 1 entity, that should be a non-company, and if their turnover exceed 250 crores or else borrowing exceed 50 crores. Here, if the turnover is in between 50 crores and 250 crores, or borrowings 10 crores to 50 crores, or any of holding or subsidiary of above 2, that is a level 2 entity. What is the difference between level 1 and level 2? In level 1, they have given directly turnover exceed 250 crores, or else borrowings and deposits exceeds 50 crores, or else if it is satisfied their holding or subsidiary. Here what is the condition in level 2? Turnover is in between 10 to 50, turnover is in between 50 to 250, and borrowings or deposits should be in between 10 to 50. If this is satisfied, it is called as a level 2 entities. Let's see what are the applicable standards for level 2 entities. Level 2 entities are required to comply with all accounting standards except the following: AS 21, 23, 25, 27, similar to level 1 entities. AS 21 is consolidated financial statements, AS 23 is investments in associates, 25 is interim, 27 is joint venture. Similar to level 1, here also it is not applicable, subject to regulatory requirement. AS completely not applicable 3, 17, 20. So AS 3, 17 and 20 is completely non-applicable. Okay, 21, 23, 25, 27 is based upon regulatory requirement, and 3, 17, 20 is not at all applicable. And last one, AS applicable with disclosure and other exemptions are there, 15, 19, 28, 29. So 3 cash flow is not applicable, 17 and 20 is also not applicable. Okay, 20 is EPS is not applicable. Coming to level 3 entities. So till now we covered level 1 and level 2. In level 1, so turnover is more than 250 crores. In level 2, 50 to 250. In level 1, borrowings are more than 50. In level 2, 10 to 50. Next category, level 3 entities. Non-company entities which are not covered under either level 1 or level 2. So here, turnover 10 to 50, deposits 2 to 10 including borrowings. So for them, applicability comply with all accounting standards except 21, 23, 25, 27 subject to regulatory requirement. Not applicable standards here also 3, 7 and 18, 20, 24. So 2 more standards are added, 18 and 24. Applicable disclosure requirement 10, 11, 15, 19, 28, 29, similar to the level 2. Okay, so level 4 other than level 1, 2, 3. So here AS 14, 21, 23, 25, 27 regulatory requirement not applicable as per level 3, similar to level 3, 3, 7, 18, 20, 24, 28. And disclosure requirement 10, 11, 13, 15, 19, 22, 26, 29. So now you have to understand one point very clearly when to call level 1, level 2, level 3 and level 4. So let's try to draw the chart for entire this particular concept. Okay. Yeah. Am I okay now? Yeah. So, total entities we have divided into 2 categories. What are those 2? Corporate non-corporate. Coming to corporate, again 2 division, SMC, non-SMC. Coming to non-corporate, 3 categories, level 1, level 2, level 3. When to call SMC, 2 criteria is there. Actually, for SMC, they have given list. Turnover does not exceed 250 CR. Second one, borrowings or deposits shall not exceed 50 CR. and some other conditions are there. I am not focusing on it. Okay. Some more conditions are there. That should not be bank, insurance. So I'm not focusing on it. Let's focus on that numbers. So non-SMC means other than SMC, right? Next one, levels. Level 1. When to call level 1? Turnover exceed 250 crores. Next one, borrowings or deposits exceeds 50 crores. Level 2, turnover 50 crores to 250 crores, borrowings or deposits 10 crores to 50 crores. Level 3, turnover 10 crore to 50 crores, borrowings or deposits 2 crores to 10 crores. Level 4, other than level 1, 2, 3. Okay? Super. You can copy it. I'll give you time. Done. Yeah, I think it's done. Yeah. So till now we had a discussion about what is accounting standard, all those things. So actually accounting standards are given by the our ICAI with the assistance of our government obviously. So similarly India has our accounting standards, US has their own standards, UK has their own standard. Each and every country has their own set of accounting standards. But whenever this from the last decade, if you observe, so there is huge change in global economic scenario because we need foreign investments, foreigners need our investments. So finally, we opened our doors for foreign direct investments, FDIs. So that is the reason. So we can invest in foreign companies, foreigners can invest in our companies. But whenever if you want to invest in another company or other person want to in our company, so they are not, that is not easy to understand their financial statements or for them our financial statements, because for our financial statements are completely prepared as per our accounting standards, as per our GAAP. US companies statement prepared as per their accounting standards or their rules and regulations. Okay, so this is the reason there is some little bit of difficulty to compare this particular kind of financial statements. So that is the reason India has to rethink once. So the rethink is about, does our accounting standards are enough to compare or to compete with the global environment? Then we realized one thing, that our accounting standards are not enough to compete with the foreign companies. So actually, every country has their own currency. Just like India has a rupee, America has dollars, Singapore has Singapore dollars, euros, Japan has Japanese yen. So UK has pounds. So this kind of currencies are there. Even though out of n number of currencies, so we'll give more importance to dollars just to compare with it, like similar to dollar. So out of n number of standards, there is some universal accepted standards are there. So they are IFRS. IFRS are universally accepted standards. IFRS means International Financial Reporting Standards. So IFRS are universal accepted standards. So first of all, try to understand one thing. Accounting standards are applicable only in India. IFRS are followed by this n number of countries. First of all, why we need to discuss IFRS, all these things we are going to learn after this. First of all, let's focus on what is IFRS. Similar to our accounting standards, we have IFRS. So let me read the entire list of IFRS. So IFRS 1 is first time adoption of International Financial Reporting Standards, IFRS. IFRS 2 is share based payment. IFRS 3 business combination. IFRS n number of standards are there. So from 1 to all these standards, and somewhere we can observe IAS as well. So up to 41 we have some standards IFRS. These all standards are not intangible assets of India, because they are prepared by some foreign people or foreign governments or foreign bodies. So these IFRS are not at all related to India. But to compete with the global present scenario, definitely we need to comply with the IFRS. But as a India, we didn't converted or we didn't take an IFRS directly. Instead of taking directly, actually we have taken IFRS as a base. After that, for that base, we have modified little bit. That means that is called converged. Converged means we didn't convert it directly. we have taken IFRS as a base with little bit of modification, like have changed the names and slightly some minimum modifications are there, minor modifications are there whenever it is required as per our India requirements. So with that conversion we came up with a IND AS. That means IND AS, Indian Accounting Standards, are converged from IFRS. So that's why IND AS are called converged standards. So we have not taken directly IFRS. We are not following IFRS directly. So we can follow IND AS. IND AS are almost same as IFRS. If you are preparing or if you are knowing IND AS, that means you are preparing IFRS as well, because 95% content is same. Even in some standards 100% content is same. There are some minor modifications over there. In some standards there is not at all any modifications. You can directly reading IFRS. But in India we can't apply IFRS directly. Instead we are applying IND AS. IND AS full name is Indian Accounting Standards. IND AS or convergent standards from IFRS. So try to understand one point very clearly. AS is different, IND AS is different. AS means accounting standards, IND AS means Indian Accounting Standards. IND AS are converged from IFRS. IFRS full form International Financial Reporting Standards. So that's why IND AS are called convergent standards. Okay. Yeah. This is enough for this class. Will continue in the next session, or else I will add that video to this particular video. Okay. Thank you. Bye. We'll meet tomorrow.
Okay. In last session, we had a discussion of types of entities with respect to applicability of accounting standards. Just I want to revise the new notes. So for applicability of accounting standards, first of all we need to know one thing. So first of all we have a bifurcation about types of entities for applicability of accounting standards. So we have two types of entities. One is corporate entities, second one is non-corporate entities. In corporate entities again we have two types, SMCs, second one is non-SMCs. SMC stands for small and medium companies, non-SMCs are other than small and medium companies. Second one, non-corporate entities. Under non-corporate entities we have three categories. One is level 1, second one is level 2, third one is level 3. So in previous session already we covered this discussion, but I'm just revising the entire thing. So first one, small and medium companies. Sir, when to call one entity as a small or medium company, or when to call one entity as a level 1 or level 2 or level 3 entity? So let's focus on one by one. Okay. First one, small and medium companies. So when you have to call one company as a small and medium company, so we have some criteria. So if only this any one of criteria is satisfied, then we can call that entity as a small and medium companies. Then otherwise the remaining companies are not comes under small and medium companies. First one, equity and debt securities are not listed or not in the process of listing. That means all listed companies are not comes under small and medium companies. Second one, sir, if one company is there, for example XYZ Limited company is there, but that company is not a listed company, but that company is applied for listing, it is in the process of listing, then also that company is not a listed company. That means if your company is a listed company or else company is in the process of listing, your company is not called as a small and medium companies. Second one is not a banking company, insurance company and financial institution. If your company or your entity is a banking company or insurance company, then your company is not comes under the category of small and medium companies. So if you want to call any company as a small and medium company, that company should not be a banking company or insurance company or else a financial institution. Number 3, turnover in preceding year does not exceed 250 crores. Turnover means sales that means principal revenue, not only sale of goods, it might be revenue from principal activities. If it is a service entity, revenue from rendering of services. Next one, if the turnover exceeds 250 crores, that means your company is not comes under the category of small and medium companies. Next one, borrowings exceeds in preceding year to 50 crores. That means if your company borrowings nothing but loans or else any deposits from the public, if exceeds 50 crores, your company is again disqualified to call as small and medium companies. Last one, should not be holding or subsidiary of non-SMC. For example, your company is completely qualified for small and medium companies as per the above 4 conditions, but the problem is your company is a holding company of some non-SMC, or else if your company has a subsidiary which is non-SMC, then you also disqualified to be a SMC, then you also non-SMC. Okay, so for these exemptions are partially AS 17, 15, 19, 20, 29 subject to regulations, and AS 3 is completely not applicable for small and medium companies. So this is all about small and medium companies. Sir, how to remember all these contents are very easy. So the 2 are theoretical conditions, remaining 2 are what you call quantitative numbers, and 1 is general point. The first one is it should not be listed or not in the process of listing. Second one is it should not be a banking company or insurance company or institution. Third one is your turnover does not exceed 250 crores and borrowing does not exceed 50 crores. Last one is it should not be a holding or subsidiary of some non-SMC. So this all data about small and medium companies. Sir, what is non-SMC then? Very simple. Other than SMCs are called non-SMCs. Nothing more than that. Okay. For non-SMCs, all accounting standards are applicable. For SMCs only, these are partial exempted. This is fully exempted. So this is all about corporate sector, SMC and non-SMC. Now come to the non-corporate sector. There we have level 1 entities, level 2 entities, level 3 entities. Sir, first of all, what is the difference between corporate and non-corporate entities? Corporate entities means companies. Non-corporate is other than companies. Okay, till now we covered corporate sector. Let's move on to the non-corporate sector. There we are going to learn about level 1, level 2, level 3 entities. Sir, when to call one entity as a level 1 entity? Let's see. So level 1 entity. So first of all, you have to remember one thing. Level 1 or level 2 or level 3, these 3 entities are only applicable for non-corporate entities. So this terminology is not meant for corporate entities. So first of all, whenever you want to call one entity as a level 1 entity or level 2 entity or level 3 entity, first of all you should remember one thing, that should be a non-company or non-corporate entities. Then we have to check the following criteria. First one, again same, equity or debt listed or in the process of listing. There we have discussed that if that is a listed company or in the process of listing, that is not qualified for SMC. Here if that is listed or in the process of listing, then that should be a level 1 entity. Second one, banking company, insurance company and financial institution. There we discussed that that should not be a banking company, that should not be an insurance company, that should not be a financial institution. Now that is exactly opposite. If it is a banking company or insurance company or else a financial institution, then that should be called as level 1 entity. Number 3, turnover in preceding year does not exceed 250 crores, does exceed 250 crores. That means in corporate SMCs, there we had discussed that if turnover is exceed 250 crore, that is not qualified for SMC. But here, if your turnover exceed 250 crores, then your company, your entity will be called as a level 1 entity. Next one, borrowings in preceding year exceeds 50 crores. In SMC, we discussed that if borrowings does not exceed 50 crores, then only your entity is a corporate SMC. But here, if your borrowings exceed 50 crore, then you will be called as level 1 entity. Last one, holding or subsidiary of above 4 things. So if any, for example, one entity is there that is a non-corporate entity that is not in the process of listing and that is not a listed entity. Second one, that is not a banking company, not an insurance company, not a financial institution, and their turnover also does not exceed to 50 crores, and borrowings also does not exceed 50 crores. Even though all these 5 conditions are not satisfied, still that entity can become a level 1 entity if that is a holding or subsidiary of the level 1 entity. Clear? Next one, level 2 entities. Coming to level 2 entities, again same, non-company entities. Turnover in preceding year exceed 50 crores but does not exceed to 50 crores. For level 1 entity, turnover exceed to 50 crores, but for level 2 entity, turnover is in between 50 and 250. Borrowings 10 and 50, and if these are not satisfied, holding or subsidiary of level 2 is also level 2 entity. So in level 1, turnover limit is 250 crores and borrowings are 50 crores. In level 2, turnover limit is 50 to 250, borrowing limit is 10 to 50. The last one, level 3 entities. In level 3 entities, non-company entities again, turnover in preceding year exceeds 10 crores but does not exceed 50 crores. Here turnover limit is 10 to 50, borrowings 2 to 10. Level 4 entities other than level 1, 2 and 3. And let me try to summarize all those what you call threshold limits in single chart. For example, okay, am I clear? Yeah. In SMC, they told us that should not be a listed company, not in the process of listing company. Second one, that should not be a banking company, insurance company, financial institution, and I think yeah, now it is okay. Number 3, financial institution. Number 3, turnover. First of all, turnover should not exceed to 50 crores. Number 4, borrowing shall not exceed 50 crores. Coming to level 1 entities, they said listed entity is okay, process is also okay, banking company is also okay, insurance is also okay, at the same time FI means financial institution is also okay. Coming to limits, if turnover exceed to 50 crores or more. Number 4, borrowings 50 crores. This is level 1 entity. Level 2, turnover 50 to 250, borrowings 10 to 50. Level 3, turnover 10 to 50, borrowings 2 to 10. Level 4 other than level 1, 2 and 3. So this is all about level 1 entities, level 2 entities, level 3 entities. Okay, actually if possible write a chart on your own, then you will easy to remember it. Okay, yeah. Next one, already you know that we are discussing chapter called accounting standards. My dear students, remember one thing. So in this chapter, in our CS executive syllabus, even though we have accounting standards chapter, but in detail they have not covered all accounting standards. For example, they have not given what is AS1 all the content, AS2 all the content. They have not given all those details. They have just given overview of accounting standards. That means what AS1 is, what AS2 is, what AS3 is, like that. So in this chapter, in our syllabus CS executive, we don't have in detail accounting standards. So I think as per my analysis, I understood one point that they want to just convey that we have accounting standards. That's it, nothing more than that. Okay, just we have to remember what is standard number, what is standard name. At the same day, what this standard is meant for, why this accounting standard is. Okay, so next couple of minutes we are going to discuss a total overview of accounting standards. Already I think you know that we had a discussion total accounting standards list. We have AS 1 to AS 29. Actually in your CMA or CA, there they will discuss each and every standard in detail, but as of now in our CS executive we don't have all the standards in detail. They have given just an overview of all accounting standards. Okay, now let me discuss one by one. Before entering into the AS standards, try to understand one thing: we don't have all the content in detail. Just they have introduced accounting standards, that's it. That means our board ICSI wants to convey to the student that we are following accounting standards, and they'll also discuss about Indian accounting standards as well. In your final level there will be detailed discussion of Indian accounting standards. Fine. So as of now I'm going to discuss all accounting standard from AS 1 to AS 29, just overview. Here I am not going to solve any single problem on any accounting standards. If you people from CMA or CA background, if you feel that accounting standards are very easy in problematic part, you have to feel very happy. Why? Because here no need of any problematic part in accounting standards. Just we are going to discuss all accounting standards overview, that's it, nothing more than that. Okay, come on. So first one, AS1. AS1, the full name is disclosure of accounting policies. So the accounting policies disclosure. Now just I want to tell you 3 to 4 lines about this AS1. First of all, try to decode the name of the standard. Disclosure is one important word. Second one is accounting policies. Sir, what is the meaning of disclosure? Disclosure means we have to, that means giving information. That is the meaning of correct meaning of disclosure. Giving information to others. Generally, companies how they will give information to the public. They can't give information everybody through WhatsApp or else text message. No. So generally they will give information to all the public or investors in writing only. That may be through mail or else any kind of public document, whatever it is, but it should be in written format only. Here in this context, disclosure means giving written information to others. That is the meaning of disclosure. Okay, next one. Accounting policies or specific accounting principles. Okay, these are the specific accounting principles and methods of applying those principles adopted by an enterprise in the preparation and presentation of financial statements. First of all, do you know what is the meaning of financial statements? Then we'll discuss about what is accounting policies. I am damn confident majority of the students who are watching this video, I think you are not aware of complete data about financial statements. Okay, I think some of you may say, sir, it includes balance sheet, P&L account, cash flow statement, that's it. But in reality, we have 5 financial statements. So what are the 5 financial statements? Anybody? If you know all those financial statements, just pause the video and give your opinion in our chat box or comment section if this video is uploaded on YouTube channel. Tell me, what are the financial statements? We have 5 statements. First one is balance sheet. Second one is income statement, nothing but a P&L account. Third one is cash flow statement. Fourth one is notes to accounts. The fifth one is, I think majority of you not even had this word, that is I call this statement as SOCI, but the full name is statement of changes in equity. These 5 statements are put together called financial statements. So while preparing your balance sheet, your P&L, your cash flow, your statement of changes in equity, your notes, whatever principles you are followed or whatever your methods you are followed by entity, those methods or policies are called, the principles are called accounting policies. Accounting policies are principles or methods of those principles applied by the entity in preparation and presentation of financial statements. What is the meaning of financial statements? It includes balance sheet, income statement, P&L account, cash flow statement, notes to account, statement of changes in equity. Okay, actually while I am teaching CA intro or CM intro, there I had a couple of hours discussion on this AS1, but here no need of that much of discussion. Just we have to give overview about what is total AS1 is. Okay, second one is all significant accounting policies should be disclosed. First of all, what are the examples for accounting policies? Very easy, my dear students. Accounting policies like methods of depreciation. Some people follow SLM, some people follow WDV, or cost. Some people follow cost method, some people follow what you call revaluation model as per AS10 or in AS16, whatever it is. So whenever you followed accounting policies, definitely every entity should follow accounting policies. Out of your accounting policies, if you feel that accounting policy is significant, significant means important, all significant accounting policies, all important accounting policies should be disclosed. Disclosed means you have to give information in written to all the users through public document. That is called significant accounting policies should be disclosed. The last one, no need to disclose fundamental accounting assumption. Actually, point number 3 is quite contrast to the point number 2. In point number 2, this says you have to disclose all accounting policies. In point number 3, they are again saying no need to disclose some accounting assumptions or some accounting policies. What are those? Actually, every entity has to follow accounting policies for sure. Accounting policies means what are the principles they are following in preparation and presentation of financial statements. So listen, my dear students, even though every entity is following some accounting policies, no need to disclose them separately. They are fundamentally accounting assumption. What is the meaning of that fundamental accounting assumption? That means even though if you not disclosing it, everybody feels that you are following that accounting policy. Just I will give you an example for it, then you may get a little bit of confidence on this concept. For example, all of you students who are in front of me, so even though if you not sir, for example, this person is standing and this person, the student says, sir, I have notebook, I have pen, I have calculator. No need to communicate specifically you have calculator, you have notebook and you have pen. Why? Because whenever a CS executive student come into the class, that means that means he is holding notebook, calculator and pen. They are basic things, no need to tell specifically. For example, if he brings some smartphone or else something new, then he has to convey us. That is not a basic thing, common thing. So like that, in every entity, 3 accounting policies are there. Even though they followed them, no need to convey them. If they have not followed it, they have to convey. For example, if the student is not bringing or is forget to bring calculator, he has to convey that. Otherwise, there will be lot of what you call there will be what you call, the correct word is there will be what you call consequences. Yeah, correct word. There will be a very bad consequences. Okay, you have to face that. That is the reason. So what are those fundamental accounting assumptions? There are 3 assumptions. They are GCA. What are those? GCA are called fundamental accounting assumptions. G for going concern, C for consistency, A for accrual. These 3 are every entity should follow: going concern, consistency, accrual. Even though you are following all these 3, no need to tell us separately, sir, we are following going concern, so we are following consistency, sir, we are following accrual. That means they are impliedly you are following. That means Okay, sir, if you are not following going concern, if you are not following consistency, if you are not following accrual, please convey us. Okay, so that is all about AS1. What is AS1? Disclosure of accounting policies. So the standard number AS1. What is the meaning of full form of AS? AS means accounting standard. So this standard discussing about how to disclose accounting policies. What is the meaning of disclosure? Disclosure means giving information in written to someone else. What is the meaning of accounting policies? Accounting policies are specific accounting principles and methods of applying those principles adopted by the entity in preparation and presentation of financial statements. Point number 2, all significant accounting policies you have to disclose in your financial statements. Significant means important, but still if you are following some accounting policies, no need to disclose. Why? Because they are fundamental accounting assumption. That means if any entity is preparing their financial statements, that means they are following these fundamental accounting assumptions. What are those, sir? GCA. G for going concern, C for consistency, A for accrual. These three are called fundamental accounting assumptions. Okay, this is all overview about AS1. Let's get into the next standard. Sir, is it enough for AS1? Is that much easy? No. Just I told you, here I am going to discuss only overview of accounting standard. We are not going to cover in detail about AS1, but I promise you I am covering all important content of AS1, even though some matter is not conveyed in our board book. Okay, yeah, that's it. Let's move on to the next standard, that is AS2, valuation of inventories. So before entering into this standard, just I want to give an example, then you will get more clarity about the standard, that is AS2, valuation of inventories. Okay, just give me 1 minute. For example, there are two business organizations. Number one is my business, Varma is running one business. Second one is some other person, for example Ram, is running another business. Okay, fortunately both of us started business on same date, and our business is also same product, same quality, same supplier, but different customers. Okay, for example, in year beginning I bought 100 goods, Ram also bought 100 goods from same supplier. So cost is also same, 100 into 100, for him also 100 is cost. Okay, during the year I sold 60 goods, he also sold 60 goods. Unfortunately, selling price is also same. My selling price is 150. At the same time, Ram selling price is also 150. Okay, that means at year end I am holding 40 goods in my closing stock. Ram is also holding 40 goods in his closing stock. Now year is completed. No, it is a time to prepare financial statements. So in my balance sheet, or else in my trading account, or you can say trading and P&L account, anything is okay for me. In trading and P&L account, I have to write by closing stock. At the same time, in Ramu trading and P&L account, they are writing by closing stock. But tell me, each of us, so I am holding 40 goods as my closing stock, and Ram is also holding 40 goods as closing stock. Now the point is, in my P&L account, I should not record number of goods. I have to record amount of that goods. So actually, my opinion says, as in my perspective, I stick on to one point that, sir, anyway, even though I am holding 40 goods, what is the cost of that 40 goods? 100 only. So I recorded 40 into 100, 4,000. That is my perspective. So in my perspective, I am holding 40 goods. What is the cost of that 40? 40 into 100, 4,000. That's my closing stock. Now coming to Ram books, in Ram books, so he is also taking his closing stock as 40 goods, but his intention is, his thought process is, I am holding 40 goods, but if I sell these 40 goods, I will get 150, no? So 40 into 150, so he recorded 6,000. So if you observe, I recorded 4,000, Ram recorded 6,000. Everybody is correct in their perspective. My perspective is, I am holding 40 goods, its cost is 100 rupees only, 4,000. His perspective is, even the cost is 100 rupees, if I sell, I will get 150, no? 40 into 150, am I right? No? 40 into 150, 6,000. If everything is same, what is going to happen? If his closing stock is more, definitely his gross profit will increase. For example, sake, if nothing is there, only sales is for example 2 lakhs. If there are no other expenditure, only for example sake, my gross profit is 2,40,000. His gross profit is 2 lakh. Sorry, this is 2,04,000. This is 2,06,000. Definitely his gross profit will be more than my gross profit. It impacts net profit as well. Net profit is more than my net profit. If you show this trading and P&L or balance sheet to a layman, they will understood that Ram's company is more better than Varma's company. That means in their perspective, Ram company is performing better than Varma's company. But what is the reality? We both are performing in the same manner, in fact same purchase price, same selling price. Then why there is difference of gross profit and net profit? The reason is very clear. I am following a cost model, he is following selling price model. That means we can't compare these two at a time. So this is the main reason. So if you want to compare these two companies, definitely both Varma and Ram both should follow single method. Either Ram should follow cost method like Varma, or else Varma should follow selling price method like Ram. Then only we can compare two companies. So that is the reason. So we have to accept one thing. There is a need for one particular rule. That rule should be followed by every person. Then AS2 comes into the picture, valuation of inventory. AS2 says one regulation, everybody should follow that regulation. Now Varma contract 4,000, Ram contract 6,000. Both the people should follow AS2. Sir, what AS2 says? Let's wait for some time. So let's check what AS2 says. I'm just telling you what is the background of AS2. What is the background of AS2? All this background of AS2. So this is the reason for come up of AS2. Okay. Now let's check what AS2 overview. Yeah, I think notes is good, no? So I spent a lot of hours on it to prepare notebook in this much better way. Yeah, AS2, valuation of inventory. So first of all, you should understand one point. Generally, inventory means what student thinks that. Student thinks that inventory means closing stock. No, that is not at all correct. Of course, closing stock only, but what student feels inventory means, so we bought some goods, out of those we sold some goods, whatever the remaining is called closing stock. But no. So inventory means not only finished good. It may be raw material or work in progress or finished good. All these are called inventory as per AS2. So in previous example, I think where it is? Yeah. In this example, I followed cost, he followed selling price. What AS2 says, this is AS2 provision as per AS2. So AS2 says you have to value your inventory. Inventory should be valued at cost or NRV, whichever is lower. So that means both Varma and Ram both are wrong. So Varma followed cost model, Ram followed selling price, both are wrong. What AS2 says? AS2 says you have to write cost or NRV, whichever is lower. What is the meaning of NRV? We'll discuss later. So first of all, let's focus on what is the cost of inventory. Cost of inventory includes three things: cost of purchase, cost of conversion, other cost. So what is the meaning of cost of purchase, cost of conversion, other cost? We'll discuss now. So first one, cost of purchase. Cost of purchase means your purchase price plus or taxes. But remember, while you are adding taxes, you should add only taxes if they are non-refundable. If there is any taxes which are refundable, you should not add to your cost. Why? Because if you are added to your cost of inventory, in future you are getting back, there is what you call inflation in cost of inventory. That is not correct. You can add your taxes, whatever you are paying on that particular goods or assets, whatever it is, but subject to condition that should be a non-refundable. Sometimes we have to pay some tax on it, but we know that is refundable after a couple of months or couple of 6 months or 7 months, or even sometimes 1 year. You should not add that taxes to your cost. If you know that is a refundable taxes, that means you should add only non-refundable taxes. At the same time, any other directly attributable cost. What is the meaning of it? Any costs which are incurred to bring that goods into the present location or condition. Next one, cost of conversion. Cost of conversion means sometimes some entities are manufacturing entities. I think you know, in business there are two types of entities. One is trading entity, second one is manufacturing entity. Trading entity means they'll just purchase and sell the goods. Manufacturing entity means they will purchase the raw material, they convert that raw material into finished good. So whatever you are incurring on conversion, that might be variable overhead or fixed overhead, anything, whatever you are incurring, that comes under cost of conversion. That is also includable cost. Last one, other cost. Apart from this thing, if you have incurred any cost which are other than cost of purchase and cost of conversion, they are also form part of cost of inventory. Okay, so here inventory should be valued at cost or NRV, whichever is lower. Here cost means all these three things. What are those three? Cost of purchase, cost of conversion, other cost. Okay, next one, what is the meaning of NRV? Sir, first of all, the full form of NRV is net realizable value. Sir, what is the meaning of net realizable value, sir? Very easy, sir. For example, I want to sell this particular asset, or for example, I want to sell this mobile to you, not to you, to some other person, but I can't sell this to people directly. So actually what can I do? I may appoint one person to sell this mobile to someone else. For example, if I expect to sell this mobile, I am estimated that my estimated selling price is 10,000, but I know that I have to pay commission to my agent. That is called estimated selling commission is 2,000. That means net I receive only 8,000. So this 8,000 is called net realizable value. Net realizable value means in net how much you are receiving or realizing. First of all, try to remember one thing. NRV is not a present selling price, it is a estimated selling price minus estimated selling cost. This is the formula for NRV. What is the formula? Estimated selling price minus estimated selling cost. Actually, AS2 has very in-depth concept is there. we have beautiful problems in a accounting standard in actually AS2 content, but unfortunately in our executive syllabus we don't have that in detail content. So just already I told you in AS1 discussion we have just overview of AS all accounting standards, but AS2 says inventory should be valued at cost or NRV, whichever is lower. What is the cost? It includes three things: cost of purchase, cost of conversion, other cost. What is NRV? Net realizable value. What is net realizable value? Estimated selling price minus estimated selling cost. That's it. Okay, very good morning. I think in yesterday's session we covered overview of AS1 and AS2. Now it is time to enter into the AS3. So AS3 is discussing about cash flow statement. Okay, yeah, cash flow statement. So again, before entering into AS3, just I want to convey concept along with an example, just like AS2, then you will get more clarity. Or else okay. Now I am showing you one balance sheet which is on your screen. Observe the balance sheet very carefully, at least for 30 seconds. You have balance sheet on your screen. Observe the balance sheet at least for 30 seconds. Okay, is it visible? Yeah. Or else I will close the camera to observe it. Just observe it, that's it, nothing more than that. So ABC Limited balance sheet is there. On liability side, share capital, reserves and surplus, non-current liabilities, current liabilities. On asset side, land, building, plant and machinery, furniture and fixtures, cash. Okay. Now I will show you another company balance sheet. Please observe that balance sheet also for 30 seconds. Yeah, this is XYZ Limited balance sheet. Observe it. Okay, now tell me, so out of these two balance sheet, actually both are looks almost same. Share capital, reserves and surplus, everything is same except cash. Now only focus on cash. So ABC Limited cash is 25 lakh and the cash of XYZ Limited is 125 lakh. You tell me, my dear students, if you are in a place to decide, for example, you want to invest some 1 lakh rupee in shares of one company. Tell me, as a qualified CS, you tell me, will you choose ABC Limited or XYZ Limited? Tell me. Definitely, everybody says, sir, XYZ Limited is better than ABC Limited, sir. Why, sir? Sir, remaining all are almost same as ABC Limited, but if you compare cash, in ABC Limited they have cash only 25 lakh, in XYZ Limited they have 125 lakh. That means in XYZ Limited they are holding more cash than ABC Limited. So that is the reason. So XYZ Limited is better than ABC Limited. Of course, your answer is absolutely 100% correct. But I'll tell you one more fact about these two companies. Then let's check your answer may get changed. So what is that fact? Let's see. So of course this ABC Limited cash is 25 lakh only. This entire 25 lakh they got only from sale of goods. They sold goods and they got that cash. This 125 lakh in XYZ Limited, through sale of goods their revenue is zero in that particular year. That means nobody purchased even single rupee goods from XYZ Limited. This 125 lakh cash they got from bank loans, and they sold some assets, and they issued debentures. If we ignore debentures or loans, they sold assets, then they got that much of money. Now tell me, which company is better? Obviously ABC Limited. Why? Because they, even though they got 25 lakh only, they don't sell any kind of assets, or they have not gone for any kind of loans or debentures. So definitely if you sold assets, how can you survive in the future? That is not at all practically possible. So that is the reason now XYZ Limited is better than ABC Limited. So they sold the goods to get this 25 lakh, but one second. Yeah, but here total 125 lakh is not from sale of goods. They have sold all assets. So this is the reason. So ABC Limited is far better than XYZ Limited. Okay, sir, because this is my example, I have given all those facts. But if it is a company just like Reliance or Tata or some other companies, in such companies they can't tell to each and every person, please come my dear shareholder. So this is the scenario. They can't explain to each and every person. So that is the reason. So this is the area where we need some kind of standard. So that's where AS3 comes into the picture. So what AS3 says, so even though in every balance sheet cash is a very important item, so how cash is coming to the business and how cash is goes out from the business, so these two are very important for any business entity. So that is the reason we have to, that means every company has to prepare one statement called cash flow statement, where we have to record how cash inflow incoming to the entity, how cash outgoing, or how cash inflows, how cash outflows. Inflows means incoming to the entity, outflows means outgoing from the entity. Okay, so next one, that means simply what can I say, we have to prepare one statement where we are going to write all cash inflows and all cash outflows. But what is in practicality? In practicality, we should not write all inflows and outflows. We have to divide entire activity into three categories. What are those three categories? They are they are divided into three categories. One is operating activities, second one is investing activities, third one is financing activity. Actually this standard has lot of data, but already I told you in yesterday's session as well. So in our CS executive syllabus there is no need of in detail accounting standard knowledge. They have just given overall overview of all accounting standard. Okay, so with this last 5 to 6 minutes discussion, what you understood, what you should understand. So cash flow statement is why we have to prepare cash flow statement. This is a reason as well. Why should we prepare cash flow statement? I have given reason as well. Yeah, in balance sheet we can identify only balance of cash as on balance sheet date. But user means the person who are reading your finance statement cannot identify how cash inflows and how cash outflows to or from the business. That is the reason we have to prepare cash flow statement. Cash flows are two types: cash inflows, cash outflows. Cash inflows means how cash incoming to your company. Outflows means how cash outgoing from the company. Again, they have divided into three categories: total transactions or activities. What are those three activities? Operating activities, investing activities, financing activities. Okay. Now let's read the content in our material, our hand notebook. AS3 cash flow statement. Company should prepare a cash flow statement and present it for each period. So as per AS3, every company should prepare cash flow statement. If you remember, already I told you at the time of discussion of AS1, I told you what is the meaning of financial statements. It includes balance sheet, P&L account, cash flow statement, statement of changes in equity, and notes. Their cash flow statement is covered. No, that is the reason they have to prepare and present every year, each period. That is obligatory thing. Cash flows are two types: inflows and outflows. Already I told you, inflows means how cash comes into our business, outflows means how cash outgoing from our business. Next one, cash flows are divided into is divided into three categories. What are those three categories? Operating activities, investing activities, financing activities. So this is what AS3 is. Okay. Yeah. Sir, how to prepare cash flow statement? All those that is not formed part of our syllabus. Clear? Next one, next standard AS4. Let's discuss what is AS4. First of all, so AS4, the full name of AS4 is contingencies and events occurring after balance sheet. So same way as how we discussed AS2, 3. So let's also discuss AS4 along with background of the standard. So without knowing background of the standard or any chapter, if you enter into directly, that is not a correct way of learning. And by the way, if you observe all last previous classes from the day 1 to till now, all our theoretical concepts. Sir, our subject is corporate accounting and financial management. Okay. So actually, this AS4 is discussing or deals with two topics. One is contingencies, second one is events occurred after balance sheet date. First of all, what is the meaning of contingencies? Sir, contingencies means very easy. So its outcome is dependent on future events. So that's what I have given in notes as well. Contingency is a condition or situation, the outcome of which gain or loss will be determined on occurrence or non-occurrence of one or more future events. So, for example, one person filed a case against our company. So, I have to pay some. I may have to pay some amount to that particular petitioner. It will be decided on the judgment of the court of law. So that means if the judgment is in favor of me, no need to pay any amount. That is called contingent. That means it will be decided on the judgment of that particular court. That means contingency is a condition or situation that might be a gain or loss, but it is decided or determined by the either occurrence or non-occurrence of one or more future events. That is contingency. There, that's where we are discussing generally contingent liabilities and contingent assets. Next one, events occur after balance sheet date. Listen, already I told you financial statements. Financial statements includes balance sheet, P&L, cash flow statement, statement of changes in equity, and notes. Okay. So these all are public documents. Every company should release these financial statements to public as per section number 128 and 129. So whenever they have to release these statements to the public, they'll read it and they will decide whether to invest or not. So, for example, Reliance company is there. Tell me who will prepare balance sheet of Reliance company? Who will prepare P&L account of Reliance company? Who will prepare cash flow of Reliance company? Who will prepare soci of Reliance company? Who will prepare notes of Reliance company? Definitely employee. For example, his name is Mr. X, who is accountant of Reliance company. He will prepare. So Mr. X is an accountant of Reliance, so he will prepare balance sheet, P&L, cash flow, statement of changes in equity and notes. Definitely, after preparation of these statements, if they release these statements to the public, for example, in balance sheet of Reliance company, there is one big mistake is there. Okay, so if for example, if Varma as a shareholder of Reliance company, if I filed a case against Reliance company or Mukesh Ambani, then he will escape easily that, sir, I have not, my dear shareholders, I have not prepared this balance sheet. It is prepared by Mr. X, who is my accountant. So this mistake is done by the Mr. X. You have to take action against him. So I am nobody to do it. I'm not at all relevant related to this crime. That's how he can escape. So that is the reason Companies Act says, even though Mr. X prepared your financial statements, before they are releasing to the public, you have to approve those financial statements. That is called approval of financial statements. Who has to approve? Generally, it should be approved by the board of directors. If they approved it, then Mr. X is not at all liable. Then liability will be transferred from X to board of directors. Then they all are responsible for future consequences. Fine. Now, for example, Mr. X prepared their balance sheet as on, for example, that is for 24-25. That means balance sheet date is 31st March 25. So, but for preparing, it will take some amount of time, and finally, it is go for approval. That is called date of approval by the board of directors. Date of approval is on, for example, it is on 30th June 2025. That means that means my balance sheet date is 31st March. Date of approval is 30th June. In balance sheet, it shows some asset 10 lakhs. Okay, that is correct figure as on 31st March, but it is approved by the directors on 30th June. It is released to the public on 30th July. Okay, the problem is in between. For example, on 15th April, one biggest fire accident occurred and this total entire asset has been destroyed. Now tell me whether your balance sheet is correct or not. 100% correct. Why? Because this balance sheet as on 31st March only. As on that date, the asset was there, but the value is 10 lakhs, correct. But right now, on 15th April, that is destroyed. Now, my point is, so these financial statements are not yet released to the public. Now, tell me, is it necessary to change the figure to zero, or else keep it as 15 lakh? If you keep it as 15 lakh, definitely investors or shareholder may come into wrong notion that still that asset is with you. They may invest in your company, then definitely they will get loss. Second version, if you want to make it zero, but your balance sheet as on 31st March, as on the date the asset was 10 lakhs, how can you make it zero? So that is also not correct. So this is the area where AS4 comes into the picture. Okay, let's come to our notes. Events after balance sheet date or events occur between balance sheet date and date of approval. So just now I told you, 31st March and 30th June. In between, if anything happened, they are called events occurring after balance sheet. So what is the treatment? It's depend upon a few things. If it is adjusting event, non-adjusting event, all those things. But unfortunately, in detail, that is not covered in our syllabus of CS Executive. Okay, just try to understand what is AS4 and what are the topics it is covering. What is AS4? Contingencies and events occurring after balance sheet date. Contingency means it is a condition or situation, the outcome that might be gain or loss. It is dependent, it is determined or dependent on occurrence or non-occurrence of one or more future events. Second one, events occurring after balance sheet date. That means events occurring between balance sheet date and date of approval of financial statements. They are called events occurring after balance sheet date. This is all about AS4. Till now we covered 4 standards: AS1, 2, 3, 4. AS1 is about disclosure of accounting policies. What is the meaning of accounting policy? Accounting policies are specific accounting principles and methods of applying to the principles in preparation and presentation of financial statements. Second one, all significant accounting policies should be disclosed. Third one, no need to disclose fundamental accounting assumptions. Second category, AS2, valuation of inventory. Valuation of inventory. So inventory should be valued at cost or NRV, whichever is lower. Cost includes 3 things: cost of purchase, cost of conversion, other cost. And already I told you, while you are calculating cost of purchase, you should be very cautious with respect to non-refundable taxes. If it is refundable, you should not consider it. You have to consider only non-refundable taxes. Next one, NRV. NRV means net realizable value. What is the formula for it? Estimated selling price minus estimated selling cost. AS3, cash flow statement. Cash flow statement, just now we covered in the present class only. So every company should prepare cash flow statement and present for each period. So cash flows are 2 types: inflows and outflows. Again, they are divided into 3 categories: operating activities, investing activities, financing activities. Just now we covered AS4, contingencies and events occurring after balance sheet date. What is the meaning of contingency? Contingency is a condition or situation, the outcome of which gain or loss will be determined on occurrence or non-occurrence of one or more future events. What is meaning of events occurring after balance sheet date? That means events in between balance sheet date and the date of approval of financial statements. Okay, that is AS4. Next one, AS5. Next, AS5, net profit or loss for the prior period items and changes in accounting policies. Actually, this standard is pure theoretical standard, and in fact, this is not at all important even for CA and CMA level, including CS2. So actually this standard should be applied by the enterprise in presenting a profit or loss. Actually very easy to explain. So for example, normally in our academic purpose, we have to prepare P&L account and you will get net profit, no? But in reality, we have to show that net profit, what is from ordinary, what is from extraordinary activity. That means we have to show separately how much profit we earned through normal ordinary activities, how much earned through extraordinary activities. At the same time, if there is any prior period items or there any changes in accounting policies. Okay, not important, no need to focus more on it. AS6 is not there. Sir, AS1 we discussed, AS2 is also there, AS3 is also there, AS4 is also there, AS5 is also there. Next, I am moving on to AS7. Sir, what about AS6? Don't worry, my dear students. Actually, when I was a student, when I was in your place, I read AS6. AS6 was depreciation. Now it is removed. Why? Because when I was student, so AS6 was depreciation and AS10 was fixed assets. Now these two standards are merged while come up with a new standard called AS10 PPE. No more AS6 and AS10, they were merged with a new standard called AS10 PPE. AS6 was depreciation when I was student, AS10 is a fixed asset. Now these two standards are merged, come up with the AS10 only PPE, property, plant and equipment. Okay, yeah, that's why AS6 is no more. Now we have to discuss from AS7 onwards. Okay, yeah.
Okay, now the next standard is AS7 construction contracts. So this standard is specifically meant for who are in the field of construction. So listen, the objective of this standard is to prescribe accounting treatment of revenue and cost associated with the construction contract. For example, we are some L&D constructions, we are building some 5 floors or 10 floors building. So definitely a particular owner, they will give you money in installments. For example, we have completed first floor out of 5 floors building, but we have not yet received money. Sir, is it necessary to record as revenue after the completion of first year, or what? How to deal with all those? We will deal with the AS7 construction contract. Already I told you this standard is also a little bit interesting, but we no need to discuss in detail how construction contract treatment all and above. Okay, just are the executive CS executive syllabus. The main agenda of our board ICSA is to just to convey that we are going to discuss all accounting standard overview, but no need of in detail discussion of any standard. If you observe, till now we covered AS 1, 2, 3, 4, 5 and now 7 we are discussing. So even out of the 6 standard, we have covered only overview, but there is no detailed discussion about any standard. Next one, AS9 revenue recognition. Okay, this standard deals with the recognition of revenue in the statement of profit and loss. Here, revenue includes sale of goods, rendering of services, interest, royalties, dividend, etc. So, what is this standard about? I will tell you. Listen very carefully. Okay. So, for example, I sold goods on credit. Sir, one to record, sir. Whether I should record at the time of agreement, or else at the time of contract, or else at the time of physical transfer of goods, or at the time of receipt of goods, or at the time of payment of particular sales, when to record. All the things will be dealt by AS9 revenue recognition. For example, if I am rendering services, when to record as a revenue? Is it at the time of point of sale, or at the time of rendering of services, or after completion of services, or at the time of receipt of money? When to record is discussed by the AS9. Sometimes we are receiving some interest or royalties or dividend. If you are receiving anything, when to record? Okay, all these things is dealt by AS9 revenue recognition. Simply, the main agenda of AS9 is whenever a company is doing business that might be in trading sector or a service sector, if they are doing sale of goods or rendering of services, when to record or how to record is dealt by AS9 revenue recognition. Okay. Next one, AS10 property, plant and equipment. Okay, fine. So already I told you, when I was student, we have 2 standard. One is AS6, second one is AS10. AS6 was depreciation, now it is removed. AS10 was fixed asset. Now these 2 standards are merged and coming up with a new standard called AS10, that is PPE. PPE stands for property, plant and equipment. Okay. So that means in AS10 PPE, it covers both the standards AS6 as well as AS10. That means in this standard we are going to cover about fixed assets as well as depreciation. Okay. That means in this standard we can cover complete details about fixed assets at the time of purchase of asset and at the time of initial recognition and subsequent recognition, depreciation, all those things will be covered under AS 10. So what AS 10 says? AS 10 is discussing about PPE. PPE means property, plant and equipment. Maybe some of you may get doubt, sir, why we need to call it as a PPE instead of why can't we call it as a fixed assets? That is a genuine doubt actually. So actually before introduction of this new version of AS 10, we have another standard called AS 10 old standard fixed asset only. The reason for changing the name from fixed asset to PPE is very clear. This is because of Indian accounting standard in Ind AS 116. Ind AS 116, okay fine. So Ind AS 16 is PP, 116 is something else. So please just, so Ind AS 16 says, that started also discussing about fixed assets. There they have used the name called PE. Why? Because even for Ind AS the background is IFRS. So in IFRS they are literally using the word called PPE, property, plant and equipment. Instead of they are calling fixed assets, they are calling it as PPE. All foreign companies, including US, UK, all those companies, majority of the companies, they are following IFRS, International Financial Reporting Standards. Even we converted IFRS to Indian Accounting Standard that we are going to discuss later. So in AS 16 says PP. That is the reason AS 10 also modified slightly. They have modified the name from fixed assets to PPE. Now let's discuss what is the meaning of PPE. PPE full form property, plant, equipment. So what AS 10 says? AS 10 says PPE definition. It is a tangible items held for use. First of all, what is the meaning of tangible item? So if I ask this question, majority of my students generally says tangible means which can be seen and touched. My students, of course you are right, but you are not correct. You are right, but you are not correct. Why? Because sometimes interviewer asks this kind of questions like why, what is meaning of tangible assets? Students generally use it to say tangible assets means which can be seen and touched. That is okay, but does not looks like professional answer. So you have to say, instead of saying which can be seen and touched, you have to use one more word called assets which have physical existence. That is the correct word for the definition of tangibility. Okay. So tangible items means items which have physical existence. Of course, you can add that word later. So tangible assets means assets which have physical existence and which can be seen and touched. Held for using. What is the purpose of use? There are three purposes. First one, production or supply of goods or services. Second one, rental to others. Third one, administrative purposes. Only for these three purposes you can use any item if that is a tangible item, that is called PPE. Sir, I didn't understand what you are telling in the definition. No, don't worry, I will give clarification on each and every word. So PPE definition says it should be tangible item. What is the meaning of tangible item? Which should have physical existence and which can be seen and touched. Second one, held for use either in this or this or this. That means there are three purposes given by the standard. First purpose, production or supply of goods or services. That means if you are using any tangible item in your production or supply of goods or services, then that item should be called as a PPE. Sir, give me an example. Why not? For example, I am using this camera for recording these classes. So definitely I am using that camera for producing services. That is first condition. So this camera is called PP. I am using that AC for rendering services. That is also AC. Or else I am using this laptop for recording the class. That is also producing services. That is also PP. Second one, rental to others. If I am giving any asset as a rental to anybody, for example, if I am doing some rental business of laptops or else some computers, that computer or laptop is also a asset PPE because there is a tangible item, and the same way given rental to others. Third one, administrative purposes. That means I am not using that asset either for production or supply of goods or services or rental to others. I am using it for administrative purposes. Give me an example, sir. Sure. So, for example, I am using this computer for recording this lecture, that is for production of services. If I use the same computer in reception area, so that is not directly producing services, but I am using that computer for administrative purposes, that is also PPE. So, AS10 says PPE is a tangible items held for use in production or supply of goods or services or rental to others or administrative purposes. If these three purposes, if you are using that asset for these three purposes, then that asset is called PPE, property, plant and equipment. Sir, definition is okay, sir. What is the intention of AS10? AS10 objective is to provide accounting for PPE. How to accounting for PPE? All those things has been dealt by AS10. So actually, sir, I purchased a TV. What is the entry? TV account debit to cash or bank account. I purchased machinery. What is the entry? Machinery account debit to bank account. For example, I purchased a TV for 30,000 and for transportation from the particular shop to my home 2,000. Now what is the cost? 30 or 2 or 32? So that's what given by AS10. So whenever you are purchasing the asset, you have to record entry called asset account debit to bank. That is called initial recognition. At the end of every year, you have to depreciate it or revalue it. That is called subsequent recognition. Sir, how to do initial recognition? How to do subsequent recognition? AS10 says you should initially recognize your PPE at cost model and you should recognize your PPE subsequently at cost model or revaluation model, which is the discretion of the company itself. You can follow cost model or you can follow revaluation model, that is completely your choice. Sir, what is the meaning of cost model? What is the meaning of revaluation model? Cost model means, for example, on 1/2025, I purchased a TV. What is entry? TV account debit to bank account. Totally 32,000. This is called initial recognition. That means first time I am recognizing my asset. At the end of year, 31st December or April, no, 31st March 26, I have to do my subsequent recognition. Either I can follow cost model or revaluation model. Cost model means I have to do depreciation for it. Depreciation account debit to TV account. This is called cost model. For example, my depreciation is 1,000. What is my book value? 32,000 is original cost minus 1,000. In balance sheet, under asset side, TV 31,000. What is revaluation model? In revaluation model, they will not look for depreciation. They will go to the market. They will find the fair value of that TV. That means if I sell this TV, how much I will get? That is called revalued amount. So if they revalued their asset, if they got 30,000 is revalued figure, they will write directly under the balance sheet TV 30,000. So which method can I follow? That is your choice. You may follow cost model or revaluation model. That is your choice. What AS10 says? AS10 says initially everybody should follow cost model only, but a subsequent recognition either you can follow cost model or revaluation model, which is comfortable to you. That is your choice completely. So actually, AS10 is very beautiful standard. If we have problems in our syllabus, it is quite interesting, but okay, that is fine. We don't have problematic part, just we have overview of AS10. Tell me, what is AS10 background? So before coming to AS10 of revised version, we have another two standards called AS6 and AS10. AS6 is depreciation, AS10 is AS10 is fixed assets. Now these two standards are merged to release a new standard, AS10 PPE, property, plant and equipment. What is the definition of PPE as per AS10? PPE means tangible items held for use either in production or supply of goods or services or rental to others or administrative purposes. If you are using that item for any purpose other than these three purposes, then you should not call that as a PPE. If you want to call that as a PPE, that either be used for production, supply of goods or services or rental to others or administrative purpose. If you are using for any purpose other than this purpose, that is not considered PPE. Sir, give me an example, sir. For example, I purchased a TV, that is a tangible item, but I have purchased it for sale, resale. That is not PPE. Why? Because that is not covered in this definition. That will be known as or called as good. Why? Because for resale. Okay. This is all about AS10. So with this we covered up to AS10. So just I ask you names. Tell me. Let's try to give the answer. So what is AS1? Give me at least name. Disclosure of accounting policies. AS2, valuation of inventories. AS3, cash flow statement. What is AS4? Contingencies and events after balance sheet. AS5, net profit or loss for the period and prior period changes. AS6 is not there. AS7 is construction contracts. AS8 is there. AS8 is not there, AS9 is there, revenue recognition, AS10 is PPE. Now it's time to start AS11. AS11 is discussing about the effects of changes in foreign exchange rates. First of all, do you know what is the meaning of foreign exchange rates? So I think you all know, in India we have currency called Indian rupee. In US they have dollar. In Singapore they have Singapore dollar. In UK they have pound. In Japan they have yen. That means each country has different currencies. We have rupee, dollar, Singapore dollar, Japanese yen, pounds, euros. This is pound. This is euro. There are n number of currencies for there. So, for example, if I want some $1,000. For example, if I want $1, but in India we have rupee. Sir, how to purchase dollars? As of now, what is the rate of dollar? Can you guess? So, example say $1 is equals to 80 rupees. That means I have to give 80 rupees to purchase $1. Okay. Now, for example, I have taken loan from some foreign bank. For example, I have taken loan from American bank of $1,000 as on 1/4/25. As on this date, $1 value equals to 80 rupees. That means I have to pay 1,000 into 80,000 rupees. But what happened in practicality? After 1 year, that means on 31st March 26, dollar value increases to 90 rupees. That means my principal amount is increased only just because of change in foreign exchange rate, not because of the interest. Interest rate is same only, but my principal amount is increased just because of change in foreign exchange rates. Okay, whenever this kind of changes are there, how to deal with it? So definitely some people may take it as a loss, or some people may take it as capitalization. They will add to the asset. So for this reason, AS11 come into the force. What AS11 says, the effect of changes in foreign exchange rates. So first of all, as per AS11, where is the involvement of foreign exchange? So there are two situations where we can check involvement of foreign exchange. They are foreign currency transaction. Second one, foreign operations. These are the areas where we can check for whatever. Wait a second. Yeah, foreign currency transaction. Second one is foreign operation. Foreign currency transaction, we just know what I discussed. Example, if we purchased some asset or sold some asset or purchased goods, whatever. If you are doing a transaction with foreign currency, that is called foreign currency transaction. Second one is foreign operation. Foreign operations means, for example, we are running a some successful company. We started a new branch in US or UK. There definitely they have to prepare their own books of accounts. Definitely they will prepare their books of accounts in their currency, in the Singapore dollar or US dollar or pounds or euros, whatever it is the currency of that particular company. So definitely if they have recorded in their currency, but our parent company is Indian company, our currency is rupee. Sir, how to convert that foreign company to Indian currency? That are called foreign operations. That means AS11 is dealing with two kind of exchanges. First one is foreign currency transactions. Second one is foreign operations. So AS11 should be applied in accounting for foreign currency transaction and in translating financial statements of foreign operations. So if they want to apply the standard only whenever you are doing foreign currency transactions. Second one, in translating your financial statements of foreign operations to the Indian currency. Translating is converting from dollar to rupee or pound to rupee or euros to rupee. So there AS11 is strictly applicable. Okay? Fine. I think you are perfect with AS11. Okay? Yeah. Coming to AS12. AS12 is accounting for government grants. So again this standard has also some background. So let's discuss the background and then we'll get back to the overview of the standard. For example, some governments generally who are under development or developing or else non-developed states, sometimes central governments as well, they will encourage investments by the companies. Sometimes they will encourage new entrepreneurs like SMEs, whatever it is, small and medium scale enterprises. Sometimes they will encourage big companies. For example, if you observe some Telangana or Tamil Nadu, even AP government, they are requesting all big companies in big players in the market, like they'll request Reliance, Tata, HUL, all those companies, please invest in our state. Why? Because reason is very clear. If they set up a plant in our state, definitely there will be generation of employment. Whenever employment is generated, there will be incorporation of ancillaries, market. For example, if a D-Mart is situated in a place, automatically say small shops will come to that particular surroundings. Similarly, if for example, if in a Chennai or else in a Vizag or if some Delhi, if there is incorporation of some ITC company, definitely based upon that company there will be some 1,000 employees. No, for the 1,000 employees there will be n number of requirements are there. There will be huge employment generated in that particular area. That is called development. That is the reason governments are generally beg for companies, please invest in our states. Sir, what is the advantage to the government? Definitely there is an advantage. What is the advantage? If employment is generated, definitely they will purchase something and then we will get the tax amount. At the same time, we can reduce our poverty level. Okay? So that is the reason generally governments will encourage investments of the companies. So sometimes governments may give subsidies to the companies, sometimes they will give cash incentives, sometimes they will give duty drawbacks. Duty drawbacks means they will reduce the taxes. Sometimes they will not charge even single rupee tax. So these are the grants given by the government to the company. Government is which government? That might be central government or state government, any government, that is okay, fine. Think in company point of view, not in government point of view. If as a company you are receiving any benefit from any government, if it is in the form of subsidy or else cash incentive or else duty drawback, that is called as government grant. So government grants are in three forms. What are those three forms? Subsidies, cash incentives, duty drawback. My dear students, so till now we have covered almost 9 to 10 lectures, but still we are discussing all basics only. So we have not yet started in completely in examination oriented. Please do wait for some time. All these are fundamentals. These are very very important in further chapters. Believe me, you are going to rock your exam. And of course, this is not right time to say, but still I am saying this point. Already I told you at the beginning, I think. So listen, out of your group 1 you have 4 papers. Out of 4 papers, this paper you can score easily. That's why I analyzed your entire paper on the first day itself. Okay? So please be focused on this paper. Fine. So generally government grants means government grants are maybe in 3 forms. What are those 3 forms? Either maybe in subsidies or else cash incentive or else duty drawbacks. Subsidy means, for example, if government, for example, land in particular state is 1 acre, some 2 crores, but they are giving that land to particular TCS company at 1 crore only, that is called subsidy. Cash incentive means sometimes government will give cash directly to the company, that is called cash incentive. Duty drawbacks means they will reduce the taxes or sometimes they will ignore the exempt the taxes, that is called duty drawbacks. Government grants means assistance. Assistance means support or help. Assistance by the government either in cash or kind to an enterprise for the past or future compliance. Compliance is not a complaint, that is compliance actually. Compliance. Future compliance with the certain conditions. So generally governments will give support that may be in form of cash or in kind to any enterprise. But definitely whenever government is giving grant to you, definitely they will expect something from you. That may be because of your past compliance of some condition, or they may require to comply some conditions in future. For example, if as a faculty member of BCCA, for example, central government has given me one good opportunity. Example secondly. For example, central government has come to me and they said that, sir, you are taking classes fantastically for CS course. So please start a new startup or please take classes in tribal area somewhere in Arku or else some tribal area. Then we will use some amount. That means I have to start new college somewhere else. Just the examples I don't give. Fine. So sometimes they will say, I will give you 10 lakh rupees as a government, but one condition is there. What is the condition? In every year, you have to teach at least 10 students at free of cost. That is future condition. If there are no future condition, if they are giving me just because of my performance or my character, that is called past condition. Generally, government grants may be in past or future compliance. Generally, there will be future compliances only. Sometimes they will give you as per your past, past background or else past history. Okay. So this is all about government grant. Let me summarize AS12. AS12 is accounting for government grant. Government grant may be in 3 forms, either in subsidy or cash incentive or duty drawback. Government grants definition is government grants for assistance by the government either in cash or in kind to an enterprise for past or future compliance with certain conditions. With this, our AS 12 is also completed successfully. Fine. Next one, AS 13, accounting for investments. So very easy. Whenever a business organization invested their money in somewhere else, that is called accounting for investment. Actually, that is investment only. So how to accounting for this investment is dealt by AS 13, that is accounting for investment. How to disclose it, all those things dealt by the AS 13. Let's see what standard says. AS 13, accounting for investment. This standard means AS 13 deals with the investments and their disclosure. Already I told you in AS 1 itself what is the meaning of disclosure. Second one, what is the meaning of investment they have given? Investments are assets. Obviously we know investments are assets only. That's why we write on the debit assets side of balance sheet. Investments are assets held by the entity to earn revenue. Obviously, for example, I purchased some shares of another company, that is my investment. Why I invested here? To get dividend, to earn the revenue. That is the definition of investments. Investments are assets held by the entity to earn the revenue. Number 3, entity should disclose separately current investment and non-current investment. I think you know what is current investment, what is non-current investment. If you remember, while we were discussing the first chapter accounting investment, there we discussed current assets and non-current assets. Same concept here as well. If you are going to sell your investments within 1 year, that is called current investment. Otherwise, that is called non-current investment. Okay. So that is all about AS 13 as well. So before winding up this session, let me just summarize entire all standard. So first one, AS1. What is AS1? Disclosure of accounting policies. So what is accounting policies? Accounting policies are specific accounting principles, and we discussed all those things. So GCA, don't forget, going concern, consistency approval. AS2, valuation of inventory. It should be valued at cost or NRV, whichever is lower. AS3, cash flow statement. So inflows, outflows. Inflows means how cash comes in, outflows means how cash goes out. Again, 3 activities: operating activities, investing activities, financing activities. AS4, contingencies and events after balance sheet date. Contingencies means a condition or situation that the outcome that may be gain or loss depend upon occurrence or non-occurrence of certain future events. Second one, AS5 is net profit or loss for the period and prior to the changes in accounting policy. This discuss how ordinary activities and extraordinary activities we have to do separate, show disclosure. And AS7 is discussing about construction contract. The standard is specifically designed only for the business entities who are in construction sector. AS9, revenue recognition. So AS9 deals with if revenue is from sale of goods or rendering of services or from any other things like interest, dividend, royalties, such kind of things. How to recognize our revenue in our profit and loss account. When to record, how to record, how much record. So that's what decided by the or dealt by the AS9 revenue recognition. And AS10 we covered. AS10 is about PPE, property, plant and equipment. It means tangible items held for use either in production or supply of goods or services or rented to others or administrative purposes. That is all about AS10. Next we discussed AS11 is the effect of changes in foreign exchange. There we covered 2 topics. One is transaction, second one is operations. And AS12, that's large standard we covered. I think government, there are 3 types: subsidies, cash incentives and duty drawback. At last we covered accounting for investments. Investment means assets held by the entity to earn revenue. We have to show current and non-current separately. This is the all discussion about AS1 to AS13. In next class we are going to cover the remaining standards as well. Before the next class, please review the entire previous topics and then I need to take care. Bye.
Okay, very good morning. So I think we are in discussion of accounting standards. We have covered I think up to AS13 accounting for investments. Now let's enter into the further standards. AS14 accounting for investments, and before entering into the further concepts, I hope you have studied all the previous accounting standard from the AS1 to AS13. Okay, and already I told you these accounting standards are not that much important for our examination. Why? Because we don't have in detail accounting standard. Instead they will give just an overview of accounting standards. Okay, yeah, without any further ado, let's enter into the further standards AS14 onwards. So let me begin AS14 accounting for amalgamation. So I think majority of you are hearing this word for the first time, amalgamation. So actually as usual, let me discuss the background of this standard, then we'll enter into the content in our material. So first of all, what is the meaning of amalgamation? How many of you aware of Vodafone? At the same time, Idea as well. What are those two companies? They are telecom operators. Now what happened? Those two companies are merged and now VI. Okay. Second one, how many of you know Big Buzzer? Now it becomes Smart Buzzer, Reliance. So in first case, Vodafone and Idea, they are two separate telecom operators, and on sudden day they merged into a new entity called Vodafone Idea VI. And there was Big Buzzer, a grocery mall. Now it is taken over by Reliance. Now it is Smart Buzzer. So what is the difference in between these two cases? Let me explain you. So first of all, we have to discuss about VI case. So all of you know, our telecom industry in India is like before Jio and after Jio. Before Jio, we have n number of telecom operators: Airtel, Vodafone, Idea, Universal. N number of operators are there, even Tata Docomo. So whenever Jio comes to the industry, it was a huge effect on entire industry. There Vodafone and Idea, they are also players in the same market, but they understood one point, that this is not easy to compete Jio individually. Even though n number of players they exit from the market just because of Jio, these two people, they have not exited from the market, they just joined together and they come up with a new company called VI. That means here these two are merged. This is called synergy benefit. Generally, if something single person cannot do individually, for example, there is something there is some work is there, A can't do that work, B also can't do that work. If A and B join together, they can do that work easily. In the same way, Vodafone cannot compete directly Jio. Idea also they can't compete directly Jio. If they merge it together VI, at least they can try to compete Jio. That is the root cause of VI, Vodafone Idea. So this is called merger or amalgamation. Second example, Big Buzzer was there. So it is a competitor of Reliance Smart or Reliance Fresh. Now what happened? Now Reliance taken over this Big Bazaar. Now they renamed it as Smart Bazaar. It is belongs to Reliance now. Now no more Big Bazaar. Okay. If you compare these two cases, that means one company is merging with another company. That is one case. Second case, one company is purchasing another company. If two companies are joining together, that is called merger. Merger means they are combining together. In some cases, one company will purchase another company, that is called purchase. So these two are commonly called as amalgamation. Amalgamation consists of two categories. One is merger, second one is purchase. Merger means two companies are joined together, combined together for synergy benefit, that is called merger. No sir, the two companies are not combining, only one company is purchasing another company, that is called purchase. Second, Big Bazaar example is purchase. Okay. If our example is true, what you call VA example is merger. So whenever amalgamation is there, that might be merger or purchases. For example, ABC Limited company is there. They are purchasing a XYZ Limited company. That means this is amalgamation in the nature of purchase. In this case, I will tell you few things. For example, XYZ Limited assets are 50 lakhs, liabilities are 30 lakhs. What is the meaning of net assets? Net assets, what is the formula for net assets? Net assets equals to assets minus liabilities. That means 50 lakh minus 30 lakh, 20 lakh. That means we are receiving 20 lakh assets from XYZ Limited. Definitely whenever ABC Limited is purchasing XYZ Limited, definitely we have to pay some amount as consideration, that is called purchase consideration. Sir, why should we pay purchase consideration? Common sense. You are acquiring business, you have to pay for it. For example, if I pay 30 lakhs for it, so their net assets are only 20 lakhs, I am paying 30 lakhs. Why I am paying 30 lakhs? I know I am paying extra money even though their net assets are 20 lakhs. Why I am paying extra money? The only reason is of course some brand is there for XYZ Limited. Some what you call honest customers are there. They will come to my business if I acquire that business as well. So this is for that brand name I am paying extra 10 lakh. That 10 lakh, that brand name is called goodwill. Sometimes I may pay less. For example, if I am paying only 15 lakh, that means I am paying less. That means there is no goodwill that company. That is called gain on purchase. And whenever you are acquiring another company, you have to take all assets and all liability, and you have to be very cautious with their reserves and surplus. So how to acquire assets of XYZ Limited, liabilities of XYZ Limited, reserves of XYZ Limited, all those things will be dealt by AS 14 in detail. Actually, this chapter is very difficult chapter in all our commerce professional courses. Okay, but still anyway for us that is not a big thing. Why? Because we don't have full detail chapter right now. Come on. Next one, AS 15, employee benefits. What is the meaning of employee benefits? Employee benefits means whatever employer is paying benefits to employee. It might be any form of consideration. That may be in form of cash or in kind. Sometimes employer may not pay in cash. For example, if I am employer, you are my employee, you worked for me and I have to pay salary to you. That is also employee benefit. In actually at the end of month, I have to pay some gratuity, or I have to contribute PF, or I have to give some house rent accommodation or house rent allowance to you. So in these cases, out of all these things, some benefits are cash benefits, some benefits are non-cash benefits. Okay, so actually as per AS 15, the same thing is dealt by Ind AS 19, that is also discuss employee benefit. Actually, we have 4 types of employee benefits. Just give me a couple of minutes. I will open Ind AS 19. Yeah, this is Ind AS 19 employee benefits. So this standard also almost similar to accounting standard. So as per this standard, they have classified entire employee benefits into 4 categories. What are those 4 categories? Short term benefits, post employment benefit, other long term benefits, termination benefits. What are those 4 types or 4 classification? Short term, post employment, long term, termination. Short term benefits means whenever he is in employment. Post employment benefit means once he leaves our entity, whatever we have to pay, that is called post employment benefit. Other long term benefit means whatever we have to pay after his retirement in long term. Termination benefit means we have to pay at the time of his leaving. Okay, yeah, come back, no problem. So for example, employer has to pay salary, PF, gratuity, some perquisites, we have to pay n number of things. So how to do accounting? So the objective of this standard is to prescribe accounting and disclosure for employee benefits. Number 2, this standard should be recognized when employee provided services and enterprise consumes the economic benefits arising from the services provided by the entity. That means even though if you are providing employee benefits, that might be salary or gratuity or PF, we should record as an expenditure only if these conditions are satisfied. Condition number 1, employee should provide services. That means if he is absent for entire 1 month, you should not record salary account debit to cash or bank account. You should not do that. Second one, enterprise consumes the economic benefits arising from the services provided by the entity. If you feel, based upon the work done by the employee, if you feel that results are financial benefits to the entity, then only you should record your expenditure as per AS 15 employee benefits. So these 2 are condition criteria for recognizing your employee benefit as expenditure. What are those 2 conditions? Condition number 1 is he should provide services. Condition number 2 is our entity consumes those benefits. Then only you should record your expenditure like salary account debit to cash or wages to cash or PF to cash, whatever it is, whatever do you want to write. Okay. First of all, try to understand one point. So employee benefits means not only salaries, sometimes it may be in form of cash or in kind. It may be wages or profit sharing plan, bonus, or else pension scheme, insurance scheme. So n number of things that might be. So what is the intention of AS 15? AS 15 agenda is not to tell what are the covers under employee benefit. Our intention is to tell what is the accounting treatment of employee benefit. What AS 15 says, you can recognize as revenue or expenditure, whatever it is, no problem. But you have to fulfill these 2 conditions. Condition number 1 is employee should work for you. That is called employee should provide the services. Condition number 2 is enterprise should consume the economic benefits from the services provided by the entity. Only in these scenarios you can recognize your expenditure, no problem at all. That's what AS 15, the total overview is. Okay, so this is all about AS 15. So next overview is about AS 16. AS 16 is about borrowing cost. So actually already I told you, if it is Ind AS, if you check Ind AS number 23 is discussing about borrowing cost. First of all, what is the meaning of borrowing cost? Let me give you an example, then you will get more clarity about it. Then we can move on. For example, we purchased some particular machinery in USA. If you convert into Indian rupees, the value is 1 lakh rupees. The only value of that machinery is 1 lakh rupee. So we imported from US to India. In India, definitely we have to pay custom duty. Why? Because we are transporting from another country. So custom duty we paid 30,000 rupees. And from that port to our residence or for our workplace, transportation cost is there. The transportation cost is, for example, 10,000. Now tell me, what is the total cost of my machinery? Is it 1 lakh or 1,30,000 or 1,40,000? So definitely everybody will say exact correct answer. 1,40,000, that is correct answer. Obviously you are correct. But why you are adding this 40,000 to that machinery? They are called directly attributable cost. What is the meaning of that particular word, directly attributable cost? Directly attributable cost means whatever you are incurring to to put that asset into present location or condition. They are called directly attributable cost. That's what our AS 10 says. Already I told while we are discussing AS 10. So you know, AS 6 was depreciation when I am a student. AS 10 was a fixed asset. Now these two are merged together and they come up with a new standard called AS 10 PPE. In that standard, they have clearly given one provision that you have to consider all directly attributable cost to your asset. That means you have to capitalize all expenditure which are you think directly attributable to that asset. So as per your answer, now the total cost of machinery is 1,40,000. That is 100% correct. Even I agree with your answer. Now my question number 2, you guys. So my question number 2. So actually I want to construct a big home in my hometown. So my budget would be 1 crore, but unfortunately I don't have money. So I approached SBI for home loan. So happiest thing, unfortunately they have given home loan value of, for example, 1 CR. For your understanding purpose, 100 lakhs. And interest rate 10% per year. Now I constructed the entire house. If it is in the process of construction, definitely for construction of house I need some materials, right? I need sand, I need bricks, I need cement. Example sake, I bought sand value of some 20,000, bricks value 50,000, cement 1 lakh. We have to add all these material cost to my house cost. Why? Because they all are needed to construct a house. So that means as of now my total value of my house is 1 lakh plus 50 plus 20, 1,70,000. So example sake, year is completed, but home is under progress, under construction. Now tell me, whenever 1 year is completed, one person will come to my home. Who is that? Can you guess? Obviously SBI. Why they will come to my home? They'll ask interest. What is the interest rate? 10%. What is the loan amount? 100 lakh. 100 lakh into 10% means we have to pay 10 lakh rupees interest. My question to you guys, so now I have to pay 10 lakh rupees interest, that is secondary thing. Now tell me, is this 10 lakh, shall I capitalize or it should be expensed into P&L account? Capitalize means whether I should add to asset or not, that is the question. So some people may say, sir, we should add that interest to asset, sir. What is the reason, sir? If you ask them reason, they'll tell you very clearly that, sir, we incurred that interest only because of our home only. If there is no home, no need to take home loan, no need to pay interest as well. So we have to add that interest to our asset. Some people may say, so no sir, no, that is not correct. You should not add that interest to your asset. Why? Because if you add, your asset value is being increased or inflated, but in fact in reality that is not your correct asset value, so you should not do it. So both persons are correct in their own dimensions or perceptions, but what AS says, let's check what AS 16 says. So AS 16 is discussing about whether should I capitalize that interest or not. Some people may ask, what is the meaning of capitalize? Capitalize means adding that interest to asset. Sir, if I capitalize, that is okay, fine. If AS 16 says you should not capitalize, then what shall I do? Don't worry about it. You can directly go to P&L, write down P&L account. Nothing but you can write entry interest account debit to P&L account. Correct, no? Otherwise, sorry, P&L account debit to interest account. When you are paying interest account debit to cash, we have to transfer closing entry at the year end, no? P&L to interest, that's it. If they want to capitalize it, asset account debit to interest to cash, asset to interest, that's it. But already I told you, in our CS executive syllabus, we don't have standards in detail. They have given just overview of the standard. Why I am giving all these inputs? Just for additional knowledge purpose only. Even if you not understood all the standards also, no problem at all. Whatever I am giving notes, that is enough for you guys. But still, that is not my agenda. Just to give material and to read, that is enough. My agenda is, so you have to understood at least basic behind story of accounting standard, all accounting standard. So let me read the notes right now. Then you will get understood what is the terminology in that notes. Borrowing costs or interests, mainly borrowing cost means interest only, along with interest some other, that is not called, some other costs, typing mistake, typo, other costs incurred by an enterprise in connection with the, like if there are any additional fees, whatever, sometimes they'll ask stamping charges, no, they are also form part of borrowing cost. Borrowing costs that are directly attributable to assets should be capitalized. Borrowing costs should be recognized as an, other borrowing costs should be recognized as an expenditure. So in detail, we don't have in detail content, but don't worry. So for our exam purpose, that is enough. I can't do anything because they have not given in our syllabus. Maybe that reason could be, nowadays accounting standards will not play a major role. We all should have learn about Indian accounting standard. That might be one of the reason. I think very soon they will update all Indian accounting standards. Okay. Yeah. Next standard is AS 17, segment reporting. So as usual, before entering into AS 17, let me discuss the background of the standard AS 17. So for example, everybody knows Reliance company, right? So if you observe in the market, Reliance in different sector, Reliance in footwear, Reliance in telecom, Reliance in groceries and what you call FMCG, Reliance in ready-made garments, that means textiles. So Reliance is in different n number of sector. For example, sometimes Reliance may get huge profit in telecom and they may get loss in some footwear, or else they may get loss in textile industry. So in if one company is dealing with different number of what you call segments, in such a case, of course, shareholder wants to know from where Reliance is getting profit, from where they are getting losses, all those things. In this particular scenario, definitely either investor or shareholder, they wants to know what is their profit or loss exactly at segment wise. Sometimes you can say Reliance has establishments in North India and South India and some foreign countries as well. Maybe of course the food habits or else normal habits of North Indian people are little bit different from South Indian people. If you compare country to country, our habits are different from foreign country habits. So generally sometimes they want to know what is revenue from India, what is revenue from foreign countries. If you observe, in first category I divided with respect of brands or segments. In second, I divided in respect of region. So these all are called segments. Segment means particular department, I can say. So this particular AS 17 says if shareholders or investors, if they want to know results of segment wise, then we have to show results are segment wise. Now FW is nothing but footwear is one segment, telecommunication is one segment, like that. So whenever if they want to show their account segment wise, how to they have to report, that is called segment reporting. How to report. So if they want to show their results segment wise, that is called segment reporting. Sir, how to do segment reporting? All those things will be discussed by the AS 17 segment reporting. Okay, the standard is discussing about segment reporting. Fine, everybody. See the content in our material. The objective of the standard, that means AS 17, is to establish principles for reporting financial information about the different types of products and services of enterprise produces and different geographical areas in which it operates. That's what I told in my example. So in first category we divided product or service wise. Footwear is one segment, second one is telecom is one segment, textile is one segment. Actually they are called operating segments. Sometimes they may divide as per geographical areas, like North India or South India or India or else US, UK, like that. If they want to divide in this particular division, they are called segments. That reporting is called segment reporting. How we have to report segment wise, that is called segment reporting. How to disclose, when to disclose, what are the conditions, all those given by the our beloved standard AS 17. Next one, such, this is such, let me change. Segment information helps users of financial statement. That's what already I told you. Users are very curious about to know about the company in detail. They'll focus on very minute things. If we give segment wise reporting, it helps all the users for these particular three purposes. First one, better understand the performance of enterprise. They can understand in better manner. Sir, how it is possible, sir? Obviously, for example, Reliance has given segment reporting, then they can observe how much profit they got from textile industry, how much they got from telecom, how much they got from FMCG, how much they got from IT, how much they got from footwear. Then they can understand from what is the area Reliance is more strengthened, what is the area they are weak, what are the areas they have to strengthen itself. Second one, better assist risks and returns of enterprise. So definitely for each and every company there should be two important things over there. Even they are very much important words in our financial management. One is risk and return. Generally every company, they'll do business, not only company, any business entity, if it is a sole proprietorship or partnership or company, generally any entity, they do business for return on their investment. Return is ultimately depends upon risk. Risk and return are very, very important things in our financial management subject. So better to assist the risk and return of an enterprise. We have to assess what is our risk and what is our return. We can know all risk and return by observing a segment wise reporting. Last one, make more informed judgments. Informed judgments means, do you know what is the meaning of informed judgments? Informed judgments means taking decisions based on facts and actual figures. That is called informed judgments. If you are taking a decision just like that, that is not informed judgment. That means you are taking decision by using facts and actual information. Okay. So by this, all these three are what you call uses or else helps to the users of financial statements by segment reporting, which is covers under AS 17. First of all, try to understand what is AS 17. What is AS 17? It is a segment reporting. What is segment reporting? When a particular company is in different sectors, or if they are producing different products or different services that they are rendering, then definitely user wants to know in detail what is going in business entity. In such case, definitely our company has to release data segment wise. That how to they have to release, that is called segment reporting. So what are the conditions in segment reporting? One to we can call one segment as a segment reporting. All those things are covered by the AS 17. But try to understand what is the overview of AS 17. Sir, if we show the segment wise reporting, what are the benefits to the users? That's what I have given in your notes. There are three uses. First one, better understand the performance of enterprise. Second one, to assist a risk and return of enterprise. Third one, to make more informed judgments. Informed judgments means we can take decisions based upon actual figures and facts. So these are the benefits or helps to the users of financial statements by using segment reporting. Fine. So this is all about AS 17. Let me move on to next standard, AS 17, that is related party disclosure. So very interesting standard it is. So definitely normally our human tendency is, for example, if I am CEO or as director of one big Reliance company, so Reliance company need some 1 lakh, for example, we am CEO of Reliance footwear. Okay, I need 1 lakh boxes. Do you know boxes? No, boxes for putting those slippers or footwear, whatever it is. So if I purchase those boxes from X supplier, I have to pay for each and every box 1 rupee. My relative is also in the same business, or as my brother is in the same business which I required, then definitely I will choose my brother rather than X. Definitely, that is human relation, no? Definitely I will choose my X, sorry, my brother. Okay, sorry, so my brother, obviously. In the same way, if my relative is doing some business, definitely I'll purchase material for my company from my relative, obviously. In such case, definitely there will be some kind of fraud or else some loss to the company, chances are there. For example, if I need that particular boxes, if I purchase from Mr. X, who is supplier of Reliance company, I have to pay 1 rupee per box. Same thing, if I purchase from my brother, he is also in the same business, definitely I will pay 2 rupees. Why? Because if I pay 2 rupee, my brother will get more revenue, more profit. Even though I am not getting any loss. Why? Because I am not purchasing personally. Who is purchasing? Company is purchasing. Definitely company has to face the consequences. Even I will feel happy, my brother will feel happy. Who is suffering here? Reliance company is suffering here. As a MD or CEO, I have taken a decision to purchase some material from my brother at more than what actual price is. So that is the reason AS 18 comes into the picture. Whenever a company is entering into related party transaction, you have to follow AS 18. In fact, in practically, if any company wants to enter into transaction with any related party, it needs board of directors approval. Sometimes it needs a members approval as well, subject to conditions of Companies Act 2013. Here my point is, what are the requirements, all those things, that is not my requirement and my subject. My subject is, if you already entered a transaction with your related party, subject to conditions given by Companies Act 2013, whenever you enter, you have to tell the same thing to your shareholders. What I have to convey to my shareholders, that I entered this transaction with my related party. Then they come to some conclusion. At least they are shareholders, they are real owners. You are just employee. You have to inform everything frankly and precisely and clearly. Okay. So this standard says when we should enter into related party transactions and why should we enter, all these things are not discussed by our standard. That is completely headache of your Companies Act 2013. When to apply, who is related parties, can we enter into related party transactions or not, who is the authority, all those things are not my duty. This is Companies Act 2013 duty. Here my point is, if you already entered transaction with your related party with the approval of Companies Act 2013 conditions or provisions, you have to disclose the same thing to your shareholders. So how to disclose, when to disclose, all is discussed by the AS 18 related party disclosures. Already, if you remember AS 1, there I told you very clearly what is the meaning of disclosure. Disclosure means we have to give information to the users in written format. So let's see what is AS 18 says. The objective of the standard is to establish requirements for the disclosure of related party relationships and transaction between company and related parties. That means every company has to show their related party relationships and related party transactions. Okay. So that means AS 18 says you have to disclose two things in your financial statements. The first one, related party relationships. That means for our company, who are relatives. That's what we have to disclose firstly. Second thing, transaction between company and related parties. First one, who are your relatives, you have to tell. Second one, if is there any transaction you entered with that related parties in this year. You have to tell these two things. For example, in the current year, I have not entered into any transaction with my related parties. Still, you have to disclose who are your related parties. That is compulsory and mandatory as per AS 18. If you enter transaction with them, you have to give the details of transactions. No, sir, I have not entered any transaction. That's ignore. No need to disclose. Okay. Next standard, AS 19, which is leases. So actually same thing is covered by the Ind AS 116, Indian Accounting Standard 116. So AS 19 is discussing about leases. So first of all, you need to understand the difference between hire and lease. Both are looks alike same, but they are not exactly same. Okay. So actually in lease there are two parties. Who are those two parties? Lessor and lessee. Lessor means the person who is giving asset on lease. Lessee means the person who is taking that asset on lease. So, 1 minute. What happened? Yeah. So for example, if I need some asset, X is transferring asset to Varma on lease, or else actually I have one document I'll open. Please give me 1 minute. Lease. Yeah. Actually, don't mind with respect to the pictures in this PDF. So it was drafted so many years back. Please don't mind. So lease or buy. That means if you need any asset, sir, is it better to go for lease or buy? For example, I and you, we both are started one new startup. For example, let me take our college as an example. BCCA is coming to Chennai for taking classes for 6 to 7 months for one batch. We have taken one particular building in particular area, but the problem is in that area there are little bit power cuts are there. So that is the reason definitely we have to take one generator like this. Now the point is, for example, to purchase this generator, the cost is, I'm just writing rough figures, please don't take it. So for example, cost is 10 lakhs or else 6 lakhs. My point is it that much important? So So my question to you is it that much fair or else wise decision to purchase that generator for 6 lakhs, or else we can go for some lease with some local particular person, so we can take that asset for lease for every year 1 lakh. Tell me, if we are if our plan is going to be there for 2 years, then tell me, is it advisable to go for buy or else lease? That concept is called lease or buy. Now in this example, our plan is to be going to there for 2 years, and for every year lease payment is 1 lakh rupees. If you want to buy that asset, you have to pay 6 lakhs. In that case, which is better? Is it better to go for buy or else lease? That concept is called lease or buy. Sir, which is better? So as a account subject and as accounts faculty, I can't tell which is better. That means account subject is not able to tell buy or lease which is better. That's what we are going to learn in our next part of our subject, financial management. There we are going to learn which is better by calculating net present value, NPV. If NPV is positive, then we can go for the decision. What is NPV, how to calculate, all the things we'll discuss in part B of our subject. I think you know, in our subject we have 2 parts. Part 1 is corporate accounting, part 2 is financial management. There we can discuss which is better. Okay, yeah. For example, so our financial management decided, so buy is better, sir. Then entry accounting treatment is very easy. Asset account debit to bank account. If you pay cash, asset account debit to cash account. That is okay, then everybody knows it. But my point is, if you go for lease, what is accounting treatment? What shall I record? What is the journal entry? So first of all, you should understand some terminology. Already I have written here AS 19 as well as Ind AS 116. Both are discussing about lease accounting. First of all, this particular standard AS 19 is applicable to all lease agreements, but it is not applicable to these 3 particular resources. Already same thing I have written in my notes as well. So they are natural resources like minerals, oils, gas. For this kind of resources which are naturally available, for these resources AS 19 is not applicable. Second one, motion picture films, video recording, video games actually, video games, patents, copyrights. For these also AS 19 is not applicable. Number 3, land lease also AS 19 is not applicable. For these 3 kind of lease agreements or arrangements, AS 19 is not applicable. What are those 3? Natural resources, motion picture films, and some intangible assets and land. Here you can easily understand why for this AS is not applicable. Why? Because for them separate standard is there. So for intangible assets, that's why for that AS 19 is not applicable, and for lease of land also AS 19 is not applicable. Okay, and yeah, please don't take me wrong. So here one person is giving asset on lease to another person. I have written 2 names, Kavya and Likita. So Kavya is giving asset on lease to Likita. That means Kavya is the owner of that particular asset. Likita is taking that asset on lease. The person who is giving asset on lease are called lessor. The person who is taking that asset on lease is called lessee. So that means we have 2 parties, lessor and lessee. By the way, even though lessor is transferring to lessee asset, but they are not transferring ownership of asset. They are transferring only physical possession, and they are transferring their right of use. Right of use means they can use that asset. I am giving that right to particular lessee. So tell me, lessor is the owner of that asset, lessee is taking that asset on lease, lessor is giving a ROU. ROU means right of use. So that means you tell me, is lessor providing some kind of social service? Obviously no. So definitely lessor will expect some return from lessee. So that means lessee has to pay some rent or lease amount to lessor every year or every month based upon their agreement. So whatever lessor is paying to lessee, that consideration is called lease rentals or lease payments. That means we have learned four important terminology in AS 19. One is lessor, second one is lessee, third one is ROU, fourth one is lease rentals or lease payment. Lessor means the real owner or original owner of the asset who is giving asset on lease. Lessee means the person who has taken asset on lease. ROU means a right of use which is given by the lessor to lessee. And the last one is lease rentals or lease payments. That means amount or consideration paid or payable by the lessee to lessor for using that asset. So these four are important terms in our leases. And apart from it, so total leases are divided into two types of lease. One is operating lease, second one is finance lease. So actually accounting treatment is depend upon type of lease. If it is operating lease, treatment is different. If it is finance lease, treatment is different. What is accounting treatment? What is the journal entry? Where I should record? Where I should show? What is the position in balance sheet, in P&L? All those things are not covered in our syllabus. So I'm just giving you overview of standard. So in this standard, just try to understand what is the meaning of lease, who are lessor, who are lessee, what is ROU, and what is lease rentals or lease payment, how many types of lease, and what are those? How many types of lease? Two types. What are those two types? Operating lease and finance lease. Now let's enter into our material, then see. Already I told you AS 19 is applicable for all lease agreements other than natural resources like oil and gas, motion picture films, video recordings, patents, copyrights, and lease of land. One more thing we can record, leases are two types, operating lease and finance lease. Okay, so this is all about AS 19. Then can we move on to the next standard, AS 20. AS 20 is very interesting standard, and the practical, this is very useful standard for all the shareholders and investors. Let me check what is the standard AS 20. Okay, so AS 20 is discussing about EPS. EPS full form, earnings per share. Okay, so before entering into this standard, again I have to discuss some background of this standard, then we can move on to the AS 20. So if you come to EPS, earning per share, so just I want to show you Reliance Company annual statements. This is Reliance Company annual statements for the year 23-24. Just let me scroll up to profit and loss account. Yeah, you can check here under statement of profit and loss. At last you can identify there is earning per share. That is the company set requirement as well as this particular standard requirement. That means every company has to show their EPS in their profit and loss account itself. Why? Because whenever, if any person invested in your company in the form of equity, definitely he wants to know how much company is earning per my one share. That is normal basic human psychology and investor psychology first of all. So nobody is just spend their money just like that. Definitely they'll expect, they want to know how much earnings per share. That's what everybody observe. If you observe, company's EPS for 23-24 is 62.14. Last year it is 63.56. some reduction is there. The reason could be n number of things. That is not my duty to analyze this EPS. My point is just to tell you, if this EPS is the normal thing, we have to disclose in our P&L account. That is requirement of Companies Act. So what is the full form of EPS? EPS means earnings per share. Okay, so actually same thing has been covered under Ind AS number 33, discussing about EPS. But no problem, as of now let's discuss about AS 20 only. So AS 20, every company has to show EPS in profit and loss account. That's what I showed practically in our particular Reliance company annual report. Okay, so generally EPS are two types. First one, basic EPS. Second one, diluted EPS. You can observe here, so there are two types of EPS are there: basic EPS and diluted EPS. Okay, so these two are different types of EPS. Sir, how to find out EPS and how to find out basic EPS? What is the formula for basic EPS? What is the formula for diluted EPS? All those things are you can cover in your entire standard, but right now no need to discuss all those things. Okay, but try to just understand what is the purpose of EPS. What is the purpose of EPS? Whenever if I invest some, for example I purchased some 10 shares in Reliance company, what shall I require? I have to check before investing only how much this company earning per one share. I will compare the same thing with another TCS company or else some HUL or some another companies or DMart or S Bank or SBI or MRF, something else. Then I will compare it with all other companies along with my market value and present market value of each and every share and face value of the share and along with some ratios, and I will decide one company. But definitely for taking decision we need EPS. We means investor or shareholder needs EPS. They want to know what is their EPS. That is the reason we have to, that means company has to show their EPS in P&L itself. In P&L only investor or shareholder can check what is the profit or loss. Immediately he can check what is the EPS of the company. Definitely that's what AS 20 is. Again, EPS are two types: basic EPS, diluted EPS. Basic EPS means normally how much you are earning. Diluted EPS, I'll tell you just within brief 1 to 1.5 minutes. So diluted EPS means, I think you all know, convertible debentures. What is the meaning of convertible debentures? Convertible debentures means debentures will be converted into equity in future, option with them. So diluted EPS means if debentures will be converted into equity shares, what could be my EPS? Is the if case scenario. That's what diluted EPS. Basic EPS is a current EPS. Diluted EPS is a expected EPS if those convertible debenture holders are converted into equity shares. Otherwise, basic EPS is enough. But every company has to show both basic and diluted EPS in their P&L account itself. Okay, this is all about in brief of AS 20 earnings per share. Fine. Yes, that's it for today. We'll meet tomorrow with remaining standard. I think we have another 9 standard. We'll complete those 9 standard tomorrow, then we'll move on to the IFRS and Ind AS segment. Okay, bye, take care.
Okay, very good morning. So I think in yesterday's session we covered up to AS 20, right, EPS. So let's complete the remaining standards as well, then we can move on to the further topics. So AS 21 is discussing about consolidated financial statements. First of all, what is the meaning of consolidated financial statements? So to understand this particular term, you need some kind of basic knowledge. So let me give you that knowledge, then we'll discuss about consolidated financial statements. For example, let me take Reliance. Yeah, so Reliance, I think everybody know Reliance, RIL, Reliance Industries Limited.
So that company has n number of subsidiaries. Best example is Geo Limited. Example check only. So first of all, what is the meaning of subsidiary? I think you know in your company, but just I'm recollecting. That's it. First of all, these are two separate companies. Reliance is separate company. Geo Limited is separate company. You know some special features of company. Company is a separate legal entity. That means Reliance company is different from Geo Limited. Then what is the relationship between these two companies? In Geo Limited, more than 50% share is holding by Reliance Industries Limited. So who is holding more than 50%? They can control that company. That means in this example, Reliance Limited can control Geo Limited. Not only Geo Limited, it has almost 108 plus subsidiaries. So in this particular case, this Geo Limited is called subsidiary company. Reliance is called holding company or parent company. Reliance Limited has almost 100 plus subsidiaries. And remember one thing, every company is a separate legal entity. Okay. For example, if Geo Limited got 100 lakhs profit, definitely out of 100 lakh profit, 50% will be goes to the Reliance. Why? Because that is a major shareholder. If they have got 100 lakhs loss, again same thing is going to applicable. So that means you have to understand one point very clearly. For example, I am shareholder of Geo Limited. Then I need to know info only about Geo Limited. Definitely they will prepare their balance sheet, their P&L account, their cash flow statement, their statement of changes in equity and their notes. Correct, na? That is enough for me to understand or analyze about Geo Limited. But in case if I am shareholder of Reliance Industries Limited, they will also give me balance sheet, P&L, cash flow, SOC, notes. But the problem is, as a shareholder or as an investor of Reliance Industries Limited, they have given only data about their company. But definitely Reliance company future is depend upon not only on Reliance company, it's depend upon all of its subsidiaries. If all subsidiaries gets huge amount of profits, definitely that impacts Reliance company. If all of them get losses, that impacts Reliance company. That means only knowing the details of Reliance company is not at all enough to invest in Reliance company or to know about Reliance company. Why? Because Reliance company future is depend upon Geo Limited as well. So that is the reason, even though Reliance company limited prepared their own financial statements, Geo Limited has prepared their own financial statements. So these are called, first of all, separate financial statements. What is that? Separate financial statements. But in addition to this duty, Reliance company has one more additional duty. What is that additional duty? Reliance company has to prepare a balance sheet. In balance sheet, they have to, for example, land is there. Under land, they have to include Reliance company value as well as Geo Limited value as well as all other subsidiaries value. At the same time, plant and machinery, all parent company plus subsidiary company. That means they have to incorporate parent company as well as subsidiaries company. So this is how they have to prepare balance sheet as well as P&L account, cash flow statement, statement of changes in equity and notes as well. That means they already prepared their separate financial statements, but they are preparing financial statements consolidatedly. Consolidatedly means they are preparing parent plus subsidiaries. So this is called consolidated financial statements. Consolidated financial statements means they are preparing financial statements of parent company plus subsidiary companies together. Okay. So this is called consolidated financial statements. Here, who has to prepare consolidated financial statements? Only parent company or subsidiary company. That means you have to understand one thing. Parent company has to prepare two kinds of financial statements. One is separate financial statement. Second one is consolidated financial statements. Okay. Then while preparing consolidated financial statements, what are the rules and regulation, and that's all given by the our beloved standard AS 21 consolidated financial statements. This standard should be applied in preparation and presentation of consolidated financial statements. So already I told you how to prepare, how to present consolidated financial statement is given by the AS 21. Which standard should also be applied in accounting for investments in subsidiaries? That's what I told you. So the complete details about subsidiaries is also given by the AS 21. Okay. Yeah. Actually this standard is very lengthy standard, but already I told you n number of times. We have only overview of the particular standard. Just try to understand what is the meaning of consolidated financial statements. What is the meaning of consolidated financial statement? Before you have to remember, or you have to learn what is parent company, what is subsidiary company. Parent company means the company which invested in more than 50% in subsidiary company. Okay. Yeah. So next standard AS 22 accounting for taxes on income. So actually everybody know every company has to pay tax on their income, but do you know the reality? For example, we are looking at TCS Limited. They have prepared their own P&L account. So they got some net profit 50 lakh. Just example sake, 50 lakh is not a big amount for them, but still okay. 50 lakh. Many of students, or including you will say, if I given tax rate is 30%, if I ask you what is the tax amount, you will say 50 lakh into 30% equals to 15 lakh. That is wrong. That is not a tax amount. Why? Because you are applying tax rate, that is okay, fine, but this 50 lakh is not correct. Sir, I prepared following all accounting standards, all companies act rules. That is the problem. Why? Because this 50 lakhs you calculated as per accounting standards and companies act 2013, but you have to pay income tax not as per companies act 2013. You have to pay income tax as per income tax act 1961. You have to follow this act. So this calculation is 100% wrong. You have to recalculate your profit as per income tax act 1961. For example, I will tell you a small difference between these two acts. For example, I paid some penalty. What is treatment in your financial statements? Under P&L account, I will write debit side 2 penalties. Correct? But if you write 2 penalties on debit side, what is happening? Your net profit is reducing, tax is also reducing. But that is allowed as per Companies Act 2013. But Income Tax Act says I am not allowing penalties on your debit side of P&L account. If you write, that means I am indirectly encouraging you to do frauds and pay penalties. They are not encouraging it. If you follow Companies Act, your net profit is reduced. Why? Because you wrote penalties on debit side. If you follow income tax, they will ignore it. Then you have to add back that penalty, and your net profit will be increased. If it is 1 lakh plus 1 lakh, tax will also increased actually. That means you have to understand one point very clearly. So that means there are some provisional differences between Companies Act as well as Income Tax Act. You have to pay income tax as per Income Tax Act 1961, not as per Companies Act 2013. So that is the reason there are some differences between your Companies Act books and income tax books. There are some differences. This 50 lakh rupees is called accounting income. This 51 lakh is called taxable income. So that means you have to understand one point very clearly. Accounting income is different from taxable income. So how to deal with these differences, all those things given by the AS 22. The objective of the standard is to prescribe, that is prescribe accounting, not according. Prescribe accounting treatment for taxes on income. So try to remember at least those two words: accounting income, taxable income. Accounting income is also known as book income, nothing but profit or loss as per your P&L account, Companies Act 2013. Taxable income means income as per Income Tax Act 1961. That's what AS 22 is. Next one, AS 23. Accounting for investments in associates in consolidated financial statements. Already we have covered this particular term in AS 21, consolidated financial statements. There we discussed what is parent company, what is subsidiary company. For example, there is a company called ABC Limited is there. Okay, what is the company name? ABC Limited. Another company XYZ Limited. Another company PQR Limited. Okay. So ABC Limited is holding 60% of shares in XYZ Limited. At the same time, 30% shares in PQR Limited. Already I told you, if you want to control any company, your shareholding should be more than 51%. But in first case, we are holding 60% in XYZ Limited. That means XYZ Limited will become our subsidiary company. Okay. ABC Limited is called parent company or holding company. Why we have to call XYZ Limited subsidiary company? Because we are holding more than 51%. ABC Limited can control XYZ Limited. Controlling company is called holding company or parent company. This is called subsidiary company. Coming to the next part, ABC Limited holding 30% share in PQR Limited. Tell me, does PQR Limited is subsidiary of ABC Limited? 100% no. Why no? So if you want to call any company as subsidiary company, you should hold at least 50% share in that company. Here you are holding only 30% share in that company. How can you call it as your subsidiary? That is not correct. You can't call it as a subsidiary company. You cannot control because you are holding only 30%. Already you know, controlling means if company wants to take any decision, they want to conduct a meeting. On that meeting, there will be voting, either it is a vote of hands or any other manner. So if who is holding major number of shares, definitely they'll win that particular voting, whatever it is. But even though here we are not holding 50%, more than 51% share, still we can influence the decision. We can influence, nothing, we can't control, but we can influence. We can significantly influence. Why? Because we are holding 30%, no? So we can influence to some extent. Of course, we cannot control the entire company, but we can influence because we are holding 30% is not a joke. So if any company is holding more than 20% in any company, that means they are significantly influencing. They are not controlling, they are influencing. Then other company is called as a associate company. What is that? Associate company. So subsidiary company is different from associate company. Subsidiary company means where we invested more than 50%. Associate company means where we invested more than 20% or are equals to. Okay, that is associate company. So in this particular case, they have to prepare, who has to prepare? ABC Limited has to prepare consolidated financial statement. For them AS 21 is applicable. Now for investment companies, for associate companies, AS 23 is going to deal with it. Let's see what is AS 23 is discussing about it. This standard should be applied in accounting for investments in associates. When to call it as associates? If we are holding more than 20% in preparation and presentation of consolidated financial statements. So how to incorporate these investments, all given by our standard AS 23. Now try to understand what is parent company or holding company, what is subsidiary company, what is associate company. Subsidiary company means our investment should be 51% or more. Associate company means investment should be 20% or more. Fine. That is all about AS 23. 21 is consolidation, 23 is investments, associates. And next standard AS 24.
Okay, the next one is AS 24, discontinuing operations. Sir, what is the meaning of discontinuing operations? Let me explain with an example, then you will get more clarity as usual. For example, I am running a company. I am in food industry. I am very successful business entity and organization. Actually, I have two set of businesses. First one is I am running restaurants. Second one is I am also doing catering services. I think you know what is the meaning of catering services, fine? So I am doing this business from last 6 to 7 years. So current year is 25-26. Today is, for example, today's date is, for example, 31st December 25. So on this day, I'm just as a head of the company, I'm just analyzing all the reports of two different segments. So then I found one important thing that I got huge profit on restaurant At the same time, I'm getting some amount of loss from the catering services. So net is definitely I'm getting profit only. But for example, I'm getting 50 lakhs profit from the restaurant and 4 lakh loss from the catering. So net is 46 lakh profit only. So current year profit is 46 lakh only. But the problem is that my correct profit is 50 lakh if I am not continuing this catering services. So then I decided to close this catering service. I don't want to continue this catering service. So in this case, what is happening? I am not closing entire my company. I am not liquidate my company. I am just discontinuing one set of operations. I am going to continue my restaurant services, but I am not going to continue my catering services anymore. Okay, so this catering service is called discontinuing operations. What is that? Discontinuing operations. This restaurant is called continuing operations. Obviously, we discontinued this catering service in between year, in mid of year. That means from the beginning of 1/4/25 to 31st December 25. That means we have continued our business for 9 months. So for the rest 3 months, that means 1st January 26 to 31st March 26. For remaining 3 months, we are not continuing that catering services. If you prepare your P&L account for this year 25-26, definitely there may be some kind of revenues which are related to discontinuing operations, some expenses related to discontinuing operations. So in this particular scenario, where if you discontinued any operations, you have to show separately how much revenue or expenses from continuing operations, how much from discontinuing operations. You have to show it separately. You should not show combinedly. Okay, that's what discontinuing operations means. Let's check what our notes discussing about AS 20 for discontinuing operations. The objective of this standard is to establish principles for reporting information about discontinuing operations. So what AS 24 says in detail, if you observe the entire content, it shows you have to show how much profit you earned from continuing operations, how much profit you earned from discontinuing operations separately. Okay. Next one, AS 25. Interim financial reporting. What is the meaning of interim financial reporting? Actually, I think you know, every company, as per section number 129 of Companies Act 2013, every company has to prepare and present their financial statement, and they have to publish at least annually. That means at least yearly once. But some companies, they'll prepare their financial statements quarterly. That means in between year. Some companies may prepare their statements monthly or half yearly. So every company has to prepare annual financial statements. It contains of 1 year data. They are called annual financial statements. If any entity prepares financial statements in between the year, then that is called interim financial reporting. Interim means in between, not complete. Financial reporting means they are presenting financial statements. The objective of this standard is to prescribe minimum content of interim financial report. Whenever you prepare interim financial statements, you have to give report to the shareholders. That is called interim financial reporting. In that report, what are the minimum contents to be included? That's what decided by our standard AS 25 interim financial reporting. Second one, timely and reliable interim financial reporting improves ability of investors, creditors and others to understand entity's capacity to generate earnings. Whenever if you prepare your interim financial reporting, definitely it improves reliability towards our investors or creditors. And moreover, if any people who are interested to purchase or invest in our company, it will increase our reliability towards, and moreover, it helps us to understand our capacity towards our earnings capability generation. Okay, so that means how much we are capable to generate more earnings. For this, AS 25 will help you out. AS 25 is interim financial reporting. Try to understand at least one thing. Financial reporting is generally per annually. It contains of 1 year data. Some companies they'll use it to prepare interim financial reporting. That means they'll prepare financial reporting not for the full year. It might be half yearly or quarterly or monthly. Whenever if you are releasing interim financial reporting, you have to include some minimum contents in that report. What should I include in that report? That's all discussed by the R standard AS 25. Second one, whenever you are giving interim financial reporting, in between financial reporting, in addition to your annual reporting, definitely it improves reliability towards our company, especially reliability of investors or else creditors or else any other investors. Especially they can understand by using all this data and interim financial report, they can understand what is our capability to generate more earnings or more revenue. Okay, this is all about AS 25. Next standard, AS 26, intangible assets. If you observe, while we are discussing the first chapter, introduction to accounting, there we had a discussion of assets. Asset is a resource which generates future economic benefits. If you remember it, asset is a resource which is used by the entity to generate future economic benefits. There we discussed assets are two types. One is tangible assets, second one is intangible assets. What is the meaning of tangible assets? Tangible assets means assets which have physical existence and which can be seen and touched. That's what covered under AS 10 PPE. There we discussed about tangible assets. Second category, intangible assets. Intangible assets or other than tangible assets, nothing but which does not have physical existence and which cannot be seen and touched. So, sir, what are the intangible assets example? There we discussed some of examples like goodwill, patent, copyright, trademarks, brands, logos, etc. So, sir, what is the treatment of tangible assets? That's what we covered under AS 10. If you remember, we have discussion of PP definition and initial recognition, subsequent recognition. Initially, we should record cost model, subsequently at a cost or revaluation model. Coming to intangible assets, how to do accounting for intangible assets. So for it we have separate standard called AS 26. So first of all, AS 26 is applicable to all types of intangible assets, but this standard is not applicable to three particular things. First one, if any other accounting standard which is discussing any individual intangible assets, for that intangible assets, the standard is not applicable. For example, if one asset is there that is intangible, for example, X is an intangible asset. For this asset, some another standard AS 24 or 25 is discussing about this standard. Then for this AS 26 is not applicable. Why? Because already same thing has been dealt by some other accounting standard. So if any intangible assets, if that are covered by other accounting standard, for that intangible asset AS 26 is not applicable. Second one, financial assets. For financial assets, nothing but instruments like debentures, convertible bonds. For all these kind of financial assets, AS 26 is not applicable. Third one, natural resources like oil, gas, minerals. So for this kind of natural resources, AS 26 is not applicable. For these three kind of intangible assets, even though they are intangible assets, AS 26 is not at all applicable. So what we can say, AS 26 is applicable to all types of accounting standards, but it is not applicable to the following three intangible assets. What are those? Number one, intangible assets are covered by another accounting standard. Number two, financial assets. Number 3, natural resources. Next one, sir, okay sir, one intact, for example, goodwill is there or patent is there, it is not covered by another accounting standard, it is not a financial asset, it is not a natural resources, then definitely AS 26 is applicable. Now my point is, sir, can I recognize the patent or copyright or goodwill as intangible asset? Yes, you can recognize in your books of accounts, but AS 26 has given one criteria, that is called recognition criteria. There we have two conditions. If these two conditions are satisfied, then you can recognize that intangible assets in your books of accounts. If they are not satisfied, you should not record in your books of accounts. That is called recognition criteria. Let's see. Intangible asset should be recognized only if future economic benefits are probable. That means our company can earn benefits in future. If probability is there, we can recognize, and cost can be measured reliably. First one is, by using that asset, we can generate future economic benefits. Economic benefits, financial benefits. Probable means if there are more than 50% chance. If you are in a notion that if I use that asset, definitely in my future, if I will get future financial benefits, at the same time, I can measure the cost of that asset reliably, then you can recognize that intangible asset in your books of accounts. If nothing is, or if any one of these conditions is not satisfied, you should not record in your books of accounts. What is that recognition criteria? What is the recognition criteria? Two conditions are there. One is FEB. FEB stands for future economic benefits are probable. Second one, a cost can be measured reliably. Otherwise, you should not record in your books of accounts. Fine. That is all about AS 26. Okay. Yeah.
Good morning to all of you. So in last class, successfully we completed accounting standards part. So we have discussed all overview of accounting standards from beginning of AS1 to AS29 as well. So next, Indian accounting standards. So before entering into in details of Indian accounting standards, okay, fine. So already I told you we have two types of accounting standards. One is AS, second one is Ind AS. AS means accounting standards, Ind AS means Indian accounting standards. Already we had a discussion of how Ind AS come into the force. So let me please revise the entire in brief. So first of all, normally we followed our accounting standards. Similarly, every country has their own accounting standards. US has their own standards, UK has their own standard, Japan has their own standards, like that. But so whenever there is a concept of globalization, so doors are open for FDIs, foreign direct investments. Nowadays, an Indian investor can purchase shares of foreign company. At the same time, foreign person can purchase shares of Indian company. So, but the problem is, if he or we wants to study another country financial statements, we can't study or we can't compare with our Indian companies. Why? Because the simple thing, standards are different. We are following our accounting standards, they are following their own standards. So that is the reason we can't compare two different countries financial statements, especially our Indian company. So actually, even though every country has their own accounting standards, one standards are there, they are universally accepted standards. So they are IFRS. IFRS means International Financial Reporting Standards. These are universally accepted accounting standards. So n number of countries are accepting these standards, just like dollar. Okay, so there is some list of IFRS, not important for us to remember the entire standard numbers as well as names. Just let me read the number as well as content, then we'll move on to the further topics. IFRS 1, first time adoption of international financial reporting standards. IFRS 2, share based payments. IFRS 3, business combinations. IFRS 4, insurance contracts. IFRS 5, non current assets held for sale and discontinued operation. IFRS 6, exploration for and evaluation of mineral resources. IFRS 7, financial instruments. IFRS 8, operating segments. IFRS 9, financial instruments. IFRS 10, consolidated financial statements. IFRS 11, joint arrangements. IFRS 12, disclosure of interest in other entities. IFRS 13, fair value measurement. IFRS 14, regulatory deferral accounts. IFRS 15, revenue from contract with customers. IFRS 16, leases. If you observe, so even in IFRS, there are two kinds of different standard. One is IFRS, second one is IAS. IFRS means International Financial Reporting Standards. IAS means International Accounting Standards. So from IAS, again from 1 onwards. IAS 1, presentation of financial statements. IAS 2, inventories. IAS 7, statement of cash flow. IAS 8, accounting policies, changes in accounting estimates and errors. IFRS 10, events after balance sheet date. Sorry, IAS 10. IAS 12, tax income account. Sorry, the correct standard is income taxes. IAS 16, PPE, property, plant and equipment. And IAS 19 is employee benefits. 20 is government grants. 21, effect of changes in foreign exchange rates. 23, borrowing cost. 24, related party disclosure. 26, accounting and reporting by retirement benefit plans. 27, separate financial statements. I think in yesterday's session I told you what is the meaning of separate financial statements. What is the meaning of separate financial statements? Whenever a company has subsidiary companies, then they have to prepare two kinds of statement. One is separate, second one is consolidated financial statements. And 28, investments in associates and joint venture. 29, financial reporting in hyperinflationary conditions. 32, financial instruments. 33, EPS, there we covered EPS. 34, interim financial reporting. 36, impairment of assets. 37, provisions, contingent liabilities and contingent assets. 38, intangible assets. 40, investment property. 41, agriculture. So actually these all are IFRS and IAS. Sir, these all are not Indian standards, they are international standards. Now the real picture comes. So actually there is a situation where we have to update ourselves, we have to compete with international companies, then that is the reason we have to match with international standards. That means we have only one option, we have to follow IFRS just like remaining countries. But we didn't follow IFRS directly. Instead, we take this IFRS and IAS as a base and we converted this standard into Ind AS. That very cleverly. So they have taken IAS 1 and converted and they have changed the name into Ind AS 1. IAS 2, Ind AS 2, IAS 7, Ind AS 7, like that. Coming to IFRS, IFRS 1, Ind AS 101, IFRS 2, Ind AS 102, IFRS 3, Ind AS 1, like that we have converged. So here converged means majority standards are similar to normal IFRS. We have just slightly modified 99%, sometimes 98% content is same. Okay. So then Ind AS comes into picture. Already I told this entire content somewhere. Now let me discuss applicability of Indian accounting standards. For which companies Indian accounting standard is applicable. Okay, fine. Now let's see applicability of Indian accounting standards. So actually, Indian accounting standards. So our intention of our ICA and our central government is they don't want to pressurize the companies. They are slowly what you call motivating all the companies to convert from accounting standards to Indian accounting standards. That's why they come on phase wise. On phase one, they have focused on companies other than NBFCs, insurance companies, and banking. In phase two, they have focused on banking. So let me see what are the applicability of Indian accounting standards. Have a look. So for companies other than banking, NBFC, insurance companies. So banking companies, so SBI, S Bank, ICICI, they are called banking companies. What is NBFC full form? NBFC means non-banking financial companies. At the same time, for insurance companies also. That means if any company other than banking company, other than NBFC, other than insurance company, for them they have given phase wise. First phase from 1st April 2016 onwards, they have given some conditions. If these conditions are satisfied, every company other than these three, other than banking, NBFC, insurance, they have to follow Indian accounting standards. First one, equity or debt are not listed or not in the process of listing. No, actually there is listed not. Yeah. Equity or debt securities either listed or in the process of listing, and net worth should be 500 crores or more. Sir, what is the meaning of listing? Already we know that what is the meaning of listing. What is the listing company? Listing company means companies which are listed their companies in recognized stock exchanges, either BSE or NSE. NSE stands for National Stock Exchange, BSE stands for Bombay Stock Exchange. Sir, no sir, our company is not listed, but we applied for listed. It is in the process of listing. Then also you have to follow in AS subject to condition if your net worth is 500 crores or more. What is the meaning of net worth? Net worth is nothing but assets minus outside liabilities. Nothing but net worth means owner's equity. Second one, unlisted companies having net worth 500 crores or more. Even though if such company is not a listed company, but if their net worth is 500 crores or more, for them also Indian accounting standards is applicable from 1st April 2016. Sir, no, sir. Condition 1 is not satisfied, 2 is also not satisfied. That means we are listed company, we are not listed company, or not in the process of listing company, or else net worth is not more than 500 crores, even though sometimes Ind AS is applicable. Even, sir, if one company is there, that company is not fall under the above two conditions, but if it is a holding company or subsidiary company or associate company or joint venture of the above two conditions satisfied company, then that is also that company also have to follow Ind AS. Sir, I didn't understand, sir. No, don't worry, I'll give you an example. For example, there are two companies, X and Y. X company is parent company for Y. That means X is holding company, Y is subsidiary company. Okay. Yeah. X is holding company, Y is subsidiary company. So X has to follow Indian accounting standard. Why? Because it's complied these conditions. Why did not satisfy this condition? So why need not to prepare, why need not to follow Indian accounting standards? But even though Y has not fallen under this category, still Y is also required to follow Indian accounting standards. Why? Because company Y has holding company which need to follow Ind AS. That is the reason Y Limited also has to follow Ind AS. Simply I can say in normal sense or normal language, if even though for you Ind AS is not applicable, if your holding company or subsidiary company or associate company or joint venture, if they are following Ind AS, you should also follow Ind AS. That's it. That is first phase. Second phase, from 1st April 2017, that means from next year onwards, listed companies net worth less than 500 crores. That means in phase 1, they have covered listed companies net worth more than 500 crores. In phase 2, they have covered few more companies, even though if your net worth is less than 500 crores, don't worry, you also come and follow Indian accounting standards instead of normal accounting standards. Second one, unlisted companies having net worth 500 crores or more but less than, sorry, that is not 500, that is 250. Yeah, that means in second condition, unlisted company net worth 250 crores or more but less than 500 crores. That means in phase 1, they have covered all unlisted companies who are having net worth more than 500 crores. In second phase, they have covered even though if your net worth is less than 500 crores, if it is more than 250, you are also welcome. Please follow Indian accounting standards. Okay. Condition number 3, same as phase 1. Even though you are not complying with these conditions, if you are holding or subsidiary or associate or joint venture, if they are need to follow Indian accounting standard, you have to follow Indian accounting standards. Okay. So this is only for companies other than banking, other than NBFC, other than insurance companies. What are the conditions? They have divided into 2 phases. In phase 1, listed companies net worth 500 crores or more. In phase 2, unlisted companies net worth 500 crores or more. In condition number 2. Condition number 3, holding or subsidiary or associate or joint venture of the above. In phase 2, it is from 1st April 2017. So there, unlisted company net worth less than 500 crores, listed company net worth less than 500 crores. Second one, unlisted company net worth 250 crores or more but less than 500 crores. Point number 3, holding or subsidiary or associate or joint venture of the above. This is for companies other than banking, NBFC, insurance. And then in third phase, it is for banking is not applicable actually. It is for NBFCs, non-banking financial companies. Their phase 3 and phase 4. Phase 1 and phase 2 for other than banking, NBFC and insurance. Phase 3 and 4 only for NBFCs. So phase 3 from 1st April 2018. Phase 1 1st April 2016. Phase 2 1st April 2017. Phase 3 1st April 2018. So in this phase, let's see, NBFCs having net worth of 500 crores or more, similar to phase 1. If you are NBFC, so 2016 and 17, they have not covered you to follow Indian accounting standards, but from 1st April 2018 onwards, even though you are NBFC, if your net worth is 500 crore or more, you have to follow Indian accounting standards instead of. Next one, unlisted NBFC net worth 250 crores or more but less than 500 crores, similar to phase 2. That means if you observe, phase 1 and 3 are similar, 2 and 4 are similar. Condition 3, holding, subsidiary or associate or joint venture of the above. So that means if you observe, phase 1, 2, 3 and 4, phase 1 and 2 are for companies other than banking company, other than insurance, other than NBFC. There they are focusing from 1st April 2016, phase 1, second phase 1st April 2017, right? In phase 3 and 4, it is only for NBFCs. Phase 3 from 1st April 2018, phase 4 is 1st April 2019. So if you want at a glance total applicability of Indian accounting standards, divide into two branches. First branch, companies other than banking, NBFC, insurance, and second branch, NBFC. In first branch, again divide into two branches. First phase 1, phase 2. Phase 1, 1st April 2016. Phase 2, 1st April 2017. Phase 3, 1st April 2018. Phase 4, 1st April 2019. So for 2016, for whom index is applicable? Listed entities and net worth 500 crores or more. Coming to phase 3, here also same, but generally NBFCs are not listed, no? So net worth only 500 crores or more. And condition number 2, their unlisted companies net worth 500 crores or more. If nothing is satisfied, either holding or subsidiary or associate or joint venture of the above. Coming to phase 2, it is from 1st April 2017. So it is focusing on the entities which are not covered in phase 1. So generally, if you observe the first condition, listed entities net worth is 500 crores or more, they are covered in phase 1. Phase 2, they want to cover all listed entities if their turnover is more or less whatever it is. So they have covered all entities if your turnover is less than 500 crores. So what about more than 500 crores? They are already covered in phase 1. Second one, unlisted companies having net worth more than 250 or more but less than 500. That means if you observe, for unlisted companies some exemption is there. In case 1, they are focused only. Okay, so in phase 1, they have covered unlisted companies net worth 500 crores or more. In phase 2, they have covered, that means in phase 2 they have covered, even though if your net worth is not 400 crores or more, if it is in between 250 to 500, you have to follow Indian accounting standards. Coming to NBFCs, again phase 3 and phase 4. Phase 3 is about net worth. If your net worth is 500 crores or more, you have to follow Indian accounting standards. No sir, my net worth is not 500 crores or more, then you need not to comply with Indian accounting standards. But one thing remember, if your holding company or subsidiary company or associate company or joint venture, if any of them are need to follow Indian accounting standard, then automatically you have to follow Indian accounting standards. There is no exemption towards it. Last phase, 1st April 2019, fourth phase. So here NBFC is having net worth less than 500 crores. If net worth more than 500 crores, phase 3, less than 500 crores, phase 4. That means they are covering all NBFCs. And unlisted NBFCs net worth 250 to 500. So in NBFCs also listed there, unlisted also there. Okay. If as usual, even though if you are not covered in phase 3 or phase 4, if your holding company or subsidiary or associate or joint venture, if they are following Indian accounting standard, you need to follow Indian accounting standards automatically. So this is all about IFRS and applicability of Ind AS. I will give you a list of Ind AS, no need of detailed discussion. I will give the list in your material, that is enough, just study it. So with this, we covered totally 3 chapters. First chapter, Introduction to Accounting. Second chapter, Introduction to Corporate Accounting. Third chapter, Accounting Standards including Ind AS. So we have covered successfully 3 chapters, but my dear students, these 3 chapters are not that much important for examination point of view. They are not that much important. So from next chapter onwards, share capital onwards, they are important for exams. If you are just listen at least once, that is okay up to these 3 chapters. But from next chapter onwards, you have to be very cautious and careful. You have to listen each and every class in detail, then only you will get more clarity on corporate accounting and financial management subject. Okay, thank you, bye bye.